Good morning, everyone. I'm Alexis Christoforous.
And I'm Brian Sazi, and this is the first trade for Wednesday, December 11th.
A stunning debut. Saudi Aramco finally hits the market and soars in its first day of trading, passing Apple and Microsoft as the world's most valuable company. We'll dig into what this means for the oil markets and for rivals Exxon and Chevron.
And moment of truth. The Fed is set to unveil its latest decision on rates in just a few hours. All eyes on Jerome Powell to see if he will give in to the president's demands and deliver another rate cut.
And the new grocery store. We take a look at how Target is transforming the way we all shop for food and why a big push into groceries is helping the bottom line at our Yahoo Finance Company of the Year.
Let's get a quick peek at the futures here ahead of the Fed decision later on today. Some mixed action out there, no big movements just yet. But again, all eyes on that Jerome Powell press conference later on today. Dow futures down about 19 points.
All right, we'll get a full check of those markets for you in just a bit. But first, today's big story.
There's a new title holder for biggest company in the world. Saudi Aramco started trading this morning on Saudi Arabia's main stock exchange, the Tadawul. The stock ripped higher to the tune of 10%. That gives the company a $1.88 trillion valuation, making it the biggest IPO ever and the most valuable company by market cap on this planet. Yahoo Finance's Jared Blickery is at the Wi-Fi Interactive board to break down this big day. Jared, take it away. We've been waiting for this day for quite some time.
I know you have, Brian.
Yep.
So they got a $1.7 trillion valuation. They got a 10% pop on their day one of trading, and that is the exchange limit. So if you look at the intraday price action, the exchange closed at 7 a.m., just a flat line there, but they did get that $1.88 trillion valuation as of the close, but kind of a hollow victory because they had to make a lot of concessions along the way. Originally, they wanted a $2 trillion valuation, and they wanted to raise $100,000 in the capital, $100 billion in the capital markets. They rose just over a quarter of that, still making it the biggest IPO raise, capital raise to date, but also consider what else they had to do. They had to cancel their roadshow. There was no international demand for this IPO. It was all domestic, and they had Prince MBS dialing for dollars himself, and also on the first day of trading saying, please buy this, don't sell. That's according to the FT. And then the icing on the cake for me is the OPEC Plus meeting last Friday. They got a surprise $500,000 barrel per day cut, and that actually got the price of Brent crude up, and that supported the $1.7 trillion valuation in the first place.
Yeah, that was, I guess, good timing, right? I want to talk about its effect, though, on other oil companies, especially oil companies here in the U.S. And also, is there going to be any kind of an effect at all on the price of oil, do you think?
I don't think it's going to affect the price of oil itself. Now, if you're investing in Saudi Aramco, and it's going to be propagated through various MSCI indices eventually, you have to understand that you're probably going to get a lower dividend yield than you will with the other major oil companies. So you look at Royal Dutch Shell, BP, they have a dividend yield of 6.5%. Saudi Aramco is 3.9%. Even Exxon is 5%. And then you have some downside risk to the price of oil and not a lot of upside. As soon as the price of oil raises, the Saudi government gets more of it, such that at $100 per barrel, they're getting 80% of the revenue from Aramco. So you don't necessarily see that upside here.
Jared, is this the type of event that would lift share prices throughout the oil patch? You know, we had Matt Maley on yesterday, too, and he pointed out this remains a very unloved sector.
Yeah, because this is very domestic to the Saudi government and the Saudi country, I don't think it's going to have a big ripple effect through the international pricing scheme of things. Maybe there'll be a little bit of a pop today because of some excitement, but overall, people aren't going to really care unless this is listed on a secondary exchange, and that's their goal.
All right, Jared Blickery, thanks so much. We'll see you a little later on for our commodities report. Time now to head to the New York Stock Exchange and say good morning to Yahoo Finance's Inez Ferrer. Inez, GameStop getting absolutely pummeled this morning after that disappointing earnings report.
Alexis, another disappointing earnings report for GameStop. It is plunging in pre-market. This is after the company came in with an adjusted loss of 49 cents a share, a definite miss. Their sales were down 26% from the same quarter last year. And CEO George Sherman blamed these results in part to an unprecedented decline in new hardware. Remember that the new console cycle starts next year. We're also watching Dave & Buster's. This is after mixed quarterly results results, with their earnings coming in as a miss. The revenue, though, was up 6.1%. That was a beat. Comparable store sales were down 4.1%. That came in shy of what the street was expecting, of a decline of 4%. The company did come in with some solid guidance for the full year, though. And then we're watching Ollie's Bargain Outlet, seeing a pop this morning in pre-market, up around 10%. This is after a better than expected third quarter, with its beat on adjusted earnings. Its revenue came in above the average street estimate. Same store sales came in just short of expectations, but the company did reaffirm its full year guidance, and also the company's interim CEO will now become CEO after the founder passed away on December 2nd. The CEO was formerly CFO of the company.
Yeah, and as GameStop CEO must have left out, they have too many stores in dying malls, but we'll have to leave it there. Inez Ferre, thank you.
100%. Thank you.
Coming up here on The First Trade, the Fed is getting ready to announce its plans on interest rates, a preview of what you can expect coming up next.
Let's take a look at the European markets this morning. We have got the FTSE 100 down about 6 points, the CAC 40 up slightly, the DAX rallying 69. Yahoo Finance's Tom Belger joining us from London. And Tom, the pound continuing to rise as the latest poll predicts a Conservative victory in tomorrow's general election. I'm curious what that might mean for Brexit.
Hi, yeah, if this eagerly anticipated poll of more than 100,000 people is right, the Conservatives could be on track for their biggest win, biggest parliamentary majority since the 1980s. That should allow Prime Minister Boris Johnson to push his Brexit deal through Parliament after years of turmoil getting a deal through. That's why the pound's been rising, with investors betting that reduces the chances of Britain crashing out without a deal. It's worth saying, though, Britain wouldn't be out of the woods entirely, with the reality that Johnson portraying Brexit as done and dusted by the time we leave, potentially on the 31st of January. But voters probably going to end up frustrated to discover there's years of tough trade talks potentially ahead. And while Johnson's promised the smooth transition period of 1 year where we stick to EU rules won't be extended, most experts think negotiating a trade deal within that time period is very, very difficult. So in reality, we could be having the same conversation in a few months' time that we've been having for the past year about the potential for Britain crashing out without a deal. One last thing on that poll. It's worth saying a Tory victory is not guaranteed. Within the margin of error is a hung parliament when no party has an overall majority.
And Tom, switching gears here, you must be doing some shopping at Zara. Those results look pretty good.
Indeed, everyone seems to be flocking to Zara. The Spanish multinational Inditex, which owns the company, says sales are up 7.5% in the 9 months to October. Sounds like running a very tight ship is how they've managed that. They've managed to lift sales even though actual stock levels have fallen, which is no mean feat. They now use tags sewn into the clothes they make to track every single product, and that makes it much easier to respond not just quickly to demand, but also avoid undersupply. And we know their rival Swedish giant H&M, that's a massive headache for them, the amount of unsold goods they've got.
I think they did. They have gotten a little overpriced, but we'll leave it there. Tom Belger, thank you. Coming up here on the First Trade, Time names its Person of the Year. Your news bites are next.
Let's take a look at today's News Bites. Officials in Jersey City now say they believe a kosher market was targeted by gunmen in a brazen attack that left 6 people dead. A police officer was among those killed, along with 3 bystanders, before the 2 gunmen were shot dead. 2 other officers were wounded. Officials there and in nearby New York City have now stepped up their patrols at Jewish sites. A federal judge in Texas has blocked the Trump administration from using some military funds to build the U.S.-Mexico border wall. The judge said some $3.6 billion cannot be diverted to the wall since Congress appropriated it for another purpose. Earlier this year, the Pentagon moved money from various overseas and domestic projects to be used for the wall. And Time has announced its 2019 Person of the Year, Greta Thunberg. The Swedish teen has made headlines for her prominent role in the fight against the effects of climate change. At just 16, she is the youngest figure to be named the Time Person of the Year in its 92-year history. Time also named Disney's CEO Bob Iger as the 2019 Business Person of the Year. And boy, oh boy, it's a good day to be Garrett Cole. The prize free agent pitcher is reportedly signing a contract with the Yankees for 9 years. Forget this, $324 million. That is the largest deal ever for a Major League Baseball pitcher. Of course, the Yankees tried to draft Cole back in 2008. He declined, decided to pitch in college instead. He ultimately wound up playing for the Pittsburgh Pirates and, of course, then the Houston Astros. Coming up here on the First Trade, breaking down our Company of the Year. We'll look at how profitable the food aisle has become for Target. In just a few hours, the Federal Reserve is set to announce its latest decision on interest rates. And while every indication is that they're going to hold firm and not make any changes, the president is pushing for yet another cut. Let's talk more about this now with Scott Brown. He is chief economist over at Raymond James. He joins us this morning from St. Petersburg, Florida. Good to see you as always. Thanks for being with us. I'm just curious, what are you going to be listening for today during Chairman Jerome Powell's press conference?
Well, I think because everybody expects the Fed to stay pat at this point, the big question is what are they going to do over the course of 2020? And in public speeches, Powell has indicated that monetary policy is viewed as being, well positioned at this point to support growth, to support a strong job market and a return of inflation to around the Fed's 2% target over the course of next year. But the Fed is going to be, conditional. Our policy is going to be conditional. If the economy starts to weaken more substantially, then the Fed may come in with further rate cuts. But we don't really anticipate that at this point. So it looks like steady as she goes.
Scott, what grade would you give Jerome Powell for his performance this year?
I think it's been pretty good. You remember a year ago, the Fed raised rates. A lot of people think that was a mistake, but I don't think the Fed anticipated that the global economy was going to be as weak as it was. They didn't anticipate the trade policy disruptions that we've seen, which have dampened growth to some extent. So in hindsight, yeah, I mean, that may have been a mistake, but again, it's only because they didn't know what was coming. But the Fed, reversed course. They were very quick in terms of shifting the outlook. I mean, a year ago, we were kind of looking at maybe 1 or 2 rate increases for 2019. Instead, we got 3 rate cuts. And the Fed is really looking forward and looking at the downside risks. And really, they've taken out some insurance against the possibility of some downside next year.
Scott, hasn't the Fed completely just saved the market this year?
Well, they had, I think, but the Fed doesn't cut rates just to support the market. The Fed may react. The stock market may decline, and the Fed may react, but that's because the stock market is indicating economic weakness, and the Fed is really reacting to that downside risk to the economy. For the last couple of years, we've seen maybe the view that the Fed rate cuts would be almost like heroin for the markets. They just need another fix. But my sense is the market's a little bit more comfortable at this point. Again, we don't really expect the Fed to be coming in with more rate cuts or with a major expansion in the balance sheet. We do know the balance sheet is going to be expanding. More in line with the overall economy, the need for reserves. But inflation is still pretty low, job market's strong, and again, for the Fed, I think this is still a very good economic outlook in the near term.
You sort of just touched on it, Scott, but a hot topic around the Fed has been the repo market. They've been trying to smooth things over there. They've got this quantitative easing-like situation going on where they're buying up T-bills, widening the balance sheet. What do you make of all of that? Should we be concerned?
Well, the Fed's view is this has really been a technical issue. There were a number of just special factors that led to the squeeze that we saw in the repo market in September. And the Fed has responded with facilities really to support liquidity into the money markets, well into the first part of next year. I think they seem to be caught a little bit off guard by it. There may be some regulatory changes that are involved. And I think they're going to be monitoring closely. But, the Fed's going to provide as much liquidity as the money market needs. So this really doesn't seem to be a systemic problem for the financial sector.
All right, Scott Brown over at Raymond James. Always great to see you. Thanks a lot. And we're going to have complete coverage of the Fed's decision and Jerome Powell's news conference starting at 2 p.m. Eastern right here on Yahoo Finance as well as on our app.
Yahoo Finance Company of the Year Target has quietly transformed into a serious grocery store, and that is playing a big role in driving customer traffic to its stores each week. I talked to Target CEO Brian Cornell on why the company's food aisle has a fresh new look to it.
It's the target of new, and it's an area that we put a lot of focus on, elevating our quality, improving our sourcing, changing the in-store experience. And when you pull it all together, Brian, I think it's really an exciting change for us. We also just introduced a exciting new own brand called Good & Gather that I expect will become our single biggest own brand in our portfolio over the next couple of years. So the team's done some great work here, and the guest absolutely loves shopping this section.
Is Target legit in groceries now?
Well, I think we provide everything you need. So we don't have the endless aisles, we don't have massive assortments, but we have all those core items that we know our guest needs in their pantry each and every day. Great quality, great value. We're priced right daily, and you can see the traffic we have in this store.
How important is it that Target is now selling an expanded grocery section? Is that the magic behind some of the results you've put up in 2019?
It's one of the key drivers, but it's not the only driver. So we're seeing traffic growth in apparel, in home and beauty, in toys and household essentials, and in food and beverage. So when I think about our success, it's really the power of the and. It's all those different elements working together, and hopefully even you will start shopping for food and beverage in one of our new stores.
Brian, I'm in these stores. I am buying the fish. I am buying the steak. I am the Target customer. Where are you at with the out of stocks? We've talked about this in the past. How have you addressed that issue?
Yeah, it gets back to our new operating model. Having dedicated team members in these spaces, and they know in food and beverage how important it is to have those top selling items in stock every time you shop. So a key area of focus, and every week we get better and better and better.
Where do you see Target and groceries looking forward?
I think it's an important part of our mix, and I think it's going to help us drive traffic. We're gaining market share in this space. We're bringing exciting new brands in, both national brands and our own brands. And we hope we're going to delight guests for years to come by offering them great product, great quality, and great value in food and beverage.
And here's more proof to highlight how big grocery sales are for Target. Food and beverage sales are making up more than 20% of its overall business now. Big time stuff. Alexis, groceries at Target, they're a legit grocery store.
Are groceries bringing in more traffic to the store? Is that why people are actually going in, or are they going in for other things and then going, oh boy, let me go over to the food aisle?
People are straight up going to Target for groceries, and kudos to them because they have expanded the number of fresh groceries. They've also improved the product quality, so you don't go in there any longer to see rotting fruit and vegetables on the stands, but they've also improved what they call the consumables department. So you have a lot more paper towels, a lot more organic canned goods, and that's where they're winning.
What about the new loyalty program? Is this part of, how does food play into the loyalty program?
That loyalty program, Target Circle, just launched, and I believe it has over 30 million members. That is huge. So that is, yes, that's helping to drive traffic to the stores.
All right, thanks, Brian. And the opening bell coming up next here on The First Trade. First, here's a look at the action in overseas markets where things are mixed. And stay with us, much more show ahead. We'll be right back. Welcome back to the first trade. We are about 5 minutes away from the opening bell. Stock futures are mixed. Dow futures in the red, but the broader market slightly higher. Let's go around the bell with Christina Hooper, Invesco Chief Global Market Strategist, along with Yahoo Finance's Jared Blickery at the Wi-Fi Interactive Board. Good morning. Christina, I'm just going to start with, I guess, the news of the day. I don't know how much news it's going to be, but the Federal Reserve is going to be out with its decision on interest rates. What are you? We all expect them to stand pat, but what are you going to be listening for from Powell?
So a few different things. First of all, I want to see that dot plot. I want to see expectations for next year in terms of a policy prescription. Also expectations on where they think growth will go, where they think inflation will go. But I think even more important is going to be what Jay Powell says in that press conference. Just how comfortable he is with the idea that the bar remains very high for any kind of rate hike. I expect him to say the bar will remain high for any kind of rate cut. That's okay. What's far more important is that the bar is high for any rate hikes because we're in a very accommodative place right now.
Christina, we just had Raymond James, Scott Brown on here, and he pointed out a lot of people in the market view these rate cuts as heroin. Strong statement, yes, but is this market addicted to rate cuts and promises of more down the line?
Well, I actually take exception with that. I would say more like crack.
Well, that's really splitting hairs. Wow, Christina, I did not expect that card for you. You've been on a while. I never would have expected that.
Well, it's just that markets have come to expect it. And quite frankly, it is the key factor driving stocks right now in an upward direction. It's a real support for really risk assets in general. So,
well, you got the quote of the week, Christina. That's great. Let's leave it there.
Correcting us, not heroin, it's cocaine. What about his forecast? You're going to be looking at his forecast about the economy. It'll be interesting to see what picture they paint, given the fact that we came off this really strong jobs report recently.
Absolutely. But also recognizing that we're likely to see some kind of deterioration in growth. It shouldn't happen throughout the course of 2020, but we'll probably see a deterioration at least going into the first and possibly the second quarter. Usually that first quarter is something of a disappointing time for growth. So it would be great to hear what his view is. Do we hit an inflection point? Do we move higher, and how much higher? These are all really important considerations for the Fed, especially given that this is an environment where they are trying to focus and target higher inflation, and they're having trouble.
And where is it?
Yeah. Exactly.
I want to ask you the same question we asked Scott Brown of Raymond James about the repo market. It's sort of been under the radar, but should we be concerned that the Fed seems to be coming to the rescue here in the repo market?
Well, I think that what we're seeing going on in the repo market is just a function of some conditions that have collaborated and conspired to create where we are today. But the reality is the Fed is doing everything it can. It's being quite proactive about it. And so I would not take I would not pick an argument with your previous guest. What I would tell you is that the Fed is there to provide liquidity, and that's the good news. The Fed increasingly sees its role as not just about essentially bringing about full employment while controlling prices. It's also about creating stability in markets. And that's what this is. And I think that going forward, we're likely to see the Fed do more in the way of that role, perhaps, than some of the other components of its role.
Jared, tough act to follow. Christina's come out firing today. What do you keep an eye on at the Wi-Fi Interactive boards?
Yeah, we got a mixed picture. Not a lot of movement. Hong Kong, one of the bigger movers, up about 0.8%. The Kospi up 1/3%, and then the DAX up 0.4%. But in London, the FTSE's down about 1/4%. And a mixed picture in the U.S. We got the Dow futures down here, just ahead of the bell. Home Depot is off 2% in the pre-market, and that's because they lowered their full-year guidance for 2020. S&P 500 futures look like they're going to open in the green. Maybe, maybe not. We'll see what happens with the NASDAQ as well here.
Looks like they got a party going on there at the NASDAQ, right? I don't know who's ringing the opening bell there, but here we have the markets underway with the Dow Industrials off about 36 points. We've got to talk tariffs. While the Fed is the news of the moment, of course, we're looking out to next week on December 15th. What happens if that? All indications are that these are going to be kicked down the can, these new round of tariffs. If they're not, not. What kind of an effect does that have on the stock market?
I think it has a negative impact on the stock market. And I would say never. We just don't know. What we've heard is China say that the Trump administration is likely to defer those tariffs. But we haven't heard that definitively coming from the Trump administration. So I think there is the potential that it could actually be imposed. Those could be imposed on the 15th. And I do think that would have a very negative impact on the stock market.
To what degree? A 5% drop or worse?
I think you could see something like 5%, perhaps slightly more, but it would be probably relatively brief. One thing we didn't talk about was what Powell might say today about trade. Because keep in mind that is one of the elephants in the room for the Fed, one that they have up until now reacted to. So if the trade situation were to deteriorate, I'm sure he might, I think he might get a question today on what would happen if the tariffs are imposed. The Fed might stand ready to be a little more accommodative at its next meeting.
What are those, if the tariffs do go into effect, what does that do to growth in the first half of next year?
Well, what the actual tariffs themselves are certainly have a negative impact, but I don't think it's a dramatic one on growth. The bigger issue is the longer term impact that tariffs create, that environment of economic policy uncertainty that really deters business investment. We've seen weakness in business investment, and that could spill over at some point to employment, and that would be where it really is problematic for the economy. But even having weakened business investment is a problem over the longer term because that will likely result in lower productivity.
None of this is priced into the market.
I don't think it's priced in. I think the market has been very optimistic with regard to trade really since the get-go.
Yeah.
What about, though, a lot of these tariffs would be hitting consumers in the wallet, because these are items that they really do interface with, and we know the consumer has been such a pillar of our economic growth. Doesn't it have the potential to actually hurt consumers enough that we can start to see them pull back?
It could, but I think it would take some time to do that because when tariffs first hit, I think there's a time lapse where we actually see consumers slowly adjust to higher prices, perhaps forego some spending. We certainly saw that with washing machines, but there are some expenses they will tolerate, and maybe that means a lower savings rate. It really remains to be seen exactly how consumers react if we do get those December 15th tariffs.
Jared, what really caught my attention yesterday was some strength in the chip stocks, and more broadly, a lot of these tariff-related companies the stocks are really hanging tough here. Go figure, right?
Yes, they are. And we can see in the Dow, tech is doing well. Apple's up 0.33%. 10-year T-note yield is basically flat. We have JP Morgan just a little bit underwater, Goldman Sachs above. But speaking of the tech stocks, we'll go to the NASDAQ 100 here, and we can see some standouts. Qualcomm is up 1.2%. Now, this is a company that has been reaching record highs recently. We can see it's up about 50% year to date. We can look at some other stocks if we sort by performance here. We see Western Digital, that's up 1.9%, Micron up 1.4%. Overall, the SOX has been outperforming most of the year, and it's got to be up something like 50% year to date. And there we go, 49.79%. But getting back to the discussion of the yields and what to expect from the Fed today, my biggest concern is actually the repo market, because Zoltan Pozsar was out with an analysis. He's from Credit Suisse now, but he used to work for the New York Fed. He was the architect of the 2007, 2008 emergency lending programs. And he's saying that you can provide all the liquidity you want, but if JP Morgan doesn't want it, it's not going to get transmitted through the rest of the financial system. So he's concerned that rates are going to spike into year end, treasury yields are going to spike, and that stocks are going to roll over as a result. And he's saying the solution for it is simply for the Fed to buy coupons instead of treasury bills, but that would be QE. The Fed doesn't want to do that. We'll have to see what happens over the next 2 weeks.
Yeah, they haven't wanted to call it QE. Do you think that's because QE just has a bad rap on Wall Street at this point?
Well, I do. And also, if we think about cutting rates as crack, QE is meth.
You are just running the gamut through all the drugs.
You've absolutely shocked me today. Getting off this topic, I'm sure you've seen the response to the Aramco IPO. And oil, the sector, has been very underowned, very underloved. Is this the type of event that could get some of that love going into the oil sector?
It could. Certainly, it's an area that really has been quite depressed because it's just been avoided by investors for a while now. So it certainly has that potential, but I do believe that what ultimately will drive investors in is a sense that there really will be structural shifts in supply and demand. They just haven't seen that yet, and I think that it would have to take a catalyst like that to really drive a lot of investors in.
What about retail? We certainly shined a spotlight on retail here at Yahoo Finance. Our company of the year is Target, and Brian's been doing a great job outlining all the things that they're doing right. Today, we're seeing a lot of companies that are doing it wrong. Children's Place getting pummeled, GameStop getting pummeled today in the market because of disappointing earnings. Are you in retail, and if so, where are you looking?
Well, I think the key takeaway from just exploring the retail space is that one needs to be very selective and discerning. That, as you rightly pointed out, some companies get it. They've figured out the right strategy, the right multi-channel approach. Others just haven't. And of course, we're going through a fourth industrial revolution right now, which is altering the retail landscape and promises to alter it even more dramatically going forward. So that those companies that have their finger on the pulse and at times are willing to experiment to try to get their approach correct are the ones that are likely going to win. But this is a very fluid situation right now. So one can be positive on retail, but be very discerning and also be willing to move tactically.
Jared, all eyes on Home Depot here. Another revenue warning from this company.
Yep.
This one today ahead of an analyst event.
Yeah, and this was based on an expected slowing of the housing market next year. So that's not the greatest sign for these home improvement retailers, and we know a lot of that translates into general spending in the economy as well. But I decided to look at our retail sorted by quarter-to-date performance, and a lot of the top performers have been downtrodden in the year, but have picked up recently. So we have Bed Bath & Beyond, that's up 53.9%. But if we look at the year-to-date, we can see it had been in the red going into August. And if we look at the second place here, JCPenney up 30%, Dick's up 22%, Nordstrom up 22%, and then Target, of course, our company of the year, that's had solid performance all year long. But a lot of the retailers that hadn't been doing well until recently picked up when the yield curve started expanding, and maybe that's part of the rotation that we've seen into value and cyclicals recently.
Good stuff, Jared. That is still weird to see that type of just selling in Home Depot, nonetheless. Jared Blickery, Christina Hooper, way to bring a fire today. I'll talk to you soon. Coming up here on The First Trade, more bad news for Peloton. New reports send its shares crashing. We'll break it down next. Let's get back down to the New York Stock Exchange floor and check in with Yahoo Finance's Inez Ferre. Inez?
Brian, right now we're watching Children's Place that is down about 18% this morning. This is after a disappointing quarter. Revenue for the quarter came in as a miss. Same-store sales were up 0.8%. The street was expecting an increase of 3.5%. The company cut its full-year guidance and also included the adverse effects of tariffs in its EPS guidance. We're watching also JetBlue down just slightly. This is after they gave some guidance for its fourth quarter regarding their revenue per available seat mile, with JetBlue expecting a decline in the range of anywhere between 3.5% and 1.5% because of softer than expected yields in late November, and also the negative impact of weather during the Thanksgiving holiday. And finally, we're watching Netflix after Netflix received a bullish note from Piper Jaffray a day after Needham had downgraded the stock, predicting a subscriber loss next year. Piper Jaffray's note maintains an overweight rating with a price target of $400, with the note citing some search trends research predicting a subscriber bump in the first 2 months of the fourth quarter. And Piper Jaffray is predicting that its subscriber growth increased in the fourth quarter above consensus estimates.
All right, Inez, we'll leave it there. See you a little later on. The NASDAQ is set to beat the New York Stock Exchange in money raised through IPOs for the first time since 2012. Yahoo Finance's Scott Gamm is here with this one. Bragging rights for the NASDAQ. I guess it took a lot for the NASDAQ to come back from the debacle that was Facebook's IPO back in 2012.
Yeah, that was a debacle, and we all remember that. And, that still comes up from time to time, just the memories of the months after that year.
Much to the chagrin of NASDAQ, but yes.
Exactly. Now, when it comes to DealLogic data this year, NASDAQ listed IPOs have raised about $32.4 billion. It's a couple billion more than the $26 billion that NYSE listed companies IPOs have raised this year. Now, according to some statements in the Wall Street Journal, NYSE says that when you add on the follow-on offerings, so if a company is already listed on the New York Stock Exchange and they want to list even more shares, when you add in that money, they're ahead of the NASDAQ. Okay. So I think the bottom line is there will always be this competition between the NASDAQ and the New York Stock Exchange. I think the bigger concern for investors is not who's winning that race. It's kind of irrelevant from the point of investors. But what is the IPO outlook telling us? Because two things have happened. One, you had obviously a lot of high-profile IPOs this year, and some were worried that that was suggestive of some sort of a market top. That clearly did not happen. And then two, you have this renewed focus on profitability, right? There's a lot of scrutiny on some of these IPOs to wait until they are profitable before pulling the trigger and becoming public. That sentiment, if it continues, could affect the 2020 IPO outlook.
I mean, let's not totally poo-poo the New York Stock Exchange. They had Uber, and they also had some big direct listings. They had Slack on there, and you're down there all day. It's been a busy year for them.
Oh, absolutely. And Uber raised over $8 billion. And you bring up a good point on the direct listings, because that is kind of I don't know if it's a new phenomenon, but it's certainly something that some of these unicorn companies are considering. So you mentioned Slack this year, Spotify last year, and perhaps we'll see more of those because the fee structure is a little bit different. You have a little bit more flexibility with a direct listing. You don't have that lockup expiration period, and it's a little bit more employee focused, at least for the companies that are going public.
But even too, within that building, the NASDAQ building, they do a good job showcasing the companies in Times Square, but I think they've invested a lot in modernizing that building. I think it's really helped.
Well, look, I mean, you could say the same, I think, for both locations, right? I mean, the NYSE obviously has the iconic trading floor, but, they're both competing in this space.
Battle on. Scott Gamm, thanks so much. Tech exercise company Peloton may be way overhyped. That's according to Citron Research, which is out with a new report that says it expects Peloton stock to plunge nearly 85% to just $5 a share. Alexis, tough note for me to take because I have a Peloton bike.
I know.
And I don't think there was a lot of actual research in this report. It really looked like market commentary.
Well, the analyst, I think it's Andrew Left, over at Citron, says that Peloton is a one-trick pony, and he likens it to GoPro. Yeah. He likens it to Fitbit. Because when you think about it, what is unique to Peloton that a Nordic Track can't bring to the market at a much lower price point? I mean, is there proprietary information or software that Peloton's using here that means it should have the valuation that it has? So maybe he has a point.
There are some competitors. I went to Best Buy. You can see those connected fitness products starting to come into the Best Buy field. But, I go back to his comparison to GoPro. It's not GoPro. Why? Peloton has a large recurring revenue stream. And secondarily, GoPro for years has gone up straight head-to-head with the Apple iPhone. And that's a tough battle to win.
He's actually predicting the stock can go down to $5. He says that the company's current valuation is ludicrous. But I mean, what about the fact that there are these competitors who can offer very, very, very similar experiences for a lot cheaper? I mean, a starting bike price is over $2,000.
Yeah, and those competitors have come to market, and now it's on Peloton's plate to respond. And I think in 2020, that's why you've seen the stock rally so hard. They have to come out with some new
I think they're
products.
going to have to tier the pricing, and there's going to be a much lower price tier, which I'm wondering if that's going to hurt Christmas sales. Are people going to hold off and say, you know what, Peloton's going to be forced to lower prices? I'm waiting till the spring or whenever to do this. And let's not forget, Peloton also dealing with the cringy ad recently.
That ad, yeah.
That just went viral. They seemed a little tone deaf in that ad.
$5 is still tough. That's a big plunge.
I mean, that's a little,
That's
it got him headlines. It
Yeah.
got left some headlines, but something to consider, something to
Yep.
consider. All right. Oil fell from its 12-week high on reports of expanding inventories. We've got Yahoo Finance's Jared Blickery back at the Wi-Fi Interactive Board with our commodities report. Jared, what's the outlook for oil today?
Yeah, we have crude oil down about 0.25%. It's been underwater most of the night here. We can see this is a price action above that, or excuse me, below that key $60 psychological resistance level. If it were to shoot above that, probably get some momentum, but it hasn't been able to do that. Here's a 3-month chart, and we can see a pretty solid uptrend in place, but still haven't been able to breach that $60 mark, which is actually up here, and $59.50 is a recent high, and we can see that earlier in the year, around September, we did kind of spike above that, but that was that Aramco disaster, that drone attack that was subsequently reversed in the price action the next day. So the price action today is going to be driven by reports about the DOE, and we got a 1.4 million barrel build in the API report. We'll have to see if that's confirmed in the DOE report in about 45 minutes.
You know, Jared, interesting on Aramco here. Strong response in its opening first trades, but who would be the sellers here? I think a lot of the wealthy families in Saudi Arabia have been asked to buy stock in here. I don't think they would be. It might not be in their best interest to go out there and sell this stock. Let's just say that.
I think that's an understatement. Lots of reports that Prince MBS and his lackeys have been on the phone saying, you got to buy this. And this is a price action on the Tadawul exchange of Saudi Aramco on day one. So it jumped up, it gapped up 10%, and it stayed there the entire day. I don't see many sellers there. We'll see what happens in the coming days. But let's remember that they raised about $25 billion. They wanted to do $100 billion originally.
All right. Well, at least it's out there now, right?
Thank
We don't
God.
have to keep talking about it. All right, Jared, thanks so much. Former VP and Democratic presidential candidate Joe Biden is out with his tax plan. It is less aggressive than Senator Elizabeth Warren's wealth tax, but is it the right plan for America? And how does it stack up against Biden's other rivals in the race for president? Rick Newman and I break it down in this week's Ballads and Dollars podcast. Check it out wherever you get your podcasts.
I will do just that. Coming up here on The First Trade, Paul McCartney is involved in a major deal with Netflix. Your companies to watch are next.
Now for a look at some of the companies and stocks the Yahoo Finance team is watching for you today. Layoffs are reportedly starting to hit at Viacom CBS. The New York Post says members of the former CBS's finance department are getting the axe less than a week after the companies officially merged. They've also reportedly cut some staffers at Entertainment Tonight. The company has also announced plans to sell CBS's iconic New York headquarters, BlackRock. New York Life Insurance is reportedly looking to buy Cigna's division that sells non-medical insurance products to employers. The deal could be worth as much as $6 billion, according to the Wall Street Journal. MetLife and Sun Life Financial have also reportedly been considering buying the business. A Cigna spokesperson told Yahoo Finance they don't comment on rumors or speculation. And Tesla is making big plans in Germany. The electric car maker said it plans to build 500,000 vehicles a year at its new factory outside of Berlin. That's according to Germany's Bild newspaper. Tesla's CEO, Elon Musk, chose this plant to build Model 3 and Model Y cars and will invest up to $4.4 billion there. Shares of GameStop are under pressure this morning after the video game retailer posted a wider than expected third quarter loss. It also lowered its full year guidance. Now it believes gamers are holding off on major purchases until PlayStation and Xbox release their new consoles next year. GameStop has lost more than half its value this year alone. And because Paul McCartney hasn't done enough in his career, his children's adventure novel will become a Netflix movie. The book, High in the Clouds, is being co-produced and scored by the famous former Beatle. It tells the story of a teenage squirrel who inadvertently becomes enemies with a tyrannical owl. No word on casting or a release date. The unstoppable Paul McCartney. Coming up here on The First Trade, Glassdoor releases its best places to work list. We're going to break it down for you coming up next.
The best places to work list is out by Glassdoor, and there's a lot of surprises on there that you wouldn't expect. Yahoo Finance's Sabeel Marcellus is here with more. Sabeel, there are some shocking companies here in terms of places where they landed on this list.
Yeah, so what surprised me the most is that some of the biggest, boldest names on Silicon Valley were not in the top 10. So here's the list of the top 10 companies that are the best places to work in the country, according to Glassdoor. So number 1, you have HubSpot, which is a cloud computing company, followed by Bain & Company, DocuSign, In-N-Out Burger, Salmons Financial Group to round out.
In-N-Out Burger? Wait a minute.
In-N-Out Burger.
Back it up. In-N-Out Burger. Do they say
right?
why?
At corporate or in the restaurants?
Well, the reason why these companies are ranked as like the top 5
Yeah.
is based off of employee reviews. So employees talking about compensation, the culture, senior management, and benefits. So some of the best companies. And then just to round out the top 10 real quick, just so our viewers know. So you've got Lawrence Livermore National Laboratory, followed by Intuitive Surgical, Ultimate Software, VIP Kid, and Southwest Airlines. Now, Google and Facebook dropped out of the top 10, which is pretty surprising because Facebook was the top best place to work in the country 3 times over the past 10 years. And now it's fallen to number 23. And Google was the best place to work 4 years ago. And now it's dropped.
All these protests.
To number 11.
So much that free lunch. I thought the free lunch was supposed to be really great.
It's got to be more than just free lunch.
gotta be more than
That's
free
the
lunch.
thing. Employees really care about like the senior management issues. And some have like publicly criticized senior management, both at Facebook and Google. So we're seeing that reflected in the rankings.
And Sabeel, Apple, 84th place?
Yes.
Wow.
Yes.
Weird.
Yeah, so Apple usually hovers around top 25, fell to number 84, and Amazon didn't even make the list at all.
Well, that I could see. It's tough working in those warehouses.
Yeah, a lot of criticism about their
How many
internal
companies are on the
workplace
list?
culture. 100.
100. So no Amazon in the top 100.
Nope, didn't make it.
All right, there were some surprises. In-N-Out Burger, we're all going to work
figure.
there. We're all going to go work
Clearly,
there.
they must be getting free food, and they're go out in Glassdoor and they put their reviews on it.
Okay.
I know what I'm getting for lunch.
There you go. Yeah, I'm hungry now. All right, thanks a lot, Sabeel. That's going to do it for the first trade for this Wednesday morning. I'm Alexis Christoforous.
And I'm Brian Sozzi. Now let's get one more check of the markets with Inez Ferrer down at the New York Stock Exchange. Inez?
Brian, Alexis, a big miss for Children's Place. Its revenue came in as a miss. The company's same-store sales were up 0.8%, and the street was expecting an increase of 3.5%. Also, the company cut its full-year guidance and included the adverse effects of tariffs in its EPS guidance as well. We're also watching GameStop this morning, just plunging. This is after another disappointing quarter with their adjusted loss coming in at 49 cents a share. That's wider than what the street had been expecting. Comparable store sales also were a miss. The company cut its full-year profit guidance, and the company's CEO, George Sherman, said that the results were impacted by an unprecedented decline in new hardware. Remember that next year is when new consoles will be unveiled. And we're also watching JetBlue. This is after JetBlue gave fourth quarter guidance regarding its revenue per available seat mile, predicting a decline in the range of anywhere between 3.5% and 1.5% because of softer than expected yield in late November, and also because of the adverse effects of weather conditions during the Thanksgiving holiday. Right now, we're looking at the Dow that's up 3 points flat. The S&P is up 7 points. Make sure to stay with us because Wi-Fi AM starts right after the break. The Fed meeting ends today. They'll be discussing that and much more. Don't go anywhere. We'll be right back.
Good morning and welcome to Wi-Fi AM here at Yahoo Finance on this Wednesday morning. I'm Dan Roberts. We've got Heidi Chung and Kristen Myers here on the couches for the whole show. Let's do the show. Let's see where the markets are right now. All three major indices are in the green. The Dow just barely. It's about 16 points. NASDAQ up 27 points. S&P in the green as well. Not too much movement yet, but we have to start the day with the world's largest ever IPO. It happened. It's the Saudi Arabian oil company, better known as Saudi Aramco. The stock debuted today on the Saudi Tadawul exchange and quickly surged 10%. There it is, up an even 10% right now. And with a market cap of $1.88 trillion, it is now the world's most valuable company by market cap. Look at that, more than Apple and Microsoft. And of course, the only other tech company that recently joined that $1 trillion market cap club was Amazon. But Jared Blickery is joining us now to talk Aramco. So Jared, how did it go? Because as valuable as it is, it still wasn't as big as the prince wanted.
No, he wanted $2 trillion from the get-go with the 10% pop, which is the exchange limit. So that's as far as it could have gone on day one. It did rise to 1.88 from 1.7. Who knows? If it rises another 10% tomorrow, it might be $2 trillion. But I'm thinking it's really a hollow victory for a couple of reasons, because they only raised about $25 billion in change. That's a lot of money. It's the most ever. Beats Alibaba. Yeah.
Only $25 billion.
Only. They wanted to raise $100 billion. They're going to need a lot more money to fund their enterprises. They want to build a $500 billion city, futuristic city in the desert. They're going to have to raise more capital. They want to list eventually on another exchange. They're thinking about Tokyo now because the U.S. and London are probably out. But it's hard to imagine them doing that.
But Jared, didn't they scrap the roadshow because they didn't see enough foreign demand?
Yes.
So I guess, is that even a viable option at this point in the future?
It depends on the valuation. I don't think people are really trusting these market prices just yet. It's a very small exchange. The prince was making personal calls to people to say invest. So you can imagine nobody's selling on day one.
Right.
We'll have to see, where the price of oil goes. That's going to be a big determining factor here. And of course, Saudi Arabia is a leader of OPEC Plus, so they control that to a certain extent. But if they cut production anymore to get oil prices up, well, they don't get as much money. Saudi Aramco doesn't make as much money. So there's lots there. And yeah, they did have to cancel their roadshow because there was no international demand for this product. Just about all the buyers came in locally. So neighboring countries, and also a lot of Saudi Arabian, a lot of wealthy citizens who were imprisoned by the prince himself 2 years ago in the palace coup.
So to that point, you're not imagining any of those Saudi investors selling anytime soon. So how long exactly can this price keep rising if that interest isn't actually real?
Yeah, I think it's going to depend on the price of oil. So if the price of oil crashes next year, as a lot of forecasters are saying, because there's going to be so much increase in supply and it's not met with demand, well, you're going to see the price of Aramco go down. If there's some kind of shock, if growth picks up and the price of oil rises, we could very well see this at $2.5 trillion. It depends.
Well, Jared, we have it here, so we have to ask about, of course, crude oil. We're flirting with that $60 a barrel level, but we still haven't broken above it. What do you think is going to happen in 2020? Are we going to see it finally go over $60 a barrel? Are we going to stay in this range? What are your thoughts?
Well, I mean, look at what happened recently. How did it get to $60 a barrel? That was mainly because of the rumors early last week, that Saudi Arabia and OPEC Plus were going to cut production even more. They eventually did that. That's entirely within their control. So there were no exogenous demand or supply factors going on there. All else being equal, I think the pop is done. Now, if there's some kind of other attack, if there's a geopolitical event, if we sign the trade deal, though, that could be another growth catalyst. So we can see the price pop on that. But I'm not real bullish on the price of oil here until it closes definitively above that 60 level and holds for a while.
And you mentioned OPEC's role in all this. OPEC, as you've explained to us, has sort of lost a lot of its influence anyway.
Yeah, and they became increasingly irrelevant because they make up a smaller share of the global market supply. You look at the U.S. as the biggest producer now, hasn't been that hasn't been the case since the early 70s. So a lot has changed, and we have a lot more supply coming online next year from Norway, from Brazil, from Russia. Unless demand picks up substantially, we're probably going to see oil with a 50 handle, maybe even the high 40s next year towards the end of the year.
There's a whole ocean of oil underneath our feet.
Literally.
No one can get at it except for me. Jared's our Daniel Plainview. All right, Jared, thanks so much. Good stuff. The Federal Reserve is wrapping up its last meeting of 2019 this morning with a big announcement due in just a few hours. Will Jay Powell and the Fed look to cut interest rates again, as President Trump has demanded in tweets, or will the Fed hold firm, especially with many positive indicators for the economy? So maybe a cut isn't needed. Our Fed correspondent Brian Chung is in D.C. right now and can give us a preview.
Yeah, well, no cut really on the table for right now. For that matter, no hike as well. So the current expectations based on market pricing are a 98% chance, so almost a foregone conclusion that the Federal Reserve will hold rates steady at the current range of 1.5 to 1.75%. So, okay, if they're not going to move on rates, then why do we care? Why is this going to be an exciting meeting regardless? Well, two things that are worth watching. First of all is the dot plot projections for those that are not aware. This is a roadmap of where policymakers could see interest rates going in the next 3 years. So what you're seeing on the screen right now is the Fed dot plot that we received in the last meeting in September. Keep in mind, we don't receive these every single meeting. We receive them every other meeting, so we did not get one in the Fed's meeting in October. We'll get a fresh round today at 2 p.m. And the Fed dot plot might tell us and give us some clues about where interest rates will go next year. Maybe a hike, maybe a cut. The only problem is that these Fed dot plots have a pretty bad track record of actually telling us where interest rates will go when you consider that in December 2018, 1 year ago, the Fed was actually messaging that interest rates could go up to 2.75 to 3% by the end of 2019. What we saw is that's not the case at all. We had 3 insurance cuts this year. The second thing worth watching is any sort of commentary from Chairman Powell at the press conference at 2:30 over the Fed balance sheet. This has been a fairly contentious issue ever since the Fed abruptly ended its balance sheet roll-off program earlier this year. Some expectations that maybe there could be another repo market flare-up at the end of this year. Keep in mind that in September, we already saw that when interest rates spiked up to 10% on overnight lending. So something worth watching there as well. But as far as the actual interest rate policy, Dan, seems like nothing exciting in this meeting today.
Hey, Brian, we're really looking forward to your question, of course, later today. But I also wanted to get your thoughts on what we can expect when the committee releases its economic projections. Can you give us some insight on that?
Yeah, absolutely. So the dot plot is one part of those economic projections. But as you note, Heidi, that's not the only part of those economic projections. We also do get a roadmap for where policymakers could see GDP growth, for example, unemployment. Another thing that's worth watching is what they call NAIRU. This is very in the weeds, but it's the non-accelerating inflation rate of unemployment. And to translate that, that's basically what is the proper level of unemployment in the economy at which we don't see inflation rising up. This is related to what they call the Phillips curve, which is the interaction between inflation and unemployment. My colleague Maz Adlan released a morning brief this morning talking about how the Federal Reserve has continually lowered that estimate. So worth watching to see if the Federal Reserve will continue to lower the point at which they see a comfortable level of unemployment without any sort of expectations for prices running away from them. So that worth watching in the dot plot projections today.
Brian, you mentioned that during Jay Powell's press conference, he's likely going to talk about the balance sheet, but typically these days he's been really sticking to the script. Are you expecting that this time around as well, or are there any other things you're going to be paying close attention to?
Yeah, well, Chairman Powell has basically said that the balance sheet process, when keep in mind, they have actually resumed some of their asset purchases. They've been buying short-term Treasury bills at a pace of about $60 billion per month. And the Fed balance sheet is now over $4 trillion. Keep in mind, this is for a balance sheet that the Federal Reserve wanted to make smaller at the beginning of this year. But Chairman Powell is going to say the same thing that he said in the past, saying this is not quantitative easing. This is us trying to make sure that we don't see another flare-up in the repo markets because we want to control where interest rates are going, right? If the interest rates are going up to 10%, that means the Federal Reserve doesn't have benchmark interest rates within its actual target range, which is way lower than that right now, 1.5 to 1.75%. So Chairman Powell is going to say this is not the same thing as the large-scale asset purchases that we made post-financial crisis. This is a completely different animal. But as Jared Blickery has pointed out as well, there's some concern that maybe the Federal Reserve will have to actually go with another round of quantitative easing if it can't contain those repo markets. But that's purely speculative, and Chairman Powell probably won't have any sort of hints that that would be the case, at least for the time being.
Brian, just quickly to wrap up, is it weird? Is it a different kind of feeling since you've gone to all these meetings in the last couple of years? This one, the sort of lack of anticipation. As you said, we think we know what's going to happen, and boy, it feels like there's less riding on this final Fed meeting of the year.
Yeah. Well, it's because, look, and this is all relative, right? But for a Fed reporter, it's been such an exciting year in Fed policy. The Fed made a remarkable pivot from the beginning of this year when it was messaging interest rate hikes to actually cutting 3 times this year. And now that they're on pause, yes, you're right, Dan, it seems like maybe it's not that exciting. But again, the trajectory of Fed policy going forward, no one really knows. Is the next step going to be a hike or a cut? Will that next step even happen in the next 6 to 12 months? We're not really sure. So I think, yes, you're right, Dan. It's not necessarily the headline that's going to be that exciting in this meeting, but Chairman Powell could provide some interesting clues forward-looking that markets and investors might be worth dialing into.
All right, Brian Cheung, thanks so much for joining us. And viewers, we will have complete coverage of the Fed decision and Jay Powell's news conference starting at 2 p.m. Eastern right here on yahoofinance.com. You'll see Brian Cheung again. And coming up here on Wi-Fi AM, Deloitte looks into its crystal ball for the streaming wars in 2020. Welcome back to Wi-Fi AM at Yahoo Finance. Markets right now are in the green. Let's get some more insight on what certain stocks are doing. Let's check in with our friend Inez Ferre live on the floor of the NYSE. Hi, Inez.
Hi, Dan. Let's talk about GameStop. Another disappointing quarter for GameStop, and you can see that it's being reflected on the stock price this morning. Under pressure. This is after GameStop's adjusted quarterly loss came in at 49 cents a share. That was a miss. Same-store sales also came in as a miss. Revenue was down 26% from the same quarter last year. And this is all because of, we've spoken about this before, a decline in the demand for pre-owned games, and also GameStop CEO George Sherman during the conference call spoke about the unprecedented decline in new hardware sales. Remember that you've got the new consoles which are going to be unveiled in late 2020. So that, he says, has a lot to do with the performance at GameStop. But nonetheless, one Wall Street analyst describing these results as just awful.
All right, thank you, Inez, and we'll check back in with you very soon.
See you soon.
Well, House Democrats say they have settled on a new trade deal with Mexico and Canada. That is the new NAFTA, as some are calling it. It's the USMCA, and that will set the stage for approval of the deal by Congress in 2020. House Speaker Nancy Pelosi approved the deal an hour after presenting articles of impeachment against the president. So a lot going on. And Rick Newman joins us now to discuss. So, Rick, what can we expect next? Is this a done deal? Is it all set? It still needs approval. Might it not happen?
Oh, there's still some trifling issues, but it looks like the House is going to approve it this year before they leave on, I think, December 20th. Then it goes to the Senate, so the Senate has to ratify the same deal. And the sort of behind-the-scenes political, there's a little bit of political backlash here because there are some, believe it or not, some Democrats are unhappy that Nancy Pelosi gave President Trump a victory on trade. But there are also some Republicans who feel like the Democrats got too many concessions that favor labor and that this didn't go quite exactly the way Republicans wanted it to go. So that suggests it could be a little bit bumpy getting through the Senate, but there's no way I think that the Senate would actually fail to ratify what is basically President Trump's signature trade deal at this point. I mean, remember, Republicans do control the Senate, and they want to give Trump that victory.
So, Rick, how is the USMCA different from NAFTA? Where are the changes being made?
It's hard to find them. They're subtle. But there are some more aggressive rules for domestic content within the North American trade zone. That's all three countries, U.S., Canada, and Mexico, with regard to automobiles. So more components need to be sourced within that trade zone to be duty-free, which supporters say may bring some additional manufacturing jobs to the United States. I'm not entirely sure about that. Oxford Economics, a good forecasting firm, published an analysis yesterday. Said the macroeconomic effects of the trade deal will be negligible. That was their word, negligible. That doesn't mean it's a bust. It just means they're not expecting it to actually add much that you would notice to GDP growth. But it is much better than the other thing Trump threatened to do, which is completely withdraw from NAFTA, the old trade deal, so that we'd have no trade deal and we'd have tariffs between the three countries. So compared to that, the USMCA is much better.
Rick, I guess I'm a little confused. When we're talking about the Mexican president and Donald Trump, they seem like best friends at this point, right? Mm-hmm. No mention of immigration came up at all. So are they just going to ditch that and not discuss it anymore? Are they just...
I think that's entirely up to
partners?
Trump. That's entirely up to Trump. I mean, it's not something the Mexicans ever wanted to discuss. And it's, for President Trump, I think it's, when he first got into office, he campaigned so hard on immigration that he had to do something. And we saw how aggressively he went after building the wall, different policies towards people trying to get into the country through the southwest border. That has calmed down a little bit. And I think the data that I've seen actually says fewer people are actually trying to cross, probably because I know it's harder, and the numbers are down. So Trump seems to have backed off of that for a while. I can see him starting to talk about that again as he really starts a campaign into the first, probably really the second half of 2020. He thinks that's a big issue for his base, so he's going to be hitting that again. But we haven't heard much about it, but I think it's coming back.
Well, and he can also tout having gotten USMCA done.
I was wondering how much political capital this would give the president in an election year.
A little. I think it'll give him a little. I mean, this trade is complicated, and I'm just not sure how much voters pay attention to the details of a trade deal. And of course, his critics are going to be saying, yeah, but on the bigger issue, China, where is he? He's got nothing to show for it yet. So maybe he'll have something by 6 months from now. Who knows?
All right, trade man Rick, thanks so much for joining us. He's a trade man. Okay.
Never knew it.
Well, the streaming wars will only get more hot in 2020. We all know that. And Deloitte's new Media and Telecom report predicts that as consumers get more frustrated with paying for so many of these things, some of these streaming platforms that have resisted ads will be forced to adopt multi-tier models that do have ads. And joining us now to discuss the report is Deloitte's Kevin Westcott in LA. Kevin, thanks for coming back on the show.
Good morning.
So it's very hard for us, we discuss Netflix so much, it's very hard for us to see Netflix anytime soon adopting ads in any way, shape, or form. I feel like that would really water down the brand. You guys see things differently.
We look at the entire set of platforms out there and understand there's going to be lots of competition for consumers' attention, especially next year with the launches of a number of major platforms. So what I'm expecting to see is more and more platforms actually considering ads. I'm not saying that some of the existing ones will shift, but we may start to see multi-tiered models where some content's available for free under an ad-supported model. And if you want the super premium or exclusive content, you may have to pay a subscription. So I expect to see a bifurcation of the platforms.
Yeah, and Kevin, what's been interesting is as we discuss so many of these new platforms and the proliferation of so many different options, I do think people wonder, are we soon going to hit the point where everyone starts cutting? And yet, what we keep hearing from analysts is that we're not there yet, that people are still willing to add more, add more, add more. When do you think we'll hit that peak streaming moment where everyone starts to review their platter of OTT subscriptions and they say, okay, now I'm paying for too many, time to cut a few?
Well, over the last couple of years, our research has actually said people are holding around 3 to 4 subscriptions in a household, but the heavy users have up to 11. So there is room, there's headroom for people to continue to add. What I expect to see is as people start doing, I've heard the term spring cleaning, looking at your credit card bill and trying to understand all the subscriptions you're using and deciding which ones you're not. I think that's one thing that we'll start to see happening. The other one is when you find yourself watching 1 or 2 of the platforms almost exclusively and not using the others. I expect the winners really to be those who bring together more than just video. I expect to see them bring together video, music, games, and maybe even esports, which is an emerging trend we're watching. So that if I have more content available on the larger platforms, maybe I end up going towards those platforms and I start to abandon some of the more niche players.
So, Kevin, to that end, obviously with cable, you had bundling, right, of channels. Do you think we're going to start seeing a point where bundling, not just of different content options, but different streaming options as well?
So I'm not using the word bundling for a very distinct reason. It's got a little bit of a bad name, but I'm talking about reaggregation. So bringing together multiple types of content under the same umbrella. So I think consumers would be very happy with having a subscription where I have premium movies, I have premium, television shows, I have games, I have music, I have all my entertainment under a single one. But it's my choice. I'm not being forced to subscribe to 500 channels. I'm making the choice of what do I want to subscribe to, and then being billed based on what I'm consuming. So I think it's a little bit different of a model, but I think it gives consumers significantly more choice.
Kevin, let's talk a little bit about 5G. So everyone is extremely bullish on this idea that it's coming very, very soon. How do you think telecom media companies are starting to think about this, and what kind of strategies do you think they're starting to implement?
Well, the really exciting thing about 5G is it's in the news. We're talking about it. Consumers know about it. Consumers are actually saying they're excited about it. Consumers primarily think it's about faster download speeds and better network connections, and that's all true. I think the real exciting part is what are we going to see with this new innovation? We're going to see brand new applications. We're going to see we'll start seeing AR really being integrated into entertainment. So the really exciting point is once we get this technology in the hands of innovators, what will we see? If you think back a few years ago, none of us probably expected to be living in the centric world we are today. Well, 5G is going to bring a whole new series of those types of apps. And it won't be just to your phone. It'll be to wearables. Maybe it's to some form of glass that you're wearing that gives you the augmented reality. So that's what we're really looking forward to. And it's going to change the way that we actually consume media as well as just work and live.
Kevin, just quickly as we wrap here, I want to return to something you were just saying because it's interesting to me that you think some of the big kitchen sink ones, if they offer enough, will actually crowd out the niche players. I mean, just recently on one of our live shows, we had someone who will be running a new streaming service that is niche. And it comes from The Intercept, that news site, and it's going to have kind of documentaries and news content. And his argument was, yes, we're very small and niche, but that's why we will succeed. We don't need to compete at scale. We don't need to compete with Netflix and Disney Plus. We can make money with just a smaller niche group of subscribers. Is he wrong?
Well, there's always going to be certain sets of subscribers that are looking for very specific content. The question is, can they amass the million or a few million subscribers they really need to be profitable? So, I mean, we've always had that. You think to even the world of 500 cable channels. Some of those channels had very, very devout followers, and though they may only had a few million viewers. So there always is interest in that. My view is that for the mass audiences, we're looking at the larger players who will bring together lots of this and make it all available. So I almost see a world where the largest players will have a catalog of a lot of the smaller streaming platforms available, and you can subscribe directly through them. And that's really the reaggregation I was talking about.
Right, a subscription to subscriptions. All right, Kevin Westcott of Deloitte, thanks so much for joining us. Good stuff.
Thank you.
Coming up here on Wi-Fi AM, we will tell you what stocks are trending right now on YahooFinance.com. And one analyst says that Peloton stock is spinning out of control.
Time for today's trending tickers. First up is Children's Place. The stock getting pummeled, tanking more than 20% this morning after the children's apparel maker reported third quarter sales that missed Wall Street estimates and slashed its guidance. The company citing weak quarter-to-date mall traffic for the bleak outlook. Children's Place now expects full-year retail comp sales to decline 3%. It previously forecasted flat comp sales. Not good times for Children's Place, guys. I will mention, though, that none of us have children, right? But we have spoken to folks out there who have children, namely our senior producer, Tracy. She was telling me about what a miserable shopping experience it is whenever she visits a Children's Place. Not just one store, but several of the stores that she's been to. She has young children. And she says the quality is also not that great. And honestly, that's sort of the theme and the trend that I've been hearing from pretty much anyone who's buying children's clothes these days.
So one, people don't want to visit malls, so that's just something that they're going to have to contend with. And then two, when you have the ability to go to, and we were discussing this when we do buy gifts for small children, for our friends who have small children, we go elsewhere. We might go somewhere like TJ Maxx or Marshalls, or I even will just go straight online. I'm not schlepping all the way to a mall to say I'm going to have to sort through. I've seen Children's Place and it looks terrible in there.
Oh. Yeah, as someone with two small nieces who often buys them gifts, I certainly am not going to a Children's Place or Babies R Us or any of that stuff. I don't seek out the store. I find that when you buy the gifts, it tends to be more spontaneous discovery. Like you see cute items in a larger store that has lots of different things. Or you're right, if I specifically know what I want to seek out. So, assuming they're not watching, we went to the Disney merch website to purchase some Frozen 2
Way
items.
to spoil your niece's holiday gifts now.
That's another way that we searched for gifts. Was we were very specific. We knew we wanted Frozen 2 stuff. We went to the source. No reason to go to a Children's Place.
So I don't know if you guys are frequent visitors to a Target or Walmart, but when you're there, do you ever find yourself browsing through all the aisles? I mean, the way that a Target store is sort of formatted is you walk through the entire children's area.
It's our company of the year for a reason.
Right, and so I feel like the way that Target is organized, or even a Walmart, I feel like it makes it easy for people who are just going to either do grocery shopping or just buy general household products to sort of just browse the children's section and see if there's anything good there and just buy something as well.
But if you know, that's great for like us, you know, that have that luxury of like going and browsing and like looking at children's clothes. But if you are a parent, right, and you specifically need to go and purchase clothes for your children, it's just like, why would you want to waste the time if you have such a terrible shopping experience every time you're going to a children's place? You're just going to go somewhere else where you can find the clothes that you want easily, and you know that the clothing is going to last for a long time. As we know, children play, that stuff has to be durable.
Okay, guys, another ticker we are looking at today is Peloton. More pain for the fitness company after infamous short seller Andrew Left slapped a $5 price target on the stock yesterday. In Left's note, he compares Peloton to GoPro and Fitbit. Left starting out the note saying that there are, quote, clear flaws in Peloton business model and a management team that has been overly promotional while trying to justify an unrealistic valuation that is disconnected from all reality in a post-WeWork economy. Now, those are some scathing
but
shots
now,
fired.
Peloton being overly promotional, it's interesting. I mean, there's been one price cut on the bikes just recently, but it's still a pretty expensive
I
item.
think what he's saying here, though, is that they're being overly promotional in that they're trying to rally sort of cult-ish members, kind of like exactly like other fitness companies that we've seen. SoulCycle.
Promotional, I think he means discounting, but.
Oh, okay. Well,
like
I
when
mean,
Under Armour has been very overly promotional over the last few years, and it has killed them. But yeah, I mean, you do not want to be compared to GoPro and Fitbit. Ooh. No. Now, of course, GoPro recently was one of our trending tickers on the show here because it had bounced back
a
thanks
huge
to
win.
holiday sales.
Right.
But man, that took a long time. That took people finally maybe a new cycle of upgrading their camera.
I mean, but this is. I don't know.
I don't know if I necessarily agree. I'm not going to comment on the price target, right? $5, obviously a huge discount, but I don't necessarily disagree totally with the argument that he is making. If you do want a spin bike, you can get one for cheaper. I mean, Peloton is incredibly expensive.
Peloton.
Right, but then even the subscription service, there are other companies that will offer the same thing. So it's like,
I don't know. I think we should also take what Andrew Left says with a grain of salt here, because do you remember exactly almost a year ago he had that call on Twitter He said that Twitter was the Harvey Weinstein of social media. He said it was terrible for women. He said that the stock was going to fall 30% from the level that it was trading at the time, which was $30 per share. The stock has held up relatively well, so I don't know if he covered his short position at any point in the past year, but that was not a very good call to begin with. So.
Again, $5 might be a little bit aggressive. He might be too bearish, but I don't think
that still gives it a valuation of $1 billion to $2 billion. So.
When I think of Peloton versus other cheaper exercise bikes, I think of the scene in American Gangster, the Denzel Washington movie, where someone is talking about his brand of drugs, and it's called Blue Magic. And he's saying, I'm not going to sell it cheaper because Blue Magic, that's a brand name. It's like McDonald's, that's a brand name. Peloton has the brand, the sexy, hot, expensive brand. But it's just an exercise bike. You can get a cheaper one.
And we talk about it a lot here in New York. I'm sure they do in LA. But the rest of the country, I don't think is as excited about Peloton as we think that people are on the coast.
Okay. Coming up here on Wi-Fi AM, we will talk to Time about the magazine's Person of the Year and Business Person of the Year. Welcome back to Wi-Fi AM at Yahoo Finance. Time has named its 2019 Person of the Year. It's Greta Thunberg. There she is on the cover, the Swedish teen climate change activist. At 16, she is the youngest Time Person of the Year in Time's history. And here to discuss the choice is senior editor Haley Edwards. Hi, Haley. Thanks for coming on.
Thanks for having me.
So tell us about the choice here, because I know Time always releases like the finalists, and you saw a lot of chatter over the last few days, people saying it should be the Hong Kong protesters, or it should be this person, or of course many people joking it should be Baby Yoda. That wasn't going to happen. But tell us about choosing Greta Thunberg.
Well, inside the office, it's always this big discussion. It starts in early fall, late summer, where we have this giant meeting and everyone presents who they think it should be. And there are probably 30, 40 people on that list. Actually, I think Baby Yoda maybe made the list sort of briefly. And
wow, we're breaking news here.
Yeah. But yeah, I mean, everyone you can think of and all these different genres. And then there's a discussion, an internal discussion inside the magazine. And they actually launch different teams of reporters on a bunch of the different topics that they think are going to be front runners. And a lot of people in the newsroom don't even know what the choice is going to be until the very end. So, yeah.
So what's the criteria to make Person of the Year? Because Time has chosen some pretty controversial figures in the past, like Adolf Hitler. Trump was Person of the Year in 2016. So what does it take to make it?
So it is the person who is most influential on the world that year. And it kind of is born of a great man theory that it's one individual person who can shape the world. And that is, sometimes that's good, sometimes that's bad. We have had, as you mentioned, Hitler, Putin, world leaders who you would not want to honor necessarily. It's, you're just really looking at influence. And with Greta, she's 16 years old. She just, by sheer force of will, she walked out there, skipped school, sat down, and 14 months later, there are 7 million people out climate striking, which is,
And did this feel like a political choice at all? I mean, there are those out there who on Twitter and social media get angry about Greta Thunberg, obviously. I mean, everyone gets angry about everything, but they may not like the choice. Did this feel like a more or less controversial one than some of the others you considered?
It felt, one thing about climate change is it shouldn't be controversial. It shouldn't be political. it's like, climate change is happening. The science is very, very obvious. It's happening. So what do we do about it? It shouldn't be something that is like, if you're conservative, you disagree with this. And so I think that's kind of the way we went forward, that the science is very present, and how do we talk about it?
So Time also named Business Person of the Year. Disney CEO Bob Iger was chosen. So tell us a little bit about that choice and some of the other candidates that were on the list, actually.
Right, yeah. So Bob Iger, he's just sort of the top of this incredible organization and an incredible year. The first day that Disney Plus launched, it got 10 million subscribers. Disney's going to be the first studio that releases 5 movies in 1 year that each hit top a billion. That's it. Yep. And Iger himself is had a New York Times bestseller this year. I mean, he's sort of at the top of his game.
Who else were some of the contenders against Iger?
It's always just like such a debate inside the newsroom that I can't remember specifics, but it was when you look at the business landscape right now, one of the things that we wanted to get to was this is a time when big tech, big business, they're all kind of under attack from different perspectives. And
well, it wasn't going to be Mark Zuckerberg.
It wasn't going to be Zuckerberg, and we were probably not going to choose Bezos or something because he's obviously been on our cover before.
I love how you guys included Baby Yoda though in the photo.
It was a little bit weird.
No, that's the new CFO of Disney. Is Baby Yoda.
I thought the picture was a little
right. Yeah. And I want to make sure we fit this in. You guys also do a Entertainer of the Year.
Lizzo.
I totally agree with that choice. I love her.
She's incredible.
She's so incredibly influential.
She's had a big year.
She has had a huge year.
And we had an Athlete of the Year, U.S. girls soccer
look
team.
At that. Okay. Our former sister publication, SI, going a similar route. Megan Rapinoe, the SI Athlete of the Year, Sports Person of the Year.
Incredible athletes. And then our Guardian of the Year was the public servants who testified before Congress this year during the impeachment proceeding.
Wow.
So, I know you said that these choices aren't meant to be political, but actually, you can include Iger in this list, but Lizzo aside, honestly, it seems like all of these people or groups of people have in some way been involved in a political conversation.
Well, the public servants.
Well, of course, the public servants, but even the U.S. women's soccer team with gender pay disparities. Bob Iger, I think, even mentioned
in his book.
Exactly.
He said, yep, I considered running for president.
Exactly. So, how much does politics actually really work its way into these discussions?
I think we live in such political times. Like, how do you do anything that doesn't grocery shopping feels political now? Like you guys were just talking about going Christmas shopping for kids. That feels political in this weird way. There's nothing you can do now that doesn't feel like it's playing into this conversation. I mean, we're living in historical times. We are living through the impeachment proceeding of a president. Like, all of these things are huge. You can't really sidestep that.
Most of the people on that list notably have drawn the ire of the president. I feel like
Iger and ire, themes of the day. All right, Haley, thanks so much for joining us.
Thanks so much for having me.
Appreciate it. Coming up here on Wi-Fi AM, we'll have our colleague Ethan Wolfman live from an energy conference.
Welcome back. I'm Ines Ferre here with John Corpina. John, we're looking at a mixed picture right now. The Dow is really being dragged down by Boeing. The Fed meeting today concludes today. No rate cut is expected. What will you be looking for in the comments?
I don't think we're going to be really looking for much, right? I mean, they've kind of painted themselves into a corner where they have to proceed in the way that we're all expecting. The cookie cutter blueprint speech that we're going to get. They're going to say that they remain data dependent. They're going to continue to talk about uncertain geopolitical, economic conditions that are out there. Clearly, U.S.-China relations have an effect on how they're going to play out their role in 2020. So at this point right now, I think it's just kind of a done deal that things will stay status quo for now. The market has that priced in already. No one's really expecting any surprises.
Are we in a wait and see with these December 15th tariffs?
Yeah, it kind of keeps bouncing back and forth, and every day we get different headlines. I think right now we're pricing in that something will be delayed, and this is going to get kicked down the road. But we are clearly in wait and see mode because this is so fluid. It keeps changing. One day we think we're close to phase one. The next day the meetings are off. We continue to watch the headlines and the tweets that move the market. So I don't think anyone's really weighing too heavily on it at this point, but clearly it's something we have to focus on.
But are traders feeling like that President Trump will somehow delay these tariffs, that these tariffs are critical to the phase one, correct? The Chinese really want a rollback of tariffs. So are these expected to even go through?
It's not expected to go through at this point. I think a delay is what's being priced in. So anything other than that will have an effect on the market. But I think, unfortunately, we're almost midway through December, and everyone's already closing their books and looking forward to, what's going to happen in the first few weeks of 2020.
And just as we're looking at the Dow, that's down just 20 points, but it would be in the green if Boeing were up. This is after the FAA chief said that the recertification process will extend into 2020. That doesn't seem to be, though, too much of a surprise.
No, I mean, stock's only down 2%, so not that big of a deal from that point of view. Yes, it's weighing on the Dow. But yeah, from Boeing's point of view and from the headline point of view, they're not going to rush back into this. There's way too much weighing on it to really get to move forward quickly on this. So at this point right now, I think that headline, as impactful it is on the stock right now, really wasn't something that's weighing too heavily overall in the markets.
Thanks so much, John Corpina, and make sure to stay with us because Wi-Fi AM continues right after the break.
Welcome back to Wi-Fi AM at Yahoo Finance. Our colleague, Ethan Wolfman, is at the S&P Platts Global Energy Outlook Forum right now, and he's with Marathon Capital CEO Ted Brandt getting an overview of the energy markets. Ethan?
Hey, so here with Ted Brandt, and I'd like to first kind of get into some of the big energy trends for 2020. What do you see happening next year and kind of the major narratives that are going to shape the year to come?
I think it's an interesting time, but I always start thinking about commodity prices. I think we will continue seeing a switch from away from coal, and probably nukes as base load power will not grow, and what will grow is natural gas and renewables. That's certainly the I'd sort of premise number one. Premise number two is natural gas is going to stay cheap, and what that will mean is that, regardless of the politics, regardless of the environmental regulations, coal is losing on economics and natural gas is winning.
And so when that comes to when it comes to renewables, what is the role of kind of renewables in all of this with gas so cheap? What is the demand going to look like into 2020 in the forecast? Because that seems like, if gas is leading the charge, that might suppress renewable demand. Is that kind of what we're seeing?
Well, actually, we're seeing gas replace baseload and renewables coming in at the margins. Solar obviously, shines during the, sun shines during the day. Wind tends to blow during the winter and during the night. And what we're watching is natural gas essentially being there because it's dispatchable, and you can run a natural gas plant profitably by turning it on and turning it off based upon how much renewables is on the margin. So what we're watching is the zero marginal cost renewables are running, and natural gas is kind of picking up the slack. And the guys at the short end of the stick are the baseload coal, because they've got so many employees, because of the fuel costs, their break-even points are just way above where natural gas can be profitable, and where renewables, as a zero marginal cost basis, can also be profitable.
So obviously one of the things that's driving all of this renewables play is technology. In every sort of market, in the solar market, in the wind market, and in storage markets in particular, those little technological advances are so key. What are we seeing in terms of technology kind of coming into play in 2020 and having an effect on the market?
Well, I would say in terms of renewables, we continue to see onshore wind making incredible strides in terms of technology, blade length, tower height, et cetera. I've been in this business for 20 years, and 20 years ago, net capacity factors, which is sort of the most important number for onshore wind, how much compared to capacity will the wind blow, were 20%. Those same wind resources are now yielding 40%, or literally twice as much energy out of the same resource. Mm-hmm. The same thing's happening with solar, and while it's perverted a little bit by the tariffs and various different things that are affecting the industry, these bifacial panels, productivity continues to come up, costs continue to come down, and EPC costs continue coming down. So we're just seeing incredible leaps and strides in terms of productivity and the ability to pull more energy, useful energy, out of wind and solar.
In terms of the regulatory environment, we saw a lot of governmental aid in terms of subsidy for a lot of these renewable projects and with financing. Some of that maybe seems like it's shifting away from that. Is that true? And what does that mean for you guys, providing kind of innovative financial solutions to make some of these projects possible?
I would start by saying that the federal regulatory environment is very confusing, and I won't, in the short time we have here, say anything more other than I believe that for the most part, the subsidies through the PTC and the ITC have done their job. Right now, wind is facing a phase out over the next couple of years, going down to zero. Solar is facing a phase out over the next 4 or 5 years, going down to 10%. There'll probably be some right sizing between those two technologies, but I would make an argument that the ITC has been incredibly effective. The PTC is sort of, beyond the unintended consequences of a 30-year-old tax policy, where a PTC is the most profitable part of a wind farm. But there are major constituents across onshore wind, offshore wind, and solar that are trying, very hard to continue having tax subsidies, through the United States tax code.
Right. And so if we think about, renewables and going forward in the future, storage is a huge part of this. Just a brief word on what we expect kind of 2020 with anything new with storage.
Storage on a standalone basis or in connection with either solar or wind is now a fact of life. I would say most of the things that we are selling or that we are involved in have a storage component. Most of the RFPs require a storage component as part of the deal. So storage is becoming more and more mainstream, less and less weird. I would say that with a few jurisdictions exceptions, the revenue model still is a bit confusing, and it's tough to make standalone storage work in many, many markets, but there are some FIT programs and some other programs where capacity payments are being paid, and so we are seeing that creeping into the business.
Thanks. I'll have to leave it there. Dan, back to you.
All right, thank you, Ethan. And coming up here on Wi-Fi AM, we will talk about the college football semifinals. Welcome back to Wi-Fi AM. Well, this season's college football playoff is now set. The 4 teams are LSU, Ohio State, Clemson, and Oklahoma. Their 4 conferences will each get a $6 million payout for making it to the playoff. The 2 semi-games will be on December 28th. That's LSU and Oklahoma, the 1 and 4 seed, playing in the Chick-fil-A Peach Bowl. And joining us now is Peach Bowl CEO Gary Stokan. So, Gary, thanks for coming back on the show.
Thanks, Daniel. Appreciate you having me.
All right. So you guys are, again, a semi. Of course, the semis trade off. So every other year, the Chick-fil-A Peach Bowl is not one of those playoff bowls, but this year it is. Big game. Let's just start with the matchup. How do you like the matchup?
Well, we got 2 of the top offense in the country, 2 quarterbacks that are going to be up here next week for the Heisman Trophy. Joe Burrow is probably going to win it.
Oh, yeah.
So, we couldn't be any more happy.
Wow.
So I was reading that you're the CEO of the Peach Bowl, and I was a little bit confused as to what that means or how it works.
Yeah, so we're a 501c3, 52 years old. We'll probably do about $40 million in business this year, have an economic impact of $100 million to Atlanta, and probably translates to about $5 million in tax revenues into the city coffers for our games.
So how much, I think we're asking, how much goes into that? How much planning? What's your
No, I wasn't
like?
going to ask that, but you go for you go for that one.
Walk us through sort of, I mean, this is a year-round job.
A lot of people think I work one day a year, just a bowl game. But we do work full-time. We have a kickoff game to start the season. We have a bowl game to end the season. We have a golf tournament. And we're the most charitable bowl game out of all 41 bowl organizations. We've given $53.8 million away in charity since 2002. And just last 2 months ago, we donated $20 million to Children's Healthcare of Atlanta to find clinical trials and cures for childhood cancer.
So you were just highlighting really like the huge economic impact that the Peach Bowl creates. So I'm wondering, obviously, that a lot of that's made on the backs of college football players. So I'm wondering if you think that some of those athletes should get paid.
Yeah, it's interesting. I think the NIL, name, image, and likeness, is going to be approved. The NCAA is working on some legislation that will probably be approved next year in January. And certainly the players, name, image, and likeness is going to give them the opportunity to make money. When I played college basketball at NC State, we got $15 a month. It was called laundry money.
Big stipend.
Big stipend. We could get a pizza and we felt like we were rich. But yeah, I think that's coming.
So this is the Chick-fil-A Peach Bowl. Can you
Yes.
explain to us what that partnership with Chick-fil-A is actually about?
Yeah, it's interesting. The New Year's Six Bowl games, ESPN paid $7.3 billion over a 12-year term to televise all the New Year's Six games, the Rose, the Cotton, the Sugar, the Orange, and the Fiesta, and the Peach. 2 semifinals every year, and the national championship game. So that $7.3 million, they make that back primarily on the title sponsors of our games. So in the case of Chick-fil-A, they're spending probably about $30 million in a national TV buy over the year with ESPN.
This is the 5th year now that we are in the new structure. We're getting far enough away from the old way, the BCS system, that people barely remember it anymore. I remember that last year of it, covering at the time. But now it's the 5th year, and in all 4 of the first years, Bama was in the playoff. First time this year that Alabama and Nick Saban are not in the playoff. But Gary, how do you judge? I mean, you know, the Chick-fil-A Peach Bowl itself has been around, as you said, for decades. But how do you judge how the change to the new playoff format has gone now in the 5th year?
Yeah, I think the CFP is better situated than the BCS. I think people enjoy it a lot more with the semifinals and the national championship game. You get the top 10 teams in the major bowl games. So TV viewership is up, payouts are up. So college football is healthy. It's the second most fan-avid sport out of all the sports, Major League Baseball, hockey, etc. Only behind the NFL in fan avidity.
All right, well, I'll be watching those 2 games on the 28th. I will give you my prediction, LSU-Clemson in the championship, and Clemson wins it all.
You heard it here first.
All right, well,
What do you think, Gary?
I disagree, but
Who do you like?
LSU, Ohio State, LSU to win.
Okay.
I have no...
She doesn't care about
that. All right,
Thanks
you,
for
Gary.
having me.
Appreciate it.
All right.
Now, we'll be right back here at Wi-Fi AM after a quick break. Welcome back to Wi-Fi AM at Yahoo Finance. Earlier in the show, we were discussing Time today revealed its Person of the Year. It's 16-year-old climate activist or climate change activist Greta Thunberg. And we were debating some of the other finalists. Guys, I thought they could have done, now Time already did it, but years ago, and now it's more relevant again than ever before, but The Protester. The Year of the Protester, again.
I really thought that would have been a good one as well.
In a sense, they could have included her. She is a protester.
True.
She is.
Right.
Actually, I see what you're saying. Just like the protesters as like an umbrella group, you could have included her, the Hong Kong protesters. Right. I'd actually would tie into almost like the theme that they've had with like the public servants as well.
That's right. All right, we have to leave it there. That is Wi-Fi AM for today. We'll see you right back here tomorrow. But don't miss On the Move. That show starts in 2 minutes.
It is 11 a.m. here in New York City, about 90 minutes into the trading day. Stocks, not much change today, a little bit mixed here. And that's as here comes the Fed. The central bank wraps up a busy year with its final interest rate decision of 2019 just under 3 hours from now. History in Saudi Arabia, Aramco shares jump in their first day of trading for the largest IPO in history. And listing battle, the NASDAQ looks set to take the top spot over the NYSE as the top destination for IPOs since Facebook went public. Welcome to On the Move. I'm Julie Hyman.
And I'm Adam Shapiro. Good to have you here. Our top story, Decision Day. The Federal Reserve will hold its final policy meeting of the decade, and in just a few hours, it'll release the FOMC statement. The central bank is widely expected to hold rates steady. Yahoo Finance's Brian Chung joins us from Washington. He will be at the press conference following. So, Brian, what are we looking for?
Well, no change at all, really. So Fed funds futures are currently pricing in a 99% chance. So basically a foregone conclusion that the Fed will hold rates steady at the current range of 1.5 to 1.75%. So, OK, if there's no change in the interest rates, then why is it worth dialing into the meeting in the first place? Well, two things that are worth watching. The first thing is really going to be the dot plot projection. Keep in mind that these are a new print of economic projections that we only get every other meeting. So we didn't get it when the Fed cut interest rates in October. We got it in September. Now, the Fed dot plot is going to tell us where interest rates could be headed in the next 3 years. Obviously, a lot of people watching the markets interested to see where interest rates might go in 2020. The problem is that the Fed dot plots are not all that good at predicting what actually happens. When you consider the December 2018 dot plot a year ago projected that rates would be between 2.75 to 3% this year. We see that we are actually much lower than that at 1.5 to 1.75%. The second thing worth watching is any sort of commentary on the Fed balance sheet. Some speculation in markets that maybe the Fed is going to want to steer clear of another repo flare-up like we saw in September, which could require some changes to the way that it addresses the balance sheet. That's not the expectation per se, but some commentary from Federal Reserve Chairman Jerome Powell could be warranted as some worry about a year-end crunch in repo overnight lending markets again.
All right, appreciate that. And Brian, we're going to be keeping an eye on you because, again, 2 p.m. is the important hour. Let's introduce the hour's panel now, though. Yahoo Finance's Akiko Fujita is here, as is Scott Gamm. Also joining us from Boston is Mellon chief economist and macro strategist Vincent Reinhart. Vincent, good to see you. No one expects any surprises. I guess we're going to have to pay attention to the dot plot, but I know, members of the Board of Governors and the FOMC have talked about, are they setting up unrealistic expectations with the dot plot because then Wall Street gets all excited? So with that in mind, what do we look for in that dot plot to tell us about the future?
To me, the big issue is start from the back and work toward the current date. What do they think the long-run nominal federal funds rate should be? That reveals what they think the equilibrium or the natural real rate is. It's going to be above the current policy rate, so somewhere between today and forever, they're going to have to raise rates. They're going to signal then when they think that process starts, and it probably won't be in 2020. They'll push off interest rate increases to the further horizon just because they don't want to get committed to having to act on policy.
And so what do you think then the economy looks like in 2020 that would allow them to kind of stay in that position of not having to lower rates further, or perhaps not having to raise rates either?
Well, Julie, I think my most confident prediction is that Jay Powell will say the policy rate is in the right place to keep the economy in a good place. That has been their mantra for the last couple months. Essentially, the economic momentum has us growing in the neighborhood of 2%. 2% is close to the rate of growth of potential output, should be associated with a little pressure on costs, modest increase in inflation. The Fed will put pretty high guardrails around the current level of the federal funds rate. They'll need to see some evidence that economic growth was softening in order to ease, because they characterized the previous 3 easings as insurance. And they'd have to see a lot of evidence that inflation was persistently above goal before they were to tighten. The U.S. economy doesn't move that fast, so 2020 is probably too soon to think about changing the funds rate.
You know, Vincent, what's interesting is when you look at the data between the previous Fed meeting and where we are today, you know, the narrative hasn't really changed a whole lot. We're still looking at softer manufacturing, a very strong labor market. And yet when you talk to a lot of these analysts, they will say that next year they're expecting maybe 2, 3 cuts. So I'm curious what you're seeing going into next year. If the U.S. data hasn't necessarily changed, what do you think could lead to the slower growth that a lot are looking at right now?
Couldn't know.
We're having a technical issue, and we're going to try and get Vincent Reinhart back on with us. He is the Mellon chief economist. But real quick, to the issue you were raising, and this whole thing about GDP growth, the other issue is inflation. And you got Neel Kashkari, who is the Federal Reserve Bank president out of Minneapolis. He has been one of those people who has said, cut rates, cut rates, cut rates. He, on November 5th, said, quote, we've been undershooting inflation for basically 6 or 8 years. So why don't we commit not to raise rates until we actually achieve that? Vincent, I don't know if you can hear that, but Neel Kashkari was saying, let's commit to not raising rates until we actually achieve our inflation target. What risk is there to the Fed actually doing what Kashkari wants, or is there no risk?
So the risk is that there's overshooting. First thing, I think the president, Kashkari, is a little ahead of the FOMC pace. Remember, they're doing a strategic review of their inflation goal and the setting of monetary policy. They're not promising any results until next year. And that's going to be an essential part of the conversation. How tolerant should the Fed be of an overshoot? The problem about a significant, persistent overshoot of inflation, say in 2020 or 2021, is that pretty soon market participants who tend to be impatient and overreact are going to say, gee, maybe President Trump really has influenced Jay Powell. Maybe those tweets do matter. And the other thing to remember is Jay Powell is probably a one-term chair. Not obvious that a re-elected President Trump would reappoint him. Not obvious that a Democratic president would reappoint him. Chances are then that it'll be a more dovish next chair. Do you want to leave that dovish next chair with an inflation rate above goal?
Vincent, just very quickly, at this meeting a year ago, the Fed, of course, raised interest rates, and that was kind of the final straw for the stock market. Any quick comments on how malleable this Fed has become over the past year?
They've been willing to move pretty quickly. Powell has shown himself to be flexible. Essentially, they wanted the economy to slow from 3% to 2% because that's what it takes to sustain the expansion. They thought they'd have to provide the headwinds with higher rates. Turns out President Trump provided the headwinds by all the uncertainty about trade and the actual dislocation to supply chains by actual tariff increases. So when they saw that, they moved from projecting tightening to actually easing.
All right. Vincent Reinhart is the Mellon chief economist. It's always good to see you. Thank you for joining us on The Move.
Thank you.
Boeing is dragging on the Dow today. That's after the FAA chief said the 737 MAX jet recertification process will extend into next year. Ines Ferre has more for us from the floor of the stock exchange. A lot of people, despite what Boeing had originally said, were expecting that this would drag on, right?
Yeah, that's right, Adam, especially after the FAA had put out statements recently saying basically that they're in charge and they're going to take their time when it comes to this recertification process. The FAA chief in an interview today, Steve Dickson, said that there are more milestones to be completed, and if you do the math, this process will extend into 2020. Just sticking for a moment with the FAA officials are meeting today in D.C. in front of a hearing in front of House lawmakers, and an FAA document was released in that hearing today in which FAA personnel had predicted more crashes after that first deadly crash, which occurred last year. That's the Lions Air crash. Remember that the grounding of the 737 MAX jet did not happen until the second crash this year. Well, the document that was dated at December 2018, which was released in this hearing, predicted some 15 fatal crashes if there were no changes made to the flight control software. The explanation that's being given at that hearing is that that analysis stayed at a regional level and it did not reach the national executive level. Adam, Julie.
Thanks, Inez. Well, shares of Saudi Aramco soared as the world's largest IPO hit the Saudi Stock Exchange. The oil giant officially became the world's most valuable listed company with a valuation of $1.88 trillion on this first day of its trading. I want to bring this to the panel. So this, even though 1.88 trillion is obviously an enormous figure, it's also lower than the kingdom initially wanted and Mohammed bin Salman reportedly wanted for the company. So what do we take away? If 10% is still 10% in terms of a first day pop.
Yeah, it's pretty incredible. I feel like we've been hearing about this for years and all of a sudden it just kind of creeped up on us. But I think the big thing to keep in mind is they're raising a little bit more than $25 billion, and that is a little bit more than the $25 billion that Alibaba raised at the New York Stock Exchange in 2014. So this is the largest IPO in the world by just a hair. Now, the $1 trillion valuation, or under $2 trillion, is significant because it's also a small percentage of the company that they sort of listed out to the public. So that speaks to just how large of a company this is.
Should anyone be concerned that the majority of purchasers right now are Saudi nationals?
I mean, this was a domestic IPO, right? I mean, I think that's what I take away from it. You talk about $25 billion. Mohammed bin Salman wanted to raise up to $100 billion when he first listed this years ago, or started floating out the idea. So that seems to me to suggest that, number one, they clearly didn't time it right, but there are also still a lot of questions around the kingdom, in addition to Saudi Aramco, which is obviously seen as part of the kingdom. There's a lot of transparency questions, and so it seems like that foreign listing that was supposed to raise a lot of money has really cooled down, and now they're looking at Asia as a spot, largely because there are still transparency questions.
Right, transparency questions, and also, I mean, MBS is alleged to have ordered a murder of Jamal Khashoggi by our own intelligence service. So I don't know if that's giving investors pause, but maybe it should. All right, let's turn to Chevron. There's trouble there as well. The company's writing down the value of its assets by more than $10 billion. It's the largest write-down by an energy producer in years. And this is fascinating, right? Because the shale boom had been seen as a boon for so many U.S. energy producers for so long. And Chevron's saying effectively that boom has led to lower natural gas and oil prices, and therefore it's writing down the value of its assets.
Well, it's like the chicken or the egg, right? Like you want higher prices to make it more valuable for you to actually invest in that infrastructure needed to drill oil. But then as the U.S. has become the world's largest oil producer, that of course has kept a ceiling on prices. And it is fascinating. You look at what happened to oil prices last week, not just with the optimism about the Aramco IPO, but the OPEC production cuts. And oil was up $4 last week. And now we've got good news on the Aramco IPO, and look at oil, down 1%.
But are the other major oil companies going to have to follow Chevron and write down some of their assets?
I think that's a big question. But I think to your point, that also, looking at the oil moves, that also suggests that things aren't necessarily dictated in the Middle East anymore, which is something that we've been talking about for a while.
Well, but when we talk about oil trading down, and I got to point out that my family has shares of Royal Dutch Shell, but when you look at oil globally, demand for fossil fuels, we talk about the headwinds with climate change and regulation that are coming, it's still projected to grow for the next decade plus, even though the world is switching. It's still going to grow. We're going to hit 100 million barrels of oil next year. Natural gas is going to be more in demand as we shift off of coal. So why are we watching all these energy stocks fall? And they've been falling for quite a while.
Because there's still more supply than there is demand, even if demand is rising.
Well, that, and you have, if you're an asset manager, I guess what is the long-term thesis for some of these names when you have so much excitement over new technology, right? Energy efficiency, electric cars, things like that. So are you going to, even if the numbers show some increase in demand, is that truly sort of the direction of where things are going?
And also, I guess, if you want to talk about new technologies, like sure, that's still a very small part of the market. And so I see, the demand that you're talking about, and you look at the growth in the emerging markets, I think you look at that and say, well, when does that start to cap off? But we're still seeing, even in a place like China, there's still huge demand, even with concerns about the economy.
All right, let's talk about what's going on in the world of listings, because the NASDAQ could steal the NYSE's IPO crown for the first time in years. NASDAQ-listed IPOs raised roughly $32 billion year to date, edging out the NYSE's $26 billion sum. So interesting here that NASDAQ has finally seemed to move past the Facebook situation.
People still talk about it 7 years later.
Yeah, well, it was a pretty big botched offering.
And yet NASDAQ has still been able to get some pretty notable IPOs this year, like Lyft. Of course, the New York Stock Exchange got Uber. Now, if you read the story in the Wall Street Journal that talks about this today, NYSE officials will say, well, when you add on the follow-on offering, so if you're a company already listed on the exchange and you want to raise even more money, you want to list even more shares, when you add that capital, the NYSE is ahead of the NASDAQ. But look, I think there will always be this competition between the two. I'm not sure of the relevance of this for investors beyond the broader IPO market. And I think there are still a lot of pressures right now, just the extra scrutiny on profitability. And I wonder what that means for the 2020 state of the IPO market.
Yeah, I mean, it matters to the NASDAQ and NYSE, but I think if you're an investor, it doesn't really resonate.
Even if you're an investor in the parent company of the NYSE or in NASDAQ itself, because listings revenue is not that significant a portion of these companies' businesses. It's more of a bragging rights kind of situation.
Yeah, it is kind of interesting, though, in that story when they talk about the incentives that are given to some of these companies, right? Whether it's the bell ringing or, some of these other things that they have had to do to try and sort of wheel in the big names. But Uber and Lyft, sort of the two biggest names, they split, right? Yeah.
And the direct listings were more notable at the NYSE than the NASDAQ, Spotify last year, Slack this year.
Yeah. All right, coming up, consolidation in cybersecurity, how a deal between two software rivals could create a powerful player in the war on cybercrime. Plus, too old to run, new reports claim Joe Biden would not run for re-election in 4 years if he were to be elected president in 2020.
Welcome back to On the Move. I'm Jared Blickery. We got the Dow down just about 50 points, 17 basis points. S&P 500, though, is in the green, up 12 basis points. NASDAQ up a little bit more. Russell 2000 down about 1/3%. Here's the intraday price action. We gapped up just a little bit, rallied, fell off, but another low volatility, low volume day. We are expecting that big FOMC decision at 2 p.m., followed by the fireworks, or maybe not, with Jay Powell's press conference at 2:30. Let's take a look at the 10-year T-note yield. That is off 2 basis points today, and the 30-year T-bond, it is down 3 basis points today. So we're also going to take a look at crude oil futures, because those have been pretty volatile following the stockpile report from the DOE. There was a larger than expected build, and especially in the gasoline and distillates, something like 5.4 million to 4.1 million respectively. Let's take a look at the Dow the Dow heat map here. We see Apple is up 0.5%, Microsoft just about unchanged, JP Morgan unchanged as well. Let's do this. equal weight, and we're going to go to quarter to date, see who's winning. We're about 2.5 months into this third or fourth quarter here. We see United Health is up 29%, Apple up 21, and JP Morgan up 14%. All three of those at record highs very recently. To the downside, Cisco has had a very tough quarter, down 10%. Boeing is also down 10%. We'll be back in 1 minute.
In a new Economist YouGov poll, Joe Biden is leading the way in the 2020 Democratic race, followed by Elizabeth Warren, Bernie Sanders, Pete Buttigieg, Mike Bloomberg, and Andrew Yang. But that may change potentially could change after a lot of things. But among other things, Biden reportedly signaled to his aides that if he did win, he would only serve one term in office. Rick Newman is here with us now to talk about this. So, Rick, I mean, it makes sense. He is what, 78? 78. Yeah. He's up there. So would this be an asset for him? Or does it say if you're too old to be president for 2 terms, aren't you too old to be president for 1 term?
I mean, that's what the political class is arguing about today. Would this be a good thing or a bad thing for Biden if he actually came out and told voters this publicly? The thinking is, on one hand, if you say, well, I'm only going to run for 1 term, it's basically saying I'm going to be too old to run again after my first term, which raises an obvious question. Well, doesn't that suggest that maybe you're too old right now if you can't go in it for 2 terms? But on the other hand, he might be leveling with voters. And I'm not sure. I mean, what do you guys think? I'll take a poll. Do you think that this would be a good thing for Biden to do or a bad thing for Biden to do? Why?
I think when you vote for a candidate, you go in expecting that broader vision they're selling isn't going to be accomplished in 4 years, right? Mm-hmm. You go into it thinking, yep, I believe this guy can be in it for 8 years, or this woman can be in it for 8 years. I mean, that to me suggests that he's willing to just kind of mend fences. I'm going to come and quiet things down after Donald Trump. I don't think voters.
Well, I don't think it's going to matter because I don't think that's why people are voting for Joe Biden. If they're voting for Joe Biden, I think they're voting for Joe Biden because he is not offensive, because he's
get things back to normal.
Exactly.
That is sort of his storyline. I will get things back to normal.
So I would contend it's not going to matter.
But also, the incumbent president has a much better chance of winning. So in your second term, if your incumbent is running again and you're a Democrat, you want your guy or whoever.
So this raises another interesting issue, which is that if Biden is the nominee, that makes his running mate probably more important than the vice president typically is, because the running mate becomes the heir apparent. Yeah. And worth pointing out, the presidential nominee in each party usually doesn't pick his or her running mate until the nomination. So you're not going to know who that is.
We're looking at this from an age standpoint and Biden, but you said something, back to normal. I don't think the Trump supporters want back to normal, what that means. And I don't think Democrats his age want back to normal.
Well, what do they even think normal is? And that's an issue. So
you've got two Democrats. No, you've got 3, Elizabeth Warren 70, who are 70 plus. You've got Elizabeth Warren, Bernie Sanders, who had a heart attack, who's 77, and Joe Biden.
Yep.
You know, that's an age issue. That you got a president who's overweight, but apparently in good health, but is 73 years old. Back to normal for a great part of this population is anybody under 70. I know it sounds ageist, But
we were talking about a poll that came out, what was it, last week or 2 weeks ago? You talked to college students who said Bernie Sanders was a candidate of choice. So age clearly hasn't factored into the younger demographic. But I think
there's something unique about Bernie Sanders' connection to young people, though, and that was true in 2016. It's not just that he's old that makes him appealing. There's something about his iconoclasm. You know what I'm trying to say.
He's an iconoclast.
And I mean, he's a glass breaker. He wants to, sort of, sweep all the china off the table, and I think that's his rebelliousness that they really like. And the others just haven't caught on whether they're young or old with younger people like that.
But why signal anything? Like, I just don't think it benefits him to even go there, right? Just focus on 2020. You'll deal with 4 years.
I mean, you might be right, but I think you also point to a third way here. So the first way is to say, I'm only going to run for one term. The second way is to say, no, I'm going for 2 terms off the bat. And the third way is to sort of whisper, have other people as your proxies say, he might not run for a second term. And so people have this in their mind that he's not going to be so obstinate that even if he becomes senile, he's not going to run for a second term.
The real issue is that you've got reporters assigned to these candidates who have to turn a story every day. And this is what you get.
Well, it's some Biden's staffers. This is not
something,
Biden.
And then
this
a reporter
Biden's staffers
been there,
talking to the press. Yeah. And I'm not sure this is the worst thing for Biden because his age is on people's mind.
Okay, let's talk about cybersecurity. As we head into 2020, cybersecurity threats and the companies that stop them are at the forefront of conversations. Yesterday, the Wall Street Journal reported we could be seeing a massive deal in the sector, with McAfee reportedly looking to merge with one of its rivals, NortonLifeLock. Steve Grobman,
yes,
welcome, is McAfee Senior Vice President and Chief Technology Officer, is joining us now. And can you share any more information, though, about a potential merger? A lot of people who are watching, a lot of us have LifeLock. Tell us what it would be like if there is a joint venture, a merger.
Right. Well, I can't speculate on rumors, but what I can say is the cybersecurity industry is a vibrant industry, both protecting consumers as well as all sorts of organizations against many types of threats, both cyber threats, but even information threats that could do things like influence the upcoming campaign, as you were just talking about with our last guest.
So I'll ask another vague question. Is bigger better when it comes to fighting cybersecurity threats? Is there a benefit to scale?
So there is a benefit to scale, and what's very important is having a comprehensive set of technology to defend your organization. One of the things that we've seen is that there's no single technology that can defend against all cyber threats. So having technologies that can work on devices, technologies that can work in networks, technologies that can work in the cloud, and having all of those work together is what an organization needs in order to defend their environment.
But isn't there an argument to be made for more competition in the space? I mean, there's already plenty of competition, but I wonder the counter to the scale argument being that you're sort of in the same space. Yes, you've got more money for R&D, but is there an argument to be said about having more players in the space?
So there are
in terms of countering the threat.
Yeah, there are plenty of players in the cybersecurity defense industry. It's actually a hyper-fragmented market, and what we've identified is no single company can defend an organization on their own. And what a organization needs to do when they set up their defense is pick solutions where different players can actually work together in common solutions in order to have that defense. So I think there's plenty of competition.
Let's shift gears to 2020. Deepfakes. A lot of the videos that are just absolutely hard to distinguish fake from real. What kind of progress is being made on that front? Because people are terrified about what could happen during the election cycle.
It is terrifying, and what's terrifying about it is that the barrier to entry to building a deepfake has come way down. We've known that Hollywood has been able to build compelling fake video for decades. I recently watched Forrest Gump, and there's compelling video there, or Rogue One.
Yeah, we're showing the Nancy Pelosi,
and it's a fake,
which is not
video,
a deep fake, right?
Right.
Nancy Pelosi is more of a
This is the Nancy Pelosi video is more of just a traditional edited video. With deepfake, though, a standard user can basically take a video of anybody and have them do or say anything and have it be compelling. While a few years ago, this took data science and AI expertise Today, it takes $12 and uploading some video to a website.
Is there a countermeasure, though? Is there some kind of code that would be able to say, oh, this was not original?
Well, and I guess to add to that, why, I mean, everything that I have, at least in speaking to those who are even creating some of these fakes, will say that you can't just keep chasing the threats. It's like cybersecurity in many ways. Why not go on the other side and try to lock in the image? Why isn't there more being put on that side instead of the focus on trying to detect a fake that's only going to get better?
Sure. So there's a few things. First, on detectability, to answer your question, is there are algorithms that can do detection, but it's a cat and mouse game. As the deepfakes get better, detection gets harder, and you can actually engineer a deepfake video in order to evade detection of the best detection capabilities. So what we're able to do is, while detection of a deepfake is able to say that is fake, the converse is not true. Whereas if it doesn't say it's a deepfake, that doesn't imply it's real. And to answer your question, you're 100% right in the long term. It's much more practical to focus on what are the authentic videos as opposed to trying to constantly find fake. And to make this practical for users right now, if they see a video on social media, try to go back to the source. If somebody posts a video and it says it's from Yahoo Finance, actually go to Yahoo Finance and watch it from the Yahoo Finance Twitter or website and make sure that you actually posted it and vetted it.
Well, we like that suggestion.
Yeah. Any advice? Behind cyber
there's many things I can take care of.
Thank you, Apple.
That is not one of them.
Steve Grobman, Senior Vice President and Chief Technology Officer at McAfee. Thank you for being here.
Thank you.
Coming up, in for the long haul, how Uber is capitalizing on the explosion of American e-commerce. Plus, before we go to break, let's take a quick look at some of the top trending tickers on Yahoo Finance today. Look, Peloton is on the list once again, down about 4.5%.
11:32 in New York City, 2 hours into the trading day. Stocks are mixed. We see the Dow is off, but the S&P 500 and the Nasdaq are trading higher at this moment. And we're awaiting the Fed decision. That's going to take place at 2 o'clock Eastern. Oil right now trading lower, $58.53 a barrel. Driving toward the future, we will take you inside Uber's freight operations with an exclusive look at the company's big plans for the trucking industry. Prime for an investigation, Amazon's takeover of Deliveroo faces scrutiny in the UK, and the Yankees get their guy. The staggering amount the Bronx Bombers paid to land pitcher Garrett Cole. Hundreds of millions. Who wouldn't want that contract? 9 years, $324 million. I'm Adam Shapiro. Welcome to On the Move.
And I'm Julie Hyman. Thanks for sticking with us. Let's go over to London now to find out what's making headlines there. Joining us is Tom Belger. And Tom, Amazon facing some backlash there over its stake in Deliveroo. Tell us about that.
There's a real risk that this deal could see consumers, restaurants and grocers facing higher prices and lower quality services. That was the pretty stark verdict today of the UK's Competition and Markets Authority. The background to this is Amazon was the lead investor in a $575 million funding round for the fast-growing delivery startup Deliveroo earlier this year. For Deliveroo, it wants the cash to expand in the pretty cutthroat takeaway market, taking on the likes of Just Eat, Uber Eats, and for Amazon, they saw, it looks like, more promise in Deliveroo than in their own Amazon restaurants arm, which they shut up shop for last year. The regulator paused those plans quite dramatically earlier this year, and it said today it's concerned that there's not actually that many players at all in the, or large players even, in the takeaway and grocery delivery sectors, and it's worried about losing future competition between these two firms. So crucially now, it's analysed internal Amazon documents and confirmed today they show continued interest in the takeaway delivery market. So much so that the regulator thinks there is a material likelihood Amazon will re-enter this market if it weren't for this deal. So that means the CMA has decided to give both parties just 5 days to address its concerns, and it will then decide within another 5 whether it accepts those changes, which will be legally binding commitments, or whether it's going to launch an in-depth investigation after its interim probe. It's pretty hard to see exactly, though, what these companies could offer that it's going to persuade the regulators to give this the go-ahead, given how serious those concerns are.
All right, we appreciate that. The growth of online shopping and a nationwide truck driver shortage have created a perfect opportunity for Uber. Uber Freight is the fastest growing segment of the ride-hailing company, and it's part of some very big bets the company's made outside of ride-sharing. That includes flying taxis like this one. Akiko, you went inside the company's R&D center in San Francisco. Not only was it fun, I'm sure, but eye-opening.
Yeah, it is, and it's certainly a timely discussion because, as you pointed out, one of the big reasons why Uber Freight has seen so much growth is because of the demand of e-commerce. Users wanting something one day, immediately, right away. Uber Freight certainly seeing a big opportunity on that front, but they're also seeing a lot of competition. One of many things I spoke to with Lior Ron, who is the head of Uber Freight.
It's a lot like Uber's ride-hailing business, except Uber Freight is tackling much bigger loads. A $797 billion trucking industry tasked with moving more than 70% of the country's freight. Lior Ron, the head of Uber Freight, says the demand for shipping has only increased with the dramatic growth of e-commerce.
As customers, we all expect more. Those trucks need to be on time. They need to deliver on time. They need to deliver with precision. They need to deliver even at the midst of the holiday season. And with that, there's more and more demand for technology.
This is where we open for shippers.
Uber's platform connects shippers directly with carriers. Shippers post loads that need to be picked up. Carriers choose their routes. Truckers can rate the facility just like the ride-hailing app and even file documents online once a load has been completed.
Before, you would actually the truck driver would have to go and fax this into their dispatcher, who would then fax it to the broker.
50,000 carriers have signed up so far across 48 states. Every one of these lines represents a haul. But Uber isn't the only player in the space. Companies like Convoy, Keep Trucking, even Amazon have all made bets on the digital trucking space, increasing competition and squeezing margins.
Let's talk about the financials. Last time we spoke, you said that the triple-digit revenue you think is still sustainable. The growth is there. Nobody's denied that. But your losses have also widened. When does that trend start to reverse? What's the path to profitability?
We think there's a very clear path to profitability, but it's important to understand we are in investment mode. As we've just discussed, we're just getting going. The beauty of this market is this is a known market. We are not inventing a new market. We're entering an existing market with technology that helps unlock a lot of efficiency.
When you think about, though, competitors like a Convoy, obviously Amazon getting into the space as well, that seems to me to suggest that you've got to offer up more incentives for some of these truckers and the shippers to stay with Uber Freight. Do you see a potential sort of race to the bottom that we've seen in the likes of ride-sharing or Uber Eats? Is that a concern?
We think this is less of a zero-sum game.
But inside Uber's R&D center in San Francisco, engineers are racing ahead to stay ahead of the competition.
What we see here are a few pieces that are going to be part of our future.
A future that puts autonomous cars and drones.
You just stuck right in, deliver your food.
And yes, flying taxis at the heart of transportation.
Self-driving trucks, that's your background. How much of that is necessary, you think, to get the company on that road to profitability?
We believe self-driving trucks are part of the future, and they are needed as a part of the overall logistics future. They are not necessary to build scale, to build density, to unlock a lot of that marketplace innovation, and to achieve profitability.
Now, going back to the financials for Uber Freight, its most recent quarter, they saw gross bookings grow by 81% year on year. Revenue was up 78% in the most recent quarter. But as we discussed there, you got a big name like Amazon that just jumped into this space this spring. There's certainly going to be a lot more competition on that front. And it's going to be interesting to see how Uber withstands that.
Definitely cool. But coming up, a new poll shows Americans split along party lines when it comes to impeaching President Trump. Plus, the New York Yankees break a record, and it only cost $324 million.
Let's take a look at some big movers in midday trading. I got a couple of retailers for you to look at. One of them is called Ollie's Bargain Outlet. That company's third quarter numbers beat estimates. In particular, sales were up by 15%. Now, recently, the CEO of this company passed away, the founder, Mark Butler. He is going to be replaced. That's just been announced by the former chief operating officer and chief financial officer, John Swigert, who has been at the company for quite some time. So those shares getting a pop from that as well. On the flip side, we've got a lot of small retail carnage today. Among them, Children's Place shares falling sharply. That company's comparable sales last quarter up just 0.8%. 3.5% is what analysts have been anticipating. The company, among other things, blaming weaker mall traffic, foot traffic in malls, and they also cut their sales guidance. We'll be right back. The S&P Platts Global Energy Outlook Forum kicking off today, and Yahoo Finance's Ethan Wolf-Mann is joining us live from the event. He's alongside Ravina Advani of BNP Paribas. Ethan?
Hey. So Ravina, I'd like to talk about some renewables and kind of what you and the bank are looking to do in the United States right now.
Thanks, Ethan. BNP Paribas is at the forefront of a number of exciting sustainability initiatives. We recently announced our intention to stop financing coal generators beyond 2030 for the EU and beyond 2040 for the rest of the world. We also have a pool of capital available to clean tech startups to really foster innovation and technology advancements. We have also publicly stated our intent to further our renewables endeavors by deploying $18 billion by 2021. That's a global mandate, and that's in euros. We've currently invested over 15 billion euros to date.
So that sounds like a lot of work. What are kind of the, some of the clients that you guys are helping and kind of the way this is going to be put into play in the future? I understand kind of gas is seen as the stepping stone to get to clean. How is that going and how's that going to happen?
Absolutely. We bank a wide range of clients across the energy spectrum within the power and utility space, the metals and mining space, and the oil and gas space, taking some of our utility clients, which I believe are at the forefront of energy transition. We have been supporting them through various financial product offerings, including green bonds and sustainable linked loans as they look to their own decarbonization goals. We've been working with a number of our oil and gas clients as they look to enhance their footprint in the United States, particularly in offshore wind, which is growing exponentially here. There's 20 gigawatts of offshore wind that are currently under development in the Northeast. So we're absolutely looking to provide them with various financing solutions. And as it relates to gas, that is an integral component to the overall energy transition. The market fundamentals continue to support gas. It's abundant, it's cheap, it produces 50% less CO2 than does coal, and it is a necessary fuel as we look to a carbon neutral environment in helping deal with some of the intermittency issues inherent to renewable generation.
So gas is obviously so abundant and cheap, as you mentioned. Is there any sort of danger of kind of getting hung up on gas on the way through this transition? Or is there some kind of other motivation that'll finish this push and make sure that it doesn't happen? Because sometimes it's not always the easiest thing can win.
I think as we look to contribute to the 2-degree scenario and we all look to combat climate change, gas will continue to play an important role in the overall energy transition. That being said, we are very excited about some of the evolving technologies that will displace all fossil fuels. I don't believe gas is going away. It represents 40% of our capacity mix to date. And as we look at 2050, projected to also represent at least 35 to 40% of our capacity mix. But as technologies evolve, particularly hydrogen or battery storage, some of those technologies will start to displace gas-fired assets, peaking assets, for example. So as we look to decarbonize globally, I think that following some of these technology advancements will be very important.
So kind of diving in a little bit into that, what are some of the technology advancements that you're most excited about?
Looking at the U.S., excited about offshore wind as it makes its way from various parts of APAC and Europe to the United States following the success of the 30-megawatt Block Island project. Very excited about battery storage in terms of its ability to displace natural gas-fired assets. And lastly, hydrogen. I mean, there are many ways in which hydrogen can be produced, transported, and used. It can be used as an industrial feedstock. It can be used to electrify and heat buildings. It can be used to really reinvigorate the transportation space. So there's a lot of talk about hydrogen and its ability to displace coal and carbons generally by 6 gigatons per annum if it's really able to take off. So that's one of the biggest trends that I'm most excited about.
So Leslie, what are you most excited for 2020 specifically? Obviously, a lot of these trends are going to take a long time, especially as some of this technology matures. Kind of in the more near term, what's in store for 2020?
I would say innovation and technology first and foremost, and then just all of the financing that's going to continue to drive this innovation and all of these new technologies.
Awesome. Thank you so much.
Thank you, Ethan.
Juliana, back to you.
Thanks, Ethan Wolf-Mann and Ravina Advani of BNP Paribas. Appreciate it.
Hospitals and insurers have been splurging on digital advancement in recent years, but a return on those investments still not clear. That's according to a new report from PwC. Yahoo Finance's Angelique Khemlani joins us with more details about this. But as you break down part of this report, one of the things that jumped out from your article and this report is that a lot of what they've done has been for convenience, not to save money.
Well, the idea being efficiency, right? That's that's their selling point. But efficiency also rolls into convenience for the consumer, and that's where they're trying to do more of a consumer-facing, strategy, where you're no longer just a patient; you are also someone that products get marketed to.
Mm-hmm. And so, are there any kind of benefits though when you're talking about on the consumer side? Whether it's cost or whether it's usability, did they see benefits there?
So the biggest problem, and this has been going on for a few years, is actually the adoption rate. So most of the patients that they're trying to target are definitely on the older range, right? Because that's where you need more of the monitoring and you need the device adoptions. But they're finding that either they're not using it well enough, or the hospitals and the doctors themselves aren't really willing to invest in it, or don't really want to get into it, because either it's cost prohibitive for them to sort of build that platform, or they're looking at the privacy part of it. Obviously, we've seen, in recent years that privacy is such a big issue when it comes to digital tech, digital health.
I don't know if this is exactly relevant to the study, but someone was telling me yesterday that due to the rise of, IoT, 5G, AI, all those buzzwords, that in several years, it's going to be a premium experience to visit a doctor in person, that an AI bot is literally going to diagnose you and deal with you. And if you want to pay for that premium service, you can. But it just blew my mind that that's kind of where this is going.
That is, again, what they're talking about as the goal. They're talking about being able to rely more on digital, because there is such a reduction in the labor space, right? We've seen so many articles about physician shortages, nurse shortages, lab tech shortages. So with that buildup continuing, especially because of the pressure that they're feeling through the reimbursement system, they're going to need a lot more of sort of like a digital help assistant, if you will, that's going to take up and fill in the spaces there. So it is really interesting. I mean, when you look at the data that we had as well from the report, the reason behind not getting into the technology, they were citing things like cost and data privacy. But then at the same time, if you look at where that is, whether the divide is from the pharma side, it's an interesting how few of the pharma executives were saying that they're willing to take it on because of the cost. And you think about pharma as this, waiting in cash sort of environment, and they're citing cost as a reason not to get into digital health.
I wonder if that's really the reason then. All right, Angelique, thank you so much. Coming up, honoring activism, Time Magazine announces its pick for Person of the Year. Plus, before we go to break, let's take a quick look at some of the biggest winners in the Dow today. United Technologies topping the list.
The mayor of Jersey City says 2 gunmen targeted a kosher Jewish deli for a shootout that left 6 people dead yesterday. Investigators say one of the suspects published anti-Semitic and anti-police posts online. 3 civilians and the 2 gunmen were killed. Those gunmen actually shot and killed a police officer, a father of 5, just before the shootout at the deli. A new Quinnipiac University poll shows 51% of American voters do not want President Trump impeached and removed from office, while 45% do. Results fell along party lines. House Democrats, they introduced 2 articles of impeachment yesterday against the president. That poll was conducted last week.
You all come to us young people for hope. How dare you? You have stolen my dreams and my childhood with your empty words.
Greta Thunberg is Time Magazine's 2019 Person of the Year. The 16-year-old climate change activist made headlines earlier this year when she chastised the United Nations for failure to deal with climate change. $324 million and a 9-year contract puts Major League pitcher Garrett Cole in the record books. The New York Yankees signed the former Astros pitcher to a record-breaking deal. The 29-year-old sensation went 35-10 over the last 2 seasons with the Astros, and we'll be right back.
It is time for Word on the Street, where we check in with our panelists and find out what stories they're watching. Scott, you're watching the newest developments in the Boeing 737 MAX scandal, and there seem to be them coming fast and furious.
Yeah, we talked about it earlier in the show, just concerned that the recertification process could extend into 2020. I don't think that's a surprise to anyone. If you look at a year chart of Boeing, really since the latest 737 MAX crash in March, the stock, yes, it's been down, but it's been pretty range bound over those past, 6 months, really since April. Look at that. I mean, it's been pretty, consistent given all of the headlines. Although right now at $343 a share, you're getting close to the August 14th low of $320 a share. Now, if you go back to that day, we were worried not about Boeing, but about the inverted yield curve. So it was a broader market downturn day. That was the low for Boeing stock since the latest 737 MAX crash, not any specific MAX headline. I just think that's fascinating how resilient the stock has been.
Resilient, but we're going to be talking next hour about CEO changes and turnover, and we still haven't seen kind of the ramifications.
The only thing we saw was Dennis Muilenburg, getting stripped of his chairman role, splitting that up, which, look, you could argue that every company should have that, right? It's good corporate governance to have your chairman and CEO roles split, but yes.
Akiko, a new report claims that China requested, was it thousands of dollars or was it millions of dollars from the World Bank for surveillance technology?
Yeah, not just requested, but China did use a World Bank loan to open some of these vocational schools in Xinjiang, which is, of course, where the Uyghurs have been imprisoned. And so this is an Axios report that has come out, essentially looking at this timeline between 2015 and 2017. 2015 is when the World Bank began a loan program called the Xinjiang Technical and Vocational Education and Training Project. And then in 2017, China came back to the World Bank requesting additional funds. And here we are looking at when this really started to peak over in that region for the surveillance equipment. And the reason I bring this up is because, number one, there's been a lot of debate about whether the World Bank should be giving loans to China at this point. There's
obviously
this, when China has developed much more as an economic power, are they, should they be on the receiving end of these? And I think this only raises additional questions about that. But it also, this Axios report also singles out companies like Hikvision and Dahua, who are already on the Commerce's entity list. So I think this is only going to give a lot of those China hawks in Congress more reason to go after China at a time when the Trump administration is trying to play nice to get a trade deal.
Well, we'll see how those cross currents work out. Akiko, thank you very much. Scott, thank you very much. And before we go to break, let's take a look at shares of XP. This is a Brazilian brokerage company that just started trading moments ago. Pretty big IPO here. The company raising about $2 billion, just under $2 billion in IPO. Overall, it's valued at about $15 billion. And you can see the shares going up about 24% in that first day of trading.
Coming up, it's the Federal Reserve's final meeting of the decade, and we are just 2 hours away from the decision on interest rates. We're going to let you know what they have to say. Will they hold or will they show them? Plus, a bad year for CEOs, why a record number of chief executives left their jobs in 2019. $12:01 in New York City, 2.5 hours into the trading day. Stocks are mixed. We're going to talk about that. Also, here comes the Fed. The central bank wraps up a busy year with its final interest rate decision of 2019. That's just under 2 hours from this moment. Taking a look at the 10-year Treasury yield, let's pull up the yield and show you it's falling 1.82%. History in Saudi Arabia. Aramco shares jump on their first day of trading for the largest IPO in history. And a year of departure, a new report breaks down the staggering number of CEOs who have vacated their positions. Gandhi in 2019. Welcome to On the Move. I'm Adam Shapiro.
And I'm Julie Hyman. Thanks for being with us. Our top story today, it's decision day. The Federal Reserve is holding its final policy meeting of the decade in just 2 hours. The central bank is widely expected to hold rates steady. Yahoo Finance's Brian Chung joins us from Washington with more. Brian, you usually get a question in there. Do you know yet what question you're going to ask?
Yeah, well, I usually come up with a list of questions because, as you know, there are many topics that are discussed, but ultimately just want to figure out what is the Fed's next step going to be. So the Federal Reserve appears to be on pause for right now. Markets currently pricing in a 98% chance of no change at all in this meeting, a pretty much foregone conclusion that they'll hold steady at the current range of 1.5 to 1.75%. Now, of course, there are some things worth watching in this meeting, the first being the summary of economic projections that comes with this meeting. They only release these projections every other meeting, so we didn't get one in October. We did get one in September. And this includes what they call the dot plots. This is projections of where each of the 17 members of the FOMC see rates by the end of 2020, 2021, 2022. What you're looking at, though, however, is the recent dot plot projection that we saw in previous meetings. And the problem is that these tend to be a bad indicator for actually what ends up happening. For example, in December 2018, they actually signaled that rates could go up to 2.75 to 3% by the end of this year. As we've seen, that hasn't been the case. The Fed has cut by a total of 75 basis points this year. Another thing also worth watching is the press conference where Jerome Powell should be expected to be asked some questions on the Fed balance sheet. Keep in mind that the Fed has begun regrowing its balance sheet. It's been buying short-term treasuries at a pace of around $60 billion per month. It's since reached the $4 trillion mark last month. So some questions about where the Fed goes from here, especially with concerns that the repo market could flare up again at year end. So a number of things worth watching. Again, as a reminder, the announcement will come out at 2 p.m. and the press conference will begin at 2:30. We'll have the coverage for you right here on Yahoo Finance.
We look forward to it, Brian. Thank you. I want to introduce this hour's panel. 3Edge Asset Management President and CIO Steve Cucchiaro and Yahoo Finance's Emily McCormick. Also joining us, Stifel Chief Economist Lindsay Piegza. Good to have you here, everyone. Lindsay, I want to start with you. Should they just get rid of that dot plot entirely? Has it done more harm than good, do you think, in terms of managing expectations?
Well, I don't know if it necessarily manages expectations, but it does give the market a sense of the divergence of opinions among committee members. Often we read the statement and assume that everyone is behind the opinion that is being presented. When we look at the dot plot, we see that may not be the case, and there's actually some diverging opinions to the more dovish or the more hawkish side. So I do think that the dot plot gives us a better indication into the conversation that's being had among committee members.
But we get that insight as well, though, when they give their public. I mean, the speeches they've given. Loretta Mester out of Cleveland back in November said she would have preferred to have held interest rates as opposed to cutting one more time as they did. And then you get people like Kashkari, who was pushing for interest rate cuts, who's now saying, let's make a commitment not to raise rates. So we eventually get what they're talking about, but Wall Street goes its own way anyway.
I agree with that, but I do agree with you that there is information still that could surprise the markets. For instance, if we see dot plots that don't show a flat line, but show an increase in hikes sometime during 2020, I think that could upset markets in ways that markets aren't expecting.
Well, I think one thing that really hasn't changed even since 2018 is this notion that the Fed is remaining data dependent, and they really are looking at this incoming data. And right now we do see that started to improve, and that's why we're seeing with near certainty market participants saying that rates likely will be on hold for the foreseeable future. If that were to change because of that data dependent Fed, then they'll change their outlook as well.
But Lindsay, is the Fed still really, it says it's data dependent, but at the same time it said that some of the recent actions were insurance, right? Because of the trade war. So has the Fed actually moved away significantly from its mandate?
I think the Fed is forecast dependent, and the forecast that is based on their analysis of the data. But right now, the Fed is very optimistic, looking for an economy at 2% perpetually and an inflation level that's going to move back to 2%. Despite the fact that inflation is stubbornly low.
It sounds like you think,
They've missed on inflation for at least 10 years.
For the better part of the past decade, absolutely. We've had brief periods above 2%. So it really, one of the questions I'd ask the chairman at the press conference is how much of that forecast is based on your realized assessment of the data as opposed to this overly optimistic forecast, in part predicated on legislative issues that may or may not come to fruition, particularly when it comes to trade.
They've given themselves a lot of scope because in recent announcements, they've painted the picture that even if inflation were to surprise on the upside, they don't plan to hike for some time because it's been asymmetrical. We've had inflation below target for some time. Let's let it run hot. Let's let it run above. And that can help them just keep on an even keel for longer than if they were data dependent.
So when Jay Powell's at the press conference, final one of the year, is there any specific thing you want to hear that we don't expect to hear from him?
I want to hear from him about his level of concern for the low level of inflation. As you pointed out, inflation is persistently below that 2% target. So if inflation maintains this low level and we don't start to see that upward momentum, is that justification for the Fed to reignite the easing train going into 2020?
We shall see. Lindsay, thank you. Lindsay Piegza is Stifel chief economist. Let's turn to stocks now. Shares of Home Depot are slightly lower after its fiscal 2020 sales growth forecast came in below street estimates. Inez Frey has more from the floor of the New York Stock Exchange. Inez.
Julie, Home Depot gave that preliminary forecast ahead of its investor day, forecasting sales growth of anywhere between 3.5% to 4% for fiscal 2020. And that came in below what the street had estimated. The company had cut its full year 2019 guidance last month after its earnings, citing investments in One Home Depot, saying that those investments haven't generated as much revenue as expected yet, and that they would back in going forward into 2020. Passing on to Disney. Disney's CEO Bob Iger has been named Time's Business Person of the Year. He described the moment that he saw those little green ears of Baby Yoda, saying that he just knew. This is the character, the Mandalorian character, of course, which has become such a huge hit. And speaking of Disney, Disney Plus, that app is now at 22 million global downloads since the streaming of Disney Plus launched, and that's according to new research from Apptopia. And we're also looking at Netflix. Netflix received a bullish note today from Piper Jaffray, a day after Needham had downgraded the stock, predicting that they could lose some 4 million subscribers in the U.S. Next year. Well, Piper Jaffray maintains its overweight rating with a price target of $400, with the analyst note citing research that they've done regarding some search trends, showing that the first 2 months of the fourth quarter could show a subscriber bump, and predicting that despite the onslaught of streaming services, that their subscriber growth for the fourth quarter could come in above the street consensus. Adam, Julie.
Inez, thank you. Shares of Saudi Aramco soared 10% as the world's largest IPO hit the Saudi Stock Exchange. The oil giant officially becoming the world's most valuable listed company with a valuation of $1.88 trillion. So let's bring in the panel on this one. Are they going to sustain this?
Well, they might in the short term, because even though we can all argue that the valuation might be excessive, there will be index funds that will need to come in, and because of their market valuation, add fuel perhaps to that stock. So I think in the short term, it might be premature to see a reset of more reasonable valuation. But in the long term, clearly they've managed this IPO. They didn't get the international take up as they hoped from the institutional world. And through friends of Middle East countries nearby and people within Saudi Arabia, that's how they got the stock price to do what it did.
Well, yeah, I mean, to your point, I wonder how much of this buying is nudge, right? Rather than
putting it mildly.
Actual, right, exactly, rather than actual demand.
I just think there are so many concerns around this IPO. I mean, the demand from investors outside of the actual kingdom is a big one. And then if we think about security as well, I mean, this is just coming a couple months after that intense attack on the oil fields, wiping out about half of production. So that remains a huge question. What about global oil supply demand? I mean, we've seen the price of barrel of oil just continue to sink. We've just been seeing a huge pivot away from a lot of these fossil fuels, and I think that's a huge concern. And not to mention the dividend yield, which is so much lower than so many of its peers.
So let's turn our attention, though, to Chevron, because there's been trouble at Chevron. The company wrote down the value of its assets by more than $10 billion. It's the largest write-down by an energy producer in years. Help us understand, is Chevron mostly United States, or is it U.S. and South America? Is it global? What does this truly mean? Because the follow-up would be, do the other oil producers have to follow?
So if you drill down into the write-off, it's mostly centered with reserves that they own in the U.S. and mostly around natural gas. And natural gas has had a particularly hard time because it's a byproduct of a lot of the shale oil drilling and other oil drilling. So I think it's reflecting the fact that not only Chevron, but others have also purchased large reserves that include a lot of natural gas. And this could have a knock-on effect where other oil companies, oil and gas companies, will be required to look hard at, do they need to write down their assets as well?
Any names? Would you be willing to?
Rather than mention names, I just see that as an overall, maybe it would be distinguished between those that are more focused with natural gas versus just the oil.
And it's also interesting that the stock is not down that much, perhaps because investors are saying, well, at least they're being realistic.
I think that's a huge part of it. And if we think about the energy sector just being the laggard in the S&P 500 so far this year, I think right now investors are saying this is just another notch with that thesis.
And there's another indication. We've had Warren Buffett and Sam Zell recently, known to be value investors, starting to invest in some of these beaten down oil and gas names. So that may be a sign that, yes, there's tremendously bad news in the sector, but perhaps prices reflect that bad news.
All right. Well, 2019 is the year of CEO departures. Just this month, 148 CEOs left their posts, and almost 1,500 have left their companies this year. Joining us is Andrew Challenger, Vice President at Challenger Gray & Christmas. And Andrew, you compiled this report, and it's the most departures we've seen since 2008 and the Great Recession. What should we as investors extrapolate from this? Are these CEOs not doing their jobs, or is there something else at play?
Yeah, there's a lot of different reasons for this, these CEO departures being at such a high volume. Certainly, partly it's tied to being in the longest expansion in American history. We have new companies that have outgrown their founder CEOs and are moving on to more professional management. We have legacy organizations that are fighting new technologies and new competitors that have been incubated during this period that are bringing in new management to combat that with new strategies. But we're also seeing a cultural shift where CEOs are being held to a higher standard. Their personal conduct is being closely watched, and boards are quick to move them out when there's any misbehavior.
Andrew, at least with the faces that we're showing, with the exception of one woman, it's a sea of white men, which of course reflects leadership at most of corporate America. With the switchover that we are seeing, is there any change there?
Yeah, so we've tracked this year about 22% of new CEOs that have come into the role are women. It's a surprisingly small number. It is up from 10 years ago when that number was about 10%. So there's some improvement there, but certainly a long way to go to get to gender equality there.
Looking at some of the sectors where you saw the most attrition, you wrote that government and nonprofit actually led. Then we have the tech sector and then financials. What's really driving these industries to be at the head of this trend?
Yeah, in government and nonprofit, there's a lot of budget cuts and regulatory changes that are causing people to make moves, but it's also a tight labor market for CEOs. We've seen this year, for the first time, more CEO hires are external as opposed to promoting internal for the first time since 2013. And in government and nonprofit, you certainly see people being poached away to more lucrative positions. In tech, we've seen quite a lot of turnover there. A lot of founder CEOs that have not been able to keep pace as their companies have matured and gotten to a new point in their life cycle.
Yes, you made a reference that right now in the cycle, we've had the longest running cycle. Do you think that there's a factor whereby people are just getting out at the top?
I do think that there's some validity to that. Most of the time, CEOs are not making the decision to leave their job on their own. Often it's pressure from the board. But I think regardless of where that's coming from, the fact that stocks are at an all-time high, that exit packages are going to be, because of that, in some ways, at an all-time high, it makes it easier all around for changes to be made at the very top of these companies.
Very quickly, Andrew, I read a report about a month ago that the average age for CEOs was going up. Are you seeing that potentially changing with these vast departures?
We haven't seen, we track actually the age of departing CEOs, and we haven't seen much change there. So don't know, but I do know that as companies are having to go externally to find new talent, and they're often doing that because they need access to people with experience in new technologies. We very well may see in the future CEO ages dropping.
I think what they say is out with the old and in with the new. Andrew Challenger, Vice President at Challenger Grand Christmas, thank you for being here.
Thank you.
Well, coming up, from steak burgers to pancake bowls, IHOP revamps its menu for the launch of its fast casual restaurant. We're going to talk to the company's president about its new concept just ahead. Plus, take a look at some of today's trending tickers on Yahoo Finance.
Welcome back to On the Move. I'm Jared Blickery. We still have the Dow off about 50 points. We did get a little bit of movement over the last hour, but on a net basis, really not much. There's that little lift off, but coming back here and kind of testing session lows here. S&P 500 is up a little bit, 8 basis points, but we can see it hit a new session low right now. And the NASDAQ is up about 15 basis points. Let's take a look at the 10-year T-note yield, because that has been under a little bit of pressure, down 2 basis points. With this, financials also under a bit of pressure, but utilities and real estate not able to take advantage of this move. And we also have gold popping a little bit, and that is a little bit related to this move. And interesting to see this kind of movement ahead of the Federal Reserve announcement. That is coming at 2 o'clock. And of course, the presser, when we usually see the most movement, is 2:30, sometimes to as late as 3:30. Let's take a look at the NASDAQ 100 heat map. We can see the FANG stocks, which are clustered right in here. Not a lot of movement, although Apple is up about 0.5%, Netflix up 1.5%. And if we sort by performance here, we can see chip stocks outperforming today, doing very well. Skyworks is up the most. It's up 4%. Micron up 2.8%. Applied Materials 2.7%, and so on. But Qualcomm is really the big mover here. That's up 2.2%, and that is based on a price upgrade to $120 per share. And that is coming out of Cowen, and they are saying that they are the 5G play of 2020, up 51% year to date. To the downside, we see Illumina, that's down 2%, and Mercado Libre down 2.2%. I want to go back to the bond market because we have something interesting happening today with the repo market. Fed Chairman Powell, he's going to get a lot of questions about this, and it's quite possible that he's going to have to respond to one of the research papers out today, or out this week, that's saying that we should get QE4 into the end of the year. Well, here's Jeff Gundlach, and this is something he wrote, somebody else is quoting him. It's a near perfect record. When the Fed grows its balance sheet, the curve steepens. And here we are looking at a correlation between the yield curve, that is this line in here, and the Fed's balance sheet, both spiking up right now. Something interesting to think about. We will be back in a minute.
IHOP is serving up something new. It's called Flipped. The fast casual concept location will open in Atlanta in April. Now, the store will have a build-your-own pancake bar along with menu items like egg sandwiches, buttermilk crispy chicken sandwich, and to-go salads. Jay Johns, IHOP's president, joins us now to tell us more about the first Flipped concept and how you all came to this. And what's the difference going to be, you know, as far as the food that's served if I go to a traditional, 1,700 franchise IHOPs, if I go to a Flipped, if this should catch on?
Well, the big difference is a Flipped is really, the food's inspired by IHOP. So you get a lot of the IHOP favorites. Think about the signature pancakes. You can still get signature pancakes, but what we're going to do is a little different at Flipped. What we're going to do is we're going to serve them in a bowl. Make this more portable, easy to carry with you. The idea of Flipped is it's for people in heavily, densely populated areas where they're a little more on the go, they need things fast. We're going to provide that for them. So those pancakes, we'll pull them hot off the griddle. Everything will be made fresh. We'll top them at a pancake bar exactly the way they want them. So if you want something sweet on there, you want fresh fruit, you want meat, bacon, sausage, eggs, we can do any of that for them.
Are you worried at all about Flipped cannibalizing sales from your mainstay IHOP locations?
I think this is a very different guest need. We did a lot of research starting about a year ago to understand what are the needs of those people that live in cities. And it's very different. They need things more on the go. They need things more portable, more handheld. I think it's a different guest occasion and oftentimes a different guest in these different markets we're looking at.
Jay, you guys in the third quarter, your comparable sales at IHOP were just about unchanged, although revenue did rise year over year. Is this where you're looking primarily for the next phase of growth, or is this, I mean, what's the speed of ramp going to be for this new?
I think that one of the foundational things we're doing is we want to get more IHOPs to more people, and that's across the board. So our growth strategy really falls into three areas. We're going to drive our PM business, which is lunch and dinner, as opposed to just breakfast. So we're going to drive that. We're going to drive more to-go business, off-premise, catering, delivery, everything off-premise. We're working on that. And then new restaurant development, and this falls right into that.
Why would you test in Atlanta and not, say, a New York or a Chicago?
Well, actually, we're looking at locations all across the country. New York, Chicago, San Francisco, Denver, you name it. We've got deals we're working right now with local franchisees, with real estate people. We're looking at spaces. I think Atlanta, there wasn't anything special about Atlanta has to be first. It just happened to be first because it's the one that kind of is going to come online ahead of everything.
You guys did quite well with your IHOB burger promotion. What did you learn from that? Are there any other kind of promotions that you're also going to introduce to try to, again, get growth back up to
I think we'll have a lot of promotions as we go forward. One thing you got to remember is we're IHOP, we're pancakes, we're fun. It's a fun brand. We're always trying to find new ways and creative ways. We just recently had an activation where we did on A&E, we built a tiny house. We built a tiny IHOP. And, you know, we're always doing something very fun, new activations. We're going to keep doing that. Movie tie-ins. We're doing an Elf on a Shelf promotion right now.
We talked to the Elf on the Shelf people.
Kids are loving it. They're coming in trying to find the elf in the restaurant.
With Dine Brands, I know one of the things that the CFO has actually said is talked about M&A as potentially being a strategy. I mean, are there any other brands that you think would fit under this portfolio to really help grow the entirety of the company if we think about IHOP, Applebee's, and a potential new entrant?
Yeah, I think one of the questions I get asked is this in replace of, Dine has said we're going after another concept and looking for something to be a good fit for us. We're still doing that. This is not replacing that. So we'll keep looking for the right fit and the right thing that will fit under the Dine umbrella overall. This is something that is a spin-off brand of IHOP within the IHOP family.
Okay, Jay, thanks for being
All right.
here. Jay Johns
Thank you very
from
much.
IHOP. Appreciate it.
Appreciate it.
Well, GameStop is in the red this morning after missing Wall Street estimates in its latest earnings report. Shares of the stock are tumbling today. They're down about 17% right now. Yahoo Finance's Dan Halley joined us now to break down the details of the report. Dan, something stuck out to me from an analyst today. The analyst from Benchmark said this was another update to the GameStop eulogy.
Yeah. I think someone quoted Jim Morrison in their quote. Something about the American nightmare. It's like this is a company that they projected that they would have losses in the high teens going for fiscal year 2020, and this is just a company that there doesn't seem to be an end in sight for the bloodshed. Really, it's an industry that is increasingly going digital. There's no consoles for people to buy right now outside of Nintendo Switch, which did have a good Black Friday and Cyber Monday and will continue to do well throughout the holidays. But Microsoft's coming out with a console next year. Sony's coming out with a console next year. And by the way, all of these companies are working on going away from consoles entirely and just streaming games. People aren't trading games in anymore. No one's buying them. It's all able to download. Why would you go to the store?
It makes total sense. But we had, what was it, right after Thanksgiving? Millennials. Remember that the report that they were going to GameStop as part of their Black Friday holiday purchase? It's almost as if put a fork in it, but the millennials don't want to put that fork in just yet.
It's strange because I think that that's probably in areas where people don't have the best internet connections, to be honest. I mean, these games are massive. They're multiple gigabytes. It takes a while to download them if you don't have a very good internet connection. But if you do, then there's no reason to go to a store and buy a physical game. There are collectors, obviously. Like I have old school stuff that I would like to still have in the future, but it doesn't really appeal to me right now. And the other thing is, these stores are atrocious on the inside. Every GameStop I've ever been to is too crowded. It doesn't feel like you're actually going into a place that you want to shop in. You feel like you go in, you're in someone's dingy basement that just lined the walls with games, and then you're just picking them up and going.
Like Sears.
Yeah, exactly. Yeah.
No, it's the customer experience.
It's never been that great there.
Well, Steve, I wanted to bring you into this because I don't know if you talk about individual stocks, but when you look at retail more broadly, I mean, what you're saying could be said about a lot of retailers right now that are doing really poorly. Is retail an area that you're looking at? Is it attractive, or are you seeing so many execution issues that...
At one point I thought maybe it's a more cyclical problem because the consoles will come, there will always be a segment, but then I think of 5G. That's just going to accelerate what you said earlier.
The demise,
It's the consoles will continue to need to be sold, but people can buy them on Amazon or Walmart online or something. But the games are really the bread and butter of the industry, and it takes a while for them to recoup the cost of the consoles. But once they do, then it's just money flying at them. But Microsoft, their last quarter, their Xbox segment was down because the new console isn't out yet, so they're seeing suffering from hardware sales. And it really is. You just download it. This is, remember Sam Goody, Coconuts, all of the music stores. This is where GameStop is going because why bother going when you can get everything online? And that's exactly what happened to those companies.
I miss Tower Records.
Tower Records, yeah.
I miss a great documentary about them. Thank you. Coming up, is bad press taking a toll? Facebook falls on Glassdoor's latest list of best places to work. Let's take a look at some of today's winners on Wall Street. Look at that, Chewy. Lockup's over.
just after 12:30 p.m. here in New York City. 3 hours into the trading day, we've got stocks little changed, not unusual on a Fed decision day. It's about 90 minutes from now, and it looks like investors are waiting to hear what the Fed has to say. Gold is trading about 0.5% higher, $14.75 the ounce. No longer the dream job, Facebook tumbles on Glassdoor's latest list of the best places to work. Testing the system, a new lawsuit challenges the need for the SAT and ACT college entry exams. And the new Mac Pro could take a huge bite out of your savings, the shocking amount your next computer could cost. Welcome back to On the Move. I'm Julie Hyman.
And I'm Adam Shapiro. Our next guest started his business scrolling his name on hats with a Sharpie and selling them to fellow snowboarders and surfers as well, wasn't it? Tapping into youth culture, he consulted with companies like Target and now creates brands that intersect celebrity and trends. Joining us is Sean Neff, whose latest endeavor is Beach House Group. And you have some big names associated with Beach House Group, like Kendall Jenner and Bobby Brown, who was actually...
Millie Bobby Brown.
Millie Bobby Brown.
Yeah.
Oh, okay. How do these the collaborations, how do you get them? Do they come to you? Do you go to them?
Yeah, it's kind of both. Kendall, I've known Kendall and Kylie for several years, so I had known them. So we kind of had an idea to disrupt oral care with Moon. So I just pinged them and went to their house. But yeah, Millie came from a mutual friend in the industry, and she was looking to go out and start her own beauty brand. And mutual friend said, I know a guy that's built several brands and had some exits, so you should talk to Sean. So I seek them out, and the good ones hopefully seek me out as well.
No, we've been talking a lot about retail lately and some brands that just are not doing very well. Whereas you write your name on a hat and people buy it and voila. So, I mean, which makes it sound really easy. But what is this sort of special sauce, do you think, especially right now? Is it getting a celebrity on board? Although when you started doing it, you weren't a celebrity that I know of. So, I mean, so what do you think is that sort of magic?
Yeah, I think, today in this competitive world, the magic for us at Beach House is you got to have incredible product. Without incredible product, you're nothing, right? And then on top of that, a platform that allows you to tell stories. For me, brand building is storytelling. So we try to find unicorn-like talent, like Millie Bobby Brown, Kendall Jenner, Shay Mitchell, Tracy Ellis Ross, people that are passionate, and let them tell an authentic story. And I think the biggest separation for us now is omni-channel, right? This past 10 years, it's all been about D2C and raise a ton of money and try to acquire customers through a funky algorithm. But I'm not a fan of that model. Big believer in retail, and I think those kind of days are over.
I mean, yes, product, of course, is incredibly important. But if we think about the age that we're in now with Instagram, with e-commerce, it almost feels like visual identity is more important, at least for that initial customer acquisition. I mean, would you agree with that? Because that seems to be the route a lot of D2C companies are taking at this point.
Yeah, I couldn't agree more. And beyond the actual product, it's who you stand for, right? Especially for us, especially with Florence. We're after Gen Z. It's a different customer base, right? They care about the world. They care about what the product's made out of. They care about what you support. So beyond just the traditional ways of making someone consume something, what do you stand for and believe in?
But you hit on, it has to be a really great product.
Yes.
And I can't think of his name. It was Kevin. He was the CEO at Saatchi & Saatchi. This is going back 20 years. He wrote a book called Love Marks. And essentially what he said was successful brands have a relationship with their base, with their clients, with the people who buy the stuff.
Yeah.
That's akin to love. That even if you mess up, as long as you're honest with them, they'll stick with you. Is that still in play in a world where one bad Instagram photo, you're out?
100%. I mean, in the end, any brand, we're nobody, right? It's all about the end consumer and what they love. And all we can do, and all I kind of do as a brand builder is there something that maybe doesn't exist today? Or can it be tweaked a little bit, right? Because working with retail, you're going to talk to a buyer and you're going to have to give them something that is not already on their shelf, or else they don't need you, right? So make it different. And especially today, you've got to be honest. You've got to be out there from a standpoint of, hey, we're here for you. And that's the key to consumer moving forward and trying to be a good brand that does good things for the world and work with good people. It's kind of what we try to do.
All right. Well, Sean Neff of Beach House Group, we appreciate your being here. Did you say to Julie we're going to riff earlier? I'm going to show my age here. We were just riffing.
Yeah, we're riff. Yeah, little riff. We just riffed.
Well,
was
I
a fun
appreciate
riff.
that. I learned a new word.
There you go.
So much for the Gen X generation here. Thank
All
you.
right.
All right.
Coming up, examining the system. A new lawsuit labels college entrance exams like the SAT biased and unconstitutional. Plus, take a look at some of today's most actively traded stocks by volume. You've got BB&T topping the list today. More riffs coming up. We've got some trending tickers for you from YahooFinance.com. Peloton shares continue to trend lower. They're down now 11% over the past 2 days in the wake of the commercial that has been criticized from the company, or perhaps just a little bit more of a rational valuation. Who knows? Because the shares had come up from the IPO and now have come down. They're still up 20% though from that IPO level. And speaking of IPOs, we've been talking about XP. This is the Brazilian. Let's see if we can get today's price. Maybe that'll be a little easier for us. There it is. It started trading just after 11 a.m. It's up 26%. This is a Brazilian brokerage. The folks who started it took their cues from Charles Schwab. It now has 1.5 million clients and about $84 billion under custody. It raised just under $2 billion in that IPO. And we've been watching some of those retailers today. American Eagle Outfitters on the list of underperformers, down by about 6%. The company's comparable sales actually rose by 5%, but it did cut its earnings forecast for the current quarter. So those shares taking a hit on that. And if you're following today's trending tickers, make sure you're watching the ticker. It's right here at 2 p.m. on Yahoo Finance.
Loneliness, uncertainty, the importance of trust are the dominant themes included in Ford's 2020 trend report. Now, the automaker's latest peek at the near future. And with us to discuss this and other trends revealed in the report is Cheryl Connolly, Ford's chief futurist. The first and simple question is, why does Ford, I don't want to put you out of work, but why do they have a futurist dealing with these kinds of issues?
Well, every company needs a futurist, and particularly if you are durable goods, long lead time, large capital investment in terms of product development, because we're building cars today or designing them that will won't hit the market for 3 to 5 years. And so we have to think about what are consumers going to want. And we can't just ask them. Even Henry Ford said if I'd asked people what they wanted, they would have said faster horses. So Futurist helps the organization imagine a future that no one else has yet to imagine.
So if loneliness is one of the trends that you're seeing, and I think that rings true with all of us who walk around with our eyes glued to our phones, right? How do you employ that when it comes to car design? How do you make it more, friendly? I don't know, or make more people in a car. I don't know what you do with that.
Well, so it's interesting. The work that I do is specifically non-automotive. I look at social, technological, economic, environmental, and political arenas to try to understand the forces that will shape consumer values, attitudes, and behaviors. So when we do the research, we're not necessarily looking for what will this mean for the auto industry. Loneliness was interesting to us because it's a trend that we tend to think of associated with older generations, but it's really the youngest generation that is suffering the greatest deal of loneliness. So 62% of Generation Zs, those people under 24 years of age, say that they feel lonely often. That's once a week. And half of those people say that they feel lonely even when they're surrounded by other people. So there are a couple different ways that brands can address this. Some of it is like finding new ways to engage them. If you can get more sleep, if you can give out hugs, there's like a National Hugging Day in January. But for automotive, one unexpected correlation is that over half the people we spoke to said that their best conversations take place in the car or when they're on the road. And then a large number of people, almost half, also say that they use their commute time to catch up with family, friends, and loved ones. So it was an unexpected tie, but we think it's really powerful.
Yes, so I'd really like your opinion about a trend that particularly concerns me on behalf of the global economy and the market impacts. And that is that for years, the global economy has benefited from globalization, cooperation, win-win. Rising tide lifts all boats. Increased global trade, and that certainly benefits car companies that operate globally. Now we see the advance, not just in the US, but in many countries, of more nationalism, zero-sum game. If I make you lose, I win. Protectionism. And in your view, is this short-term or is this a longer-term trend that we should all be worried about?
Well, every trend has a counter trend, and so it's like a pendulum. It swings one way or the other. So I've done this role for 16 years, and globalization was all anyone was talking about in the early years. And in most recent years, you definitely hear a lot more about nationalism. But when it comes to brands, global brands like Ford Motor Company, there's a trend that we call out for 2020. It's called Call to Stand. And what we see is that price, quality, convenience, service, quality, those have always been important decision makers when it came to a purchase decision. But people want to know, what are the virtues of the product? What are the values of the brand behind it? And increasingly, consumers are asking companies to take a stand on social, political issues. So for instance, if we look to the Paris Accord, we have the extraordinary leadership of Bill Ford, who is the great-grandson of Henry Ford, and he's always been a very staunch environmentalist. So the Paris Accord, he said, that's something that we want to design to. That's something that we still feel very important about to play our role. And we know that that type of positioning really means a lot to consumers today.
Cheryl, when you look at a lot of these trends that you've really listed out in this report, which one do you think is the number one priority at this point for Ford? I mean, is it really the ESG, the activism that consumers are really trying to put forth with their purchasing decisions and some of the companies that they're investing in? Is it loneliness? I mean, what's your take on that?
So I think the green paradox is a really interesting opportunity for all brands. So the green paradox, we have 70% of people we spoke to, over 70% of the people we spoke to in 14 different countries saying that I'm working really hard to live more lightly, to be aware of my footprint. But less than half of Americans say that they're only willing to take measures as long as it's a minor inconvenience or no inconvenience at all. So we're all happy to use a recycling shopping bags. We give up straws. We try to move away from plastic. But when it comes to doing something that's going to have a real meaningful impact, people are much more reticent. So from a strategic standpoint, this plays out really nicely for Ford when we're trying to help people close that gap between what we call intention and action. And I think the new Mustang Mach-E, it's our all-electric sport utility vehicle, is a perfect solution because people are saying, I still want mileage and muscle. And so it's up to brands to find a way to reconcile their desires.
And we also know about Ford's partnership with VW with electric vehicles. We have to call it quits there, but we appreciate your being here. Cheryl Conley, Ford's chief futurist. Always good to see people from Ford.
Thanks for having me.
Well, Glassdoor is out with its list of best places to work, and software company HubSpot earned the top spot on the list. Tech firm DocuSign and In-N-Out Burger filled out the other top 5 spots, though tech giants Facebook, Google, and Apple did not fare so well. Also, the declines in rankings. Facebook tumbled 16 spots to 23rd on the list. What the heck is HubSpot, by the way?
I think it's like a tech company, a software company where they're essentially, so again, it's kind of this coding focused, I guess, firm, which doesn't really surprise me to be at the top because, they tend to be well compensated. That's one of the factors that really played into the ranking, to have a lot of career development opportunities. And so I think that's how that factored in.
Did you say In-N-Out Burger was in on there? I wonder if there's because these are different kinds of businesses, but is there one unique, or is there one common theme and what makes it a happy or a pleasant work environment and why they score at the top?
Well, Glassdoor actually put out a list of 4 traits that they found that they had in common for especially the top 10. So it was a mission to believe in, a strong culture, people-focused, and transparency, which seem kind of vague, but I feel like at the same time, if you think about it, these are probably factors that we'd want to have in a workplace.
I also see a pattern in those companies that have been highly ranked that have a lot of those attributes but have come down. And what I see is that when there's a lot of external pressure on those companies, it's really hard for those companies to shield the internal environment.
Like Facebook, for example.
I think those pressures feed into the internal environment.
Does any of this stuff ever feed into your investment decisions? All of these ratings we get, whether it's a good place to work, the ESG stuff that Emily was referring to earlier, do those places make better businesses at the end of the day?
What's surprising is that most people would initially answer a question, no, there are many other financial factors and so on. But when you look over the longer term, you do find that there are certain attributes, and you might call them the environmental, social, good governance, treat employees well, treat the community well, that tend to correlate with the better performers. So I would say yes.
All right, coming up, this price has a big bite. The staggering amount, the latest Mac Pro, will set you back. Plus, take a look at some of today's losers on Wall Street. Look at that, Luckin Coffee, they're going down. Let's take a look at the top trending stories right now on Yahoo Finance. Huawei's CFO has won a court battle that will give her access to more evidence and documents relating to her arrest in Canada as she fights extradition to the United States. She was arrested last December at the request of the U.S. and was charged with bank fraud and accused of misleading HSBC Bank about Huawei Technologies and their business in Iran. New York Life Insurance is reportedly negotiating with Cigna to acquire a unit that sells non-medical insurance products in a deal that could be valued as high as $6 billion. Cigna in recent months has been seeking a buyer as it moves to focus on its core business. General Mills and Hershey's teaming up for a new breakfast cereal. Hershey's Kisses cereal is available in limited stores right now, but should be available just about anywhere starting next January. That cereal will sell for $3.99 mid-size box and $4.99 for a family-size box with lots of sugar. We'll be right back.
Now it's time for our buzzer beater round. 3 stories, 1 minute each. Let's get started with this. Time magazine is out with its Person of the Year award. The winner, teen climate change activist Greta Thunberg. Greta will be the youngest figure to receive this distinction in the magazine's 92-year history. Emily, good choice.
Well, you know, we actually had Haley Edwards of Time, a Time senior editor, on one of the earlier shows, and one of the things she said was that really the Person of the Year is about whoever exerted the most influence during the course of the year. And I think in that sense, she is a good choice because, you know, she at 15 years old, she came out, skipped school, demonstrated for a cause she believed in, and really galvanized millions of people around the world to do that. She's also emblematic of just youth activism around the world, we're seeing with movements like the Hong Kong protests.
But has anything actually changed? Like, if she's most influential, what actual action have we seen on climate change?
Well, I think we all want to believe that one person can make a difference, and she certainly proved that. I don't even think she would claim that anything has changed, but she wants to gain attention to the complacency.
Right, start a conversation. Right.
Yeah.
Apple unveiled its new Mac Pro Tuesday, and it may put a hole in your wallet. The computer starts at nearly $6,000, but get ready. It could cost up to $52,000 now, and you know we're talking about 1.5 terabytes of RAM.
Yeah.
So you know this isn't you don't bring this one home or have it break on set and then have to take it to your global services desk to get fixed, like mine just did.
Not that he's bitter.
52 grand, would you pay?
I think it's a very clever idea because it's all about speed. The big increase is to increase RAM, which increases speed, and there's always a market for someone who would pay anything to get more speed. And so I think it's very clever to call attention to that, and there will be a small segment that will eat that up.
Right. If I were a Hollywood video editor and I was, editing videos in 8K all day, I think I would need something with this capacity. And since I'm not, I will not be taking out a loan for a computer.
And it comes with wheels for $4 grand.
Yeah, you can wheel it from your editing bay to your next editing bay, I guess, in Emily's example.
I just like being able to say terabyte. 1.5 terabyte. I mean, it's,
All right, a new lawsuit is challenging the University of California's requirement to give SAT and ACT scores. The lawsuit argues that these standardized tests are unconstitutional and that they don't provide meaningful insight into a student's success. This has been an ongoing debate, whether there was bias inherent in these tests. Do you think that they're still a good way for kids to get into college?
I think SAT scores provide an excellent opportunity to have someone who's a lower income student distinguish themselves because they get a high SAT score and get into a college that they might not have been otherwise. So I take the opposite view.
I thought the purpose of the test wasn't to predict your success, but to determine whether you were prepared for what you were about to encounter when you got to the institution.
I think that's a relatively accurate assessment of it, but I think one of the issues at the heart of this is it really a biased test? Like, are the questions biased? Is the methodology biased? Or is it really just reflecting inequities?
Yes. Okay, there are inequities because, as they point out with this test, that people score higher if they come from higher income families, but that's a whole other issue.
All right, well, that's where we leave Buzzer Beater. Steve Cucchiaro, thank you for being here. Emily McCormick, thank you as always. Let's take a last look at the markets here. Of course, we are just a scant hour here, a little more than an hour from the Fed's interest rate decision, expected to leave interest rates unchanged. However, we'll see what the dot plot does. We'll see what the statement says. And as we await that, we're not seeing much change in stocks. Adam, you're going to be back watching that Fed.
At 2 o'clock, hopefully with a computer. By the way, Mr. Cook, if you're watching, we got to talk about this thing. It broke right as the show started. And I'm picking up the phone, and it's not going to be pleasant. Wi-Fi PM is going to take you through the next hour of trading. And again, we have the FOMC statement for you at 2 o'clock.
It is 1 p.m. in New York City, and all three major indices are a little changed as we await the Fed's last 2019 decision on rates in just an hour's time. On tap for today, the Fed largely expected to leave rates unchanged in its last policy meeting of the year, but where do we go from there? We'll have to watch when Fed Chair Jay Powell steps to the podium. Plus, a day of irony as Time magazine names climate activist Greta Thunberg its Person of the Year, the same day that Saudi Arabian oil giant Saudi Aramco sets a record for the largest public offering on record. We'll chat with one analyst who says the oil company is about 10 years too late in getting its IPO off the ground. And building wealth like a billionaire. Venture capitalist and author James Altucher will join us to share what he learned from interviewing more than a dozen billionaires for his new book, Think Like a Billionaire. Happy Fed Day, ladies and gents. Let's get that paper. This is Wi-Fi PM. Good afternoon, everybody. I'm Zach Guzman, and joining me on Wi-Fi PM today is Yahoo Finance's Sabeel Marcellus, along with Clearonomics founder and CEO James Lu, back with us in studio. Good to see you again, man.
Thanks for having me.
Well, let's start with the market action we're seeing. I said it was quiet ahead of the Fed rate decision. I think that's pretty quiet. The Dow off 40 points, the S&P and the NASDAQ in the green for now. We'll see what happens as we approach that interest rate decision at 2 p.m. But first, let's dig into what their thinking is as we await the central bank's last interest rate decision at 2 p.m. Eastern Time. Fed Chair Jay Powell will also hold a press conference at 2:30 following that announcement. And it comes as the Wall Street Journal reports the central bank is likely to hold rates steady after cutting rates at its previous three meetings. But James, I mean, all indication when we look at how the market is planning for this, about 100% chance that nothing happens.
That's right. When you look at Fed fund futures, they're basically pricing in a 100% chance the Fed will not make a move this time around. So really the question is what happens going forward. Mm-hmm. And if you think about where the markets and economists are today versus where they were last year, they're pretty much in sync with the Fed. They basically got what they asked for, which was that the Fed would at least pause its policy, if not start to reverse it. And at this point, the Fed has cut rates, of course, 3 times. So, going forward, there was a small chance that the market was pricing in maybe one cut next year. Mm-hmm. We'll see what happens there. Basically, the market adjustment after 2 and the press conference at 2:30, we'll, of course, watch very closely. Yep. And then the Fed will put out their statement of economic projections. We don't expect too much to change there either.
And that's really what I think today is all about, is looking at those projections moving forward. If everyone's kind of on the same page when it comes to what's going to happen in today's interest rate decision, but where their thinking is going through the data, looking ahead to 2020.
Yeah, absolutely. And what a difference a year makes. So last year, back in December, the market, we saw a massive sell-off because the Fed was raising interest rates and was not in tune with what investors were expecting and what was happening in the U.S. economy. Mm-hmm. But now we're seeing that they've turned a page. Now we don't expect rates to be changed when they come out with their decision this afternoon. And some economists are reluctantly willing to say that President Trump was probably right in going after Fed Chair Powell and saying he should stop raising interest rates. But we know that President Trump going forward wants even more from the Fed. He wants them to go to negative interest rates. Yep. And many economists have said that would definitely hurt the U.S. economy. So I think the Fed's just playing it safe right now. They believe rates are where they should be, and they're just going to hold them steady.
Yeah, and the other thing, too, is the Fed will also be releasing its updated edition of its summary of economic projections. That will include Fed forecasts on GDP, unemployment, and interest rate forecasts, as you're talking about, James, over the next few years as well, and beyond. So, I mean, when we look at it, the data, the underlying data is something that you can ask 2 different people, and they could tell you, we're fine. You can point to the consumer, and 70% of the economy is still holding up and say no worries there. But when you look at the way that some companies have been thinking about reinvesting into their businesses and the trade concerns, still no answer as we are, 4 days away from December 15 tariffs on the table as of now. How do you kind of put those 2 pieces together?
Right. I mean, there's the question of, is there going to be a recession sometime soon, which many had feared just 12 months ago? And the answer is probably no. I mean, we're an economy that can hopefully still grow around 2% in terms of real GDP, which is a pretty solid rate, especially if you look at, last week's payroll numbers, for instance, which was pretty good. Yep. And, that's kind of the longer-term structural story. And then, of course, if you look at CEO surveys, if you look at what people believe about the economy, that's where the headlines come into play, where trade uncertainty really rocks the boat a bit. So you have this long-term structural trend, which it does seem to be generally okay, even though the yield curve inverted and has uninverted. There are these kind of factors that kind of play into there. Manufacturing is weak, but generally, like you say, Zach, the consumer is okay. And then you have these big headlines. And so really what we're looking at 2020, the big shocks around the headlines, hopefully some of those will go away, and we can kind of get back to long-term structural growth.
Yeah, I mean, when we talk about those headlines, a seventh straight quarter that we've seen CEO confidence fall, and yet consumer confidence still stands a little bit more optimistic when we look at things, but some people might put a little bit more weight on the CEO confidence numbers there as well. We'll dig into those later in the show. But when we talk about the Fed's dual mandate, inflation is one of those things that has perplexed a lot of what we've heard out of Jay Powell, and we got an update to consumer prices increasing more than expected last month. November CPI rose 0.3% as households paid more for gas. Economists polled by Bloomberg were expecting an increase of 0.2%. So I don't want to sound the alarm there, but a little bit more hot when we think about inflation expectations.
Yeah, so inflation expectations, I think, were pretty much either in line or slightly above. But of course, the Fed looks at lots of different inflation expectations. We're not in a situation where anyone is talking about deflation in the U.S. As they were, especially after the financial crisis.
Yeah, so inflation went up 0.3%, so better than expected. They were expecting it to go up 0.2% month to month, but it's pretty moderate, so it doesn't really justify the Fed changing interest rates at this point. There was a lot of concern that with all the additional tariffs, that would push consumer prices up higher and the Fed would have to deal with inflation, but we're not really seeing that pan out. I don't think it's because consumer prices could not possibly have gone up because of the tariffs. I think it's because businesses have been absorbing the costs of the tariffs and being reluctant to pass it on to the consumer. So that has definitely been reflected. We saw many earnings reports, especially when it comes to those businesses that produce consumer goods. They face a lot of financial challenges on their end, but they tried to hold it close to the vest.
Yeah. And one thing to point out, too, is the tariffs that could possibly go into effect on Sunday, December 15th, those would have a much larger impact on consumer goods. And so it might be a delayed reaction in CPI and other inflation measures that might flow through from the consumer.
Yeah, and also very difficult for the Fed to kind of try and work some of this stuff into their models as well, since you never really know what's happening. Even it seems the White House sometimes doesn't necessarily know where the trade war is going to go. But shifting away from some of the macro concerns to some of the more specific, company-specific concerns we're watching today, the head of the FAA is on the Hill facing a new round of questioning over Boeing's 737 MAX plane model. The congressional appearance coincides with the Wall Street Journal reporting that U.S. regulators allowed the model to remain in the air after its first fatal crash, despite data suggesting the jet could crash again. And Yahoo Finance's Alexis Keenan joins us now for more on this. Alexis, that's troubling when you think about the FAA deciding to keep this model in the air, despite the fact that this is a very dangerous model and one that was projecting another crash in just 2 to 3 years' time.
Okay, so actually this is a topic that has been raised by the House Transportation Committee that is having its 5th hearings on the Boeing 737 MAX crashes underway as we speak. The document, we don't have to rely on the Wall Street Journal anymore. The representatives there have taken a look at this document. They've shown it, and we can show it to our viewers as well. Now, what it says is that after that first crash, and you can see there, this is an FAA document. It's an analysis that was prepared after that Lion Air crash in October of 2018. And what it shows is that the MAX was among the most accident-prone planes in decades, according to their analysis. And it shows that, on average, that there would be one fatal crash of the 737 MAX every 2 years if it was left in its original state, meaning that no fix to the MCAS or the AOA sensors or any of the other problematic systems, the confluence of systems that caused the planes to eventually go down. If nothing had been done to those, it would average about 50, there's an actual number there, 15.373 crashes over the estimated lifetime of that aircraft, which is a span of 30 to 45 years.
Wow.
So the Wall Street Journal and now congressional members saying, this was way too accident prone, and the FAA's chief administrator, Stephen Dixon, admitting that that was not a risk level that would be tolerable at any time in any decade under the FAA's purview.
Yeah, this seems not good.
No, completely absurd. I feel like we have to repeat it again. One fatal crash every 2 to 3 years.
Every 2 to 3
people
years.
just dying on planes every 2 to 3 years, and that was okay with the FAA, and they let Boeing fly these planes. I mean, I feel like we're still not getting to a point where it's FAA or Boeing is being accountable for the risks that they put for not just Americans, but the entire world.
So a number of representatives have asked Dixon, who, mind you, was not the administrator, he was not chief of the FAA at the time of these crashes or before the crashes at any time. He's only been in his position for 4 months. He says he is accountable. And many of the representatives have said, has FAA made a mistake with this document? Who had their hands at the FAA on this document? So far, I've been listening to the hearing since 10 o'clock Eastern time today, have not heard who exactly had that knowledge at the FAA, though Dixon also qualifies it, saying that, look, this is just one of the tools in the FAA's arsenal of evaluation techniques that it would have uses, to decide whether or not they made a mistake. But he did say, yes, he did say if he had this document on his desk and if he knew what he knew now, he would have grounded those planes. This document came out in November, right after that October crash.
Well, it also raises questions about where we go from here in regards to Boeing's attempts to get its plane recertified, the 737, back in the air, and how that process might go moving forward, with the FAA kind of put out here saying that their own estimates would have had this plane that crash-worthy. And yet, how do we go and say, okay, that's going to be okay with them looking at it and putting this plane back in the air?
So he was asked if there was a new estimate for time frame, and Dixon said, again, there is no time frame for the 737 MAX to be recertified. However, the FAA has now taken the authority for the full certification, no longer relying on Boeing to have any say in whether those planes go back up in the air. They have to provide the necessary requirements that the FAA is asking for, but there's still a lot of work to be done. And now we're coming up, at the end of the year here, when Boeing had estimated that it would have all of these fixes into the FAA and had hoped to have recertification, but it doesn't look like that's going to happen in December, and it certainly doesn't look like it's going to happen in January either.
No rush on that.
Yeah, and despite the pessimistic update we're getting right now, Boeing stock only off by about 2/3.
But a little bit. There's some response here, and granted, this is the FAA's responsibility that this hearing is talking about today. Boeing is seeing a little bit of a hit there.
Yeah, and still recovering as we move along in the trading day. But Alexis Keenan, thank you so much for bringing that to us. Coming up, oil giant Saudi Aramco making history with its public debut at a nearly $2 trillion valuation. About 6 ExxonMobils put together. But next, we're going to chat with one analyst that says the company is about 10 years too late in getting its IPO off the ground when Wi-Fi PM returns. Well, Saudi Aramco is soaring today after the world's largest IPO debuted on the stock exchange in Riyadh. Shares rose from an IPO price of 32 Saudi riyals to, as we're seeing there, 35.20. And joining us now to discuss is Shork Report editor Stephen Shork. And Stephen, I just want to get your quick reacts to the way that we saw this max out at the 10% gain at its debut, because going into this, it didn't sound like you were so optimistic that we might get that.
Oh, well, I'm extremely pessimistic on the future of Aramco. Of course, we did have the IPO today. And of course, we did have a lot of buying. 75% of the institutional money that this IPO represents comes from Saudi companies, funds, government agencies. 97% of the retail investors are coming strictly from Saudi Arabia. So when you put a gun up to your countryman's head and tell them to buy, guess what? They buy. But we're talking about a company now that notionally is 1.4 times more valuable than Apple. I think that's quite bizarre, because what else happened today? That Greta Thunberg kid from Scandinavia just got Times Person of the Year. The future is not oil. And yet we've got a company, an oil company, that now is theoretically 1.4 more times expensive or valuable than Apple. Doesn't jive well as far as I'm concerned.
Yeah, the irony of Greta Thunberg being named Person of the Year is not lost on me, nor is that quite troubling metaphor that you're using when we talk about holding the gun to the head. I mean, we're talking about Saudi Arabia, and people haven't really talked about the fact that some of these national security concerns, the fact that the oil refinery was attacked, and some of those concerns being overlooked with this IPO, that's one thing. But even more so, when you talk about oil demand and the peak in the prospectus laying out that oil demand would peak in 2035, some people saying that that's even too optimistic when you're talking about the shift away from oil, perhaps to natural gas here.
Yeah, absolutely. When we talk about peak demand and going out as far as 2035, the only reason why you make a forecast that goes out that far is because you're trying to make astrology look respectable. So what we've seen now in the here over the last 2 years was a significant, massive tectonic shift, not only in supply-demand fundamentals, but of course, longer-term out, the mindset of this younger generation coming into the market. So clearly, I do think, and I am a believer in peak oil demand, 2035 to that point. Yeah, I think that's a little too far out. I think it will happen sooner rather than later. And again, why you would want to own a oil company when all of the major Western oil companies, your BPs, your Shells, your Exxons, they don't even brand themselves as oil companies anymore. They're energy companies to this point. So I do think it is a risky endeavor long term out.
But many investors are in the markets to make a lot of money. So Aramco, it's now the world's most valuable listed company. And Saudi Arabia was actually trying to sell a 5% stake ownership in it to foreigners. So why wouldn't people who want to make a lot of money get a stake in this?
Well, fair enough. And you're correct. 2 years ago, the initial idea was we'll sell 5% of the shale, we'll raise $100 billion. But Saudi Arabia went on its roadshow into London and New York. And guess what? Western investors balked at the idea. So instead of listing this shares on the London Stock Exchange or the New York Stock Exchange, you had a domestic listing because there clearly wasn't enough demand from the investor community. So instead of selling 5% of the company and getting $100 billion, you sell it for 1.5% shares and you raise $26 billion. Again, not an insignificant amount of money, but far below what the what your best case scenario was just a couple of years ago. And we led off this segment, and I am on record saying that this IPO is 10 years too late. That had this occurred back in 08, 09, even during the depths of the Great Recession, you're looking at oil prices that dipped but quickly rebounded over $100 a barrel.
Yep. Well, I mean, let's go ahead and separate the issues here, Saudi Aramco aside, and look more macro here at the oil market overall, because Chevron expects to write down as much as $11 billion of its assets in the fourth quarter amid a slump in gas prices. That would be the largest write-down by an energy producer in years. So, I mean, when you look at this, Mr. Schork, do you go ahead and say this could be the beginning of what had started to be a tough year for oil and energy companies, and then the beginning of an even worse 2020?
It's going to be an extremely difficult 2020 for the oil and gas industry. We're talking about $140 billion of debt that is coming due. This is debt that was reissued 5 years ago when oil prices did break. We had oil prices at this point in 2014 at about $90 a barrel. Today, they're $50 a barrel. The same situation for natural gas. So we had a partial comeuppance in the market in 14 and 15, but Wall Street allowed the industry to kick the can. They gave them a little bit more slack in the noose. 5 years, those lines are coming due. Wall Street's no longer interested in acreage. Okay, they're no longer interested in the growth. They want to see the money. So you've got a lot of debt over the next 2 years. As I said, $140 billion coming due. There's going to be an extreme amount of bloodletting in this industry over the next 2 years. It's going to be a very difficult road to hoe.
And Stephen, I've read research that on an adjusted basis relative to where oil prices are, I mean, things in the industry look even worse than they did back in 2015. So I guess, are there any bright spots, or I guess another way of putting it is, what is the future of this industry then if oil prices and demand don't really come back?
That's it. I think, and this is why we are, the future is natural gas. This is why we just mentioned Chevron. I mean, they did walk away from that $52 billion bidding war for Anadarko against Oxy. Clearly, natural gas is the fossil fuel of choice. It's your cleanest burning. It's your cheapest to produce. It is your most cost productive. It is the engine of economic growth, especially here in my home state of Pennsylvania, but all throughout the petrochemical industry. That is the future if you allow it to grow organically. The issue now here is that we've got significant political winds that are actually talking about banning natural gas. So, which is just, to my mind, inconceivable of what this will potentially do, the hit that this will have on the entire economy should it come to fruition.
Yeah.
So you do have to make your investments, and your investments are going to be more towards the natural gas market and away from the oil market, which, as my understanding is that Chevron is writing down their natural gas, correctly so, because the market has crashed. Why? Because the market is a success in that you've had a tremendous amount of investment, and we are producing a tremendous amount of natural gas. We're making the demand outlays out there, but they're still a few years away, and Chevron's taking the appropriate steps at this point.
And you got to think, just to bring it back to Greta Thunberg being named Person of the Year, that a shift to a much cleaner energy source seems inevitable at this point. But Stephen Schork, thank you so much for joining us. Appreciate you taking the time. Just after the break, we are drilling deeper into threats to established energy giants and heading out live to the S&P Platts Global Energy Outlook Forum to chat with Google's head of energy on how the company is targeting the space. Wi-Fi PM is back in 2. Welcome back. The S&P Platts Global Energy Outlook Forum is currently underway, and Yahoo Finance's Ethan Wolf-Mann joins us there live at the event. And Ethan, you just spoke with Google's head of energy strategy and global infrastructure. So what did you learn?
That's right. I spoke with Neha Palmer, who is in charge of all that, and learned a little bit more about how Google has a relationship with renewable energy. Let's take a look. Many people are maybe surprised or would be surprised that Google has this big energy department. And I'd love for you to explain kind of what you do for Google and kind of Google's relationship with renewables right now.
Sure. So I lead energy purchasing for Google's global fleet of data centers. We have operations on 4 continents, and so this is actually a big focus for our data center footprint for sustainability purposes. People think of Google, they think of search, they think of YouTube, and all of those things are hosted somewhere in a data center. We use a significant amount of energy to power those data centers. These are very large football field size installations. And so for us, in order to run our business in a sustainable manner, we really need to address that footprint created by the electricity consumption at the data centers. So our team focuses on buying the cleanest source of energy for those data centers that we can. As a result of our efforts, we've now matched our energy with 100% renewable energy for the last 2 years, and we're the largest buyer, corporate buyer of renewable energy in the world.
So if we think about exactly how much these data centers use, I think it's, we see Google kind of like we see wind, so we sort of more perceive it. But is there an idea of how much this infrastructure that data centers actually uses? Is there kind of a way to frame that into a way that people can understand?
Yeah, so last year we used 10 terawatt hours of electricity. To put that into perspective, that's a little bit more than the state of Hawaii used last year. So we are a large consumer, which again is one of the reasons we're so focused on buying energy in a clean and sustainable manner.
So what is pushing Google's renewable kind of agenda? Obviously, you guys could probably simply just tap into existing grids and the power structure, but you guys have chosen not to do that. Why?
Yeah, it really was started by our founders. They've always wanted to run the company in an environmentally responsible way. Energy consumption is the largest portion of our carbon footprint. So in order to do that, we have to address how we buy energy.
On the other side of that, how you guys consume energy, has Google become a lot more efficient with these data centers, or is that something that is mostly happening on the buying side and the renewable side, or is there kind of that balance between the two?
No, absolutely. We call it the negawatt. The megawatt that you don't use is the most important piece of efficiency. We've been focused on efficiency since day one. We have actually used some of our core technology, machine learning, to actually make our data centers more efficient. In the last couple of years, we've been able to really optimize our cooling infrastructure by using machine learning and reduced our energy consumption as a result of that.
So when I think of kind of Google's massive global footprint, obviously it's not necessarily as feasible to do renewables in certain locations rather than others. How do you guys plan around that with your buys? And is there kind of offsetting for one market or one market offsets another market? How does that all work together?
Sure. So our goal is global and annual. So when I say 100% renewable, that means across the globe, across the year, for every kilowatt hour of electricity we use, we've also purchased a physical kilowatt hour of renewable energy. But we don't just stop at the buying. We actually spend a lot of time working with governments, utilities, in locations where there isn't access to renewable energy to open that up. An example is Taiwan. When we started in Taiwan, there was no access to renewable energy. You had to buy from the grid. Over the years, working with the government, working with the utility, they've been able to open that up to corporate customers to buy directly from renewable energy resources. So we take an approach of we'll buy, but we'll also try to open pathways for ourselves and others.
Awesome. Thank you so much. Yeah, thanks. So really interesting hearing how a large company like Google can have an impact and really change things. Obviously, Hawaii is enormous, and another company on that same scale really can do a lot. Zach, back to you.
All right, Ethan Wolf-Mann, thank you so much for bringing us that. But next on Wi-Fi PM, why annuities might be an overlooked resource in your retirement plans. We'll chat with a professor who says they could help boost your risk appetite later in life to boost your money to work harder for you when Wi-Fi PM returns. Welcome back. When it comes to retirement, annuities have long been a contentious issue, but some experts are warning against swearing off of them as the retirement outlook gets tougher and tougher for some Americans. Join us now for more insight is American College of Financial Services professor and the Frank M. Engel Chair of Economic Security, Michael Finke. And we should note this is part of our Funding Our Future campaign, an alliance of organizations dedicated to making a secure retirement possible for all Americans. So, Michael, good to have you with us. What can you tell us about annuities maybe being overlooked? I know that it might not be the sexiest instrument when we talk about retirement out there, but what are some of the pro-cons people should know about?
Well, I think it's first important to understand that we're all pretty well aware of what annuities are. Social Security is an example of an annuity. It provides a regular payment over the course of our life and retirement. If you're eligible to receive a pension, you're also receiving an annuity. And a private annuity is essentially a pension that you buy from an insurance company. And a very simple annuity, like a single premium immediate annuity or a deferred income annuity, provides income as long as you're alive. Essentially, it gives you the ability to achieve that clarity that previous generations of retirees were able to achieve through a defined benefit system, through a traditional type of pension. So really what we're doing is we're saving in our own retirement account, a defined contribution account, and then we're using our savings to provide a lifetime income through an income annuity.
There are fees associated with annuities, though, when we think about it, too, so that might be one thing for people to worry about. But I was reading your research as well and how it kind of shifts people's mental accounting when we're thinking about annuities and how that actually might, with an income stream like that, actually might push some people later in life to maybe quantify the amount that they could be putting in stocks, but maybe having a stronger risk appetite later in life that could help make them a little bit wealthier later in life.
If you think about what risk means in retirement, risk is about not being able to live the lifestyle that you want to live. And if you don't have strong investment performance in your portfolio, the consequence of that is that you may have to ramp down your spending later on in retirement. If you live too long, you might have to ramp down your spending. If you have a base of income that covers your expenses, your fundamental expenses through some sort of annuitized income, whether it be Social Security or defined benefit pension or a private annuity, essentially that takes away the downside risk and it allows you to take more risk with the remainder of your investment portfolio. So we've actually estimated that the optimal portfolio for those who have more annuitized income is more heavily weighted towards stocks than one that has less annuitized income. And when you buy an income annuity, the best way to think about purchasing it is from the bond portion of your portfolio. So sort of consider the annuity as part of your overall aggregate portfolio. It is created from fixed income instruments like bonds. So consider it part of the bond portion of your portfolio, but maintain the equity allocation in the remainder of your portfolio. And actually, because the downside risk is less, you can take even more risk with the remainder of your portfolio.
Got it.
So a big issue and concern for seniors is cognitive decline. So around what age do you think someone should actually set up these annuity payments? And will it actually protect you if you are to suffer some kind of cognitive decline when you're older?
I'm a big fan of what's known as qualified longevity annuity contracts. And with a qualified longevity annuity contract, you can put up to $130,000 from your IRA into a deferred income annuity that starts making payments when you're 80 or 85 years old. And in a way, you can automate the later part of your spending through the use of a QLAC. I and a lot of other economists are huge fans of these. Not only do they provide a tax deferral benefit, but they give you the opportunity at the very beginning of retirement to set a certain amount of money aside, $130,000, and you can buy about $40,000 of income every year after the age of 85. And we know from our research that your ability to manage your own money decreases as you get older. And by the time you hit your late 80s and 90s, your ability to manage your wealth, it may even be a bigger risk than market risk, the risk that your wealth can decline because you're making bad financial choices.
Yeah, and I mean, you can't overlook the potency of a tool to kind of help us save us from ourselves, even younger investors as well, when we think about some of our risks as well, not to be overlooked. But Professor Finke, thank you so much for joining us. Appreciate you breaking all that down. Coming up, your secret to wealth might be annuities, but could it also be emulating what other people have done to get rich themselves? Author and self-made millionaire James Altucher joins us next for what he learned from chatting with famous billionaires like Richard Branson and Ray Dalio for his new book, Think Like a Billionaire, right after this. Good afternoon and welcome to Wi-Fi PM. I'm Zach Guzman, and joining me today is Yahoo Finance's Sabeel Marcellus, along with Clearonomics founder and CEO James Liu as well, joining us today. Sabeel, it flew in my throat just then.
Right, it was close.
It went in there and I choked on it. We're looking at the market action right now, and it's a mixed picture. We got red and green on the screen. The Dow off by about 30 points, the S&P and the NASDAQ in the green for the time being. We'll see what happens in Act 2 of our show. But one of the questions we're asking today is if you've ever wondered how some of the world's richest people achieved success. And our next guest has interviewed the biggest names among the super rich, from Richard Branson to model Tyra Banks to Ray Dalio, about their road to success and what they learned along the way. So joining us now is the author of Think Like a Billionaire, James Altucher. And congratulations, your ebook and audiobook are available today, exclusively on
Zach,
Scribd.
thanks so much for having me on the show. I really appreciate it. And these were interviews done over a period of 6 years, and it took me a while to read through them, read back through all the interviews, remember all the points, and try to see what I can incorporate into my own life.
Yeah, I mean, I know that you're a very data-centric kind of mind here through your career in venture capital and beyond, but when you look at it, have you connected the dots in what these people who have established enormous wealth have been able to do and do well?
I think to some extent. I mean, everybody's different, and I started this when I was reeling from a financial or entrepreneurial failure. I was depressed. I was trying to figure out how do I get off the floor so I could function and be productive and innovative again. And so I decided, okay, I'm going to study, these people who have been so innovative, have created such impact on society, are so, charitable. All these people sign the Giving Pledge, giving away their fortunes. And I think there are a lot of things that they have in common that I wasn't enacting in my own life.
Like what?
Well, there's this one concept I'll call ready, fire, aim. So imagine like a young 27-year-old Richard Branson. He's a music magazine publisher. One day he decides, you know what, I think I'm also going to do an airline. Nobody had ever competed against British Airways before, ever. Mm-hmm. So he calls up, everyone says you're crazy, you're a 27-year-old, hippie or whatever. He calls up Boeing, borrows a plane from them, and builds Virgin Atlantic, now Virgin Galactic. Like, he's flying people into space eventually.
Yeah.
So how does someone do that? It's worth asking the question and understanding. And part of it was he wouldn't listen to the people who said, you can't do this. He fired. Mm-hmm. He didn't come up with a business plan and raise all the money and buy a plane from Boeing. He just called Boeing and said, give me a plane.
Yeah, no,
and
for sure.
Even studying that conversation and asking him about it, you learn, like, it's not quite a sense of entitlement. It's almost like improvising into that, like, I'm worth you giving this plane. You will work together.
Yeah, and shielding yourself from that self-doubt as well.
Or another one might be, someone like Damon John, who he got his first $100,000 clothing order for FUBU before he had the clothes. He had to mortgage it. He got the order from, I think, Macy's. He mortgaged his mom's house, then in a weekend sewed all the clothes, and then got the money and then paid back the mortgage.
Yeah, so ready, fire, aim, fake it till you make it. There's all bits of those throughout all these people's stories. But one of the other billionaires, too, we're talking about is Michael Bloomberg. And that's another one now in the 2020 race. So what do you think of his entrance into the race and how a billionaire's mind, we already saw it with President Trump, what a billionaire's mind might do on the Democratic side as well?
Well, we've seen it. I mean, so Bloomberg has some executive experience. He ran New York City for 3 terms. They changed the law for him to run another term. And I don't know. I think he sort of thinks that, historically money can buy an election. Whoever spends the most on campaign ads usually wins. But we've also seen historically, if you skip Iowa, you skip New Hampshire, the media is already going to crown a king. I think that's what's going to happen. If I were to make a bet, I wouldn't bet on Bloomberg here. I think someone's going to win in Iowa, someone's going to win in New Hampshire. The media is going to decide, this is the Democratic king. Like, it's just like Giuliani in 2008. He skipped those 2 first primaries and caucuses, and he never had a chance. And he spent $60 million in 2008. So Bloomberg's going to have to spend a lot more than that to overcome that bias.
He's already off to a very good start, spending $50 million in his first 2 weeks. But that is a very interesting ready, fire, aim, potentially going wrong for Michael Bloomberg. But we'll see how the.
And I have one more. Can I get one more?
I mean, yeah. Listen, I'm not going to cut James Altucher off. You go right now.
I'll call this one idea sex. So a lot of these guys and ladies, they take 2 ideas that seem disconnected and they combine them and they make a huge $1 billion idea. So an example might be someone like Tyra Banks took modeling and America's Got Talent, and then suddenly you have the most successful reality show in history, America's Next Top Model. So if you look at like even companies like Google, Facebook, they're really just a combination of other ideas.
Yeah.
So it's kind of fascinating how these guys innovate by putting 2 ideas together.
Far be it.
Currency plus e-commerce.
Yeah, far be it for me to cut off a discussion on idea sex. But James Altucher, got to leave it there for now. We're going to have you back on to discuss some more of this stuff.
Thank you so much.
Thank you for stopping by. Just ahead, 2-time LPGA Player of the Year. Stacey Lewis sits down with us after locking down the first ever sponsorship for an LPGA golfer while on maternity leave. Why securing paid parental leave isn't just an issue for pro athletes and what is to be done about it when Wi-Fi PM returns. Well, the price of becoming a mother can be very high for most professional athletes, and many end up leaving their sport without pay in order to grow their families. But KPMG, the sponsor of the LPGA, is looking to change that. And join us now to discuss is 2-time major champion player of the year and LPGA player Stacey Lewis. Stacey, thank you so much for being here.
Yeah, thank you.
It's very interesting because you became the first well, first of all, you became a first-time mom. There's that.
Yes.
And then you also became the first LPGA player to be sponsored by KPMG while on maternity leave. Right. So 2 achievements.
Right.
2 big achievements.
First. We're knocking them off here.
Yeah, and we're not going to go ahead and make you compare the 2. But
yes.
I mean, when you look at it, why do you think you were the first to achieve that?
I just don't think anybody's really pushed the idea and pushed of, being a professional athlete and being a mom is not common. You know, it's a hard thing to do. It's, you know, being an athlete is hard on your body, and obviously having a baby is very hard on your body. So it's something that just nobody's really done. And, you know, just the way things are in today's society, we're talking about women more, and there's been this movement. And so, you know, I said, why not? And KPMG was lucky enough to be able to do it and be the first.
Yeah.
Yeah, the challenges of being paid for maternity leave extend beyond sports. I was actually reading an article recently about how airline industry has a sexism problem, and that's according to a lawsuit that's from 8 pilots and female flight attendants who are now suing Frontier Airlines for that issue because they have to go on unpaid maternity leave. So what is your view on like the overall country when it comes to, you know, the need for more maternity leave protections for women?
Yeah, I mean, I think you probably look at most companies and there's probably more that fall under that boat. You know, I just, having gone through the whole process, I mean, in a sport, you don't get paid unless you play. So that's the problem we're having. And you know, maternity leave, I think it needs to be at least 2 months, if not more.
Yeah, because the time is one of those questions too. And I mean, far be it from me. I'm never going to be a mother. I'm already admitting where I'm coming.
But
on
some
this.
men go on parental leave.
No, for sure. And we're talking about parental leave could be men too. But when we're talking about it, the time and how much time is right is one of those issues. I don't know if you saw Congresswoman Alexandria Ocasio-Cortez also slamming paid family leave policies. She actually tweeted about it, and she said puppies aren't separated from their moms until 8 weeks. Less than that is thought of as harmful or abusive. So one of the most common lengths of U.S. paid family leave is 6 weeks. So yes, when we let the market decide on parental leave, the market treats people worse than dogs, in her words. Your reaction to that?
I mean, I'd have to agree a little bit. You know, it's such a hard thing, and you know, you don't get that time back.
Yeah.
You know, they're only little for so long, and they need so much at that age, and physically, you're exhausted. And it's, I mean, I tried to go play a golf tournament at 3 months, and I was exhausted. You know, and that was out of my choice too. And I think a lot of women don't have that choice, and so let's give them the flexibility. If they want to come back to work, let them. If they need more time, then let's let that happen too.
I can 3 months pregnant. I can't even do a golf tour now. There's no way that I'd be able to do it.
No, that would definitely be challenging for you, Zach.
You'll see me golf.
But I just wanted to go back to what you were saying before. You said that you think you're the first who was able to be paid for maternity leave as a professional athlete because you advocated for it. But I have to ask, I mean, I feel like there are other women who have also advocated, but there are structural challenges in society for these big corporations when they sponsor athletes. We saw also another athlete complain about Nike sponsorships and what she has to go through. So what do you think women should do besides just advocating for themselves in terms of actually being able to achieve what you achieved?
It's what written into contracts, and what KPMG did is they went outside of the contract. There was nothing written into my contract that said we're going to pay you if you have a baby. It was more they decided we want to treat you like you're a member of our firm. That's what they decided. So it needs to be written in the contracts. That's what female athletes need to be proactive about it to protect themselves from that, because otherwise you're only going to get paid if you're running or if you're playing. You know, I played until I was 6 months pregnant, but you know, that time after is where it all comes in.
Very, very interesting to think about, not just from an athletics standpoint, but also from just a baseline case for all mothers and fathers out there, perspective included. But Stacey Lewis, thank you so much.
Thank you for having me.
Appreciate it. Very interesting stuff. Well, just after the break, we're moments away from the Fed's interest rate decision, what to be watching for, and why the latest reading of CEO confidence just fell for the 7th straight quarter in a row. Wi-Fi PM is back in 2. Welcome back. The CEOs of the nation's biggest companies released their quarterly economic outlook survey, and Yahoo Finance's Jessica Smith joins us from Washington, D.C. with the details. Jessica?
Well, Zach, the CEO said that uncertainty around trade, a slowdown in global growth, and the contraction in manufacturing are all reasons they are concerned about the U.S. economy and why we did see CEO optimism dip for the 7th straight quarter. CEO plans for hiring and capital investment over the next 6 months have decreased since last quarter, but plans for sales, CEO's expectations on sales have increased. Jamie Dimon, who is the chairman of the Business Roundtable for the next couple weeks, said that reflects a strong consumer. The CEO's survey said they expect to see about 2.1% growth in the U.S. next year. Dimon says he thinks that's about right, and he expects to see about 3% global growth next year. And he added the fly in the ointment, as he called it, could be trade. He told reporters that he does expect to see a phase 1 deal and a tariff delay, but he reiterated several times that he doesn't know. It's ultimately going to be up to the president. And he said that he thinks anything beyond a phase 1 deal, so a phase 2 or phase 3 deal, could be difficult. He did say that he doesn't think the tariffs will have a large direct effect on economic growth, but he did go on to say the real issue is the indirect effect, what happens to people's psyche and confidence in businesses, and those things we don't really know, but they would not be a positive. He was asked if he thinks the ultimate outcome of this trade war with China is going to be worth the short-term price, and he says we just don't know yet. And he said that we might not know for the next 5 years or so till you see how this plays out. But he did say if there is no deal overall, then that would hurt markets and GDP. Zach?
All right, Jessica Smith with the latest from Washington, D.C. Thank you so much. And now we have breaking news as we are just minutes away from the Fed's decision on interest rates. The central bank is widely expected to hold rates steady. And as we check the market action ahead of that official news, we're seeing things continue their mixed picture on the day with the Dow in the red, the S&P and the NASDAQ in the green for now. But guys, when we talk about expectations here, James, we opened the show saying that the wide expectation is that the Fed will stay steady, rates unchanged.
Yeah, I mean, the Fed is still an important driving factor in the markets and the economy. I mean, we're over a decade past the financial crisis, and they are still one of the driving forces. They are one of the biggest macro reasons the market is up over 25% this year, and that's probably not going to change in the near future.
And speaking of expectations, I'm looking at President Trump's expectations of what the Fed's going to do. So I looked at his Twitter feed shortly before, and he's too busy tweeting about impeachment. So that's his main concern right now. So it looks like the Fed can kind of go under the radar and basically keep rates steady. That's what the markets are expecting.
And we'll see what happens at 2 p.m. Of course, anything can change when things are official. But James Lewin, Sabeel Marcellus, thank you so much for joining me for the hour. And don't go away. We're headed to the New York Stock Exchange in just 60 seconds' time. Welcome back to Wi-Fi PM. I'm Zach Guzman. We are just minutes away from the Fed's interest rate decision, the last policy meeting of the year. Expectations widely held to be holding steady here, but we will get that official decision at 2 p.m. Eastern Time. We will also hear from Fed Chair Jay Powell stepping to the podium at 2:30 p.m. Eastern Time. And right now we're checking the markets. The Dow in the red, off by about 34 points. The S&P up by about 2. The NASDAQ up as well. Right now, real estate, the biggest loser. When we look at the sectors today, technology, one of the standouts, as again, we are awaiting that Fed interest rate decision at 2 p.m. Eastern Time. Of course, the markets have been mostly mixed today, with the S&P and the NASDAQ in the green, and the Dow, as we have seen since the beginning of the show, in the red as well. Let's head to the New York Stock Exchange on the floor there to check in with Scott Gamm ahead of the Fed interest rate decision. Scott?
All right, Zach, thank you so much. I am joined now by Alan Valdez, a partner with Silver Bear Capital. Okay, so market is in wait-and-see mode. Is this a relevant Fed meeting given where we are right now in stocks?
No, probably not. I don't think they're going to move one way or another. I mean, if you look at the jobs number last week, it was great, super, the best in half a century. And if you look at consumer spending, that was up. Consumer confidence was up. I mean, right across the board, there's no reason to move the needle in this meeting.
Okay, so looking ahead, though, I guess, where do you see stocks going in the next couple of months? Because we're still pretty close to record highs. I guess the question now is how much more upside is there?
Well, you know, I think if we get this deal done with China, that's a big if, and we get close, but they keep backing away, and we keep backing away. We did do the deal with Canada and Mexico. That's a good sign. So things are moving. I think you could see more upside. It all depends on the consumer. I think if we have a great season this year, and it looks pretty strong right now, robust, if the consumer spends and unemployment stays low like it is, those are the two main numbers that keeps this market on track.
Oh, and just very quickly, I mean, it is incredible. A year ago at this time, we were talking about a market correction. We were just days away from the Christmas Eve sell-off. Any reflections in the market over the past year or so?
Well, you know, you don't hear about that recession talk anymore. And I remember when the inverted yield curve, oh, we're going into recession. None of that ever came to fruition. And I think you're going to see the market continue to go up. And again, it's on the back of the consumer. That's the big key.
Okay. Alan Valdez, always great to see you. Thanks so much. And Zach will send it back to you.
All right, stay tuned to Yahoo Finance for complete live coverage of the Fed decision just moments away. The ticker starts in 2.
Good afternoon and welcome to the ticker on Yahoo Finance. Breaking news, the Fed decision on interest rates is imminent. We are going to be monitoring that. Fed Chair Jerome Powell is scheduled to speak in roughly 30 minutes from now. Taking a look at the markets here ahead of that decision, the Dow is down just around 30 points. The S&P and the NASDAQ are holding on to gains. Joining us now is Yahoo Finance's Adam Shapiro along with Stephen Skanke, Keel Point Chief Economic Advisor. Thank you both for being here. Stephen, I'm starting with you. We're not really expecting anything huge. What are you looking for in this?
Really nothing. This is a great opportunity for the Fed just to pass, say everything is good, as they said in their testimony. The U.S. is the star economy.
All right, Stephen, let me just interrupt you there. We are getting some headlines crossing now. Fed saying that rates are, quote, appropriate to support growth. Rates are unchanged. The dot plot signals a hold through 2020. Adam, you're also looking at the headlines here.
Yeah, and as that comes through, the big thing that the market's going to like is the hold through 2020. Now, they can change it, but the key is that you heard Powell say as recently as, November 25th, we see the current stance of monetary policy as likely to remain appropriate as long as incoming information about the economy remains broadly consistent with our outlook. So I would imagine one of the key questions he's going to get is about the trade war with China, because that could throw a kerfuffle into a hold for 2020.
Yes, this forward guidance of keeping it where they are through 2020 is really helpful to the markets. It's a little bit new, not totally, but a little bit new. And of course, it always depends on what the data do or what external event just swings in.
Anything to be read of the fact that they took out the word uncertainties around the outlook? Are they more certain that 2020 will be a kind of stable year?
Well, they certainly can have a lot of confidence. Already they're seeing the impact of their rate cuts coming into the economy. The fact that the Atlanta Fed has already raised its fourth quarter expectation for GDP growth from 0.3 to 2% signals a confidence building in. And then with consumer confidence, small business confidence, and the jobs number, I think they feel pretty good and pretty safe in taking out that.
Well, let's head down to Brian Chung. He's standing by from D.C. with more on this. Brian?
Hey, good afternoon, Shauna. So the big news out of the Federal Reserve this afternoon that they did hold rates steady at the current range of 1.5 to 1.75. Not much really changed in the statement as far as what the Fed saw on inflation and also on the labor market. They did continue to describe the labor market as remaining strong, did describe inflation as remaining low. But the Federal Reserve did change the middle part of the statement where they said that they did maintain the target range. They used the new language saying that the committee judges that the current stance of monetary policy is appropriate to support sustained expansion of economic activity. So that is new language, but not necessarily new from what we've heard in public speeches from Chairman Powell and other Fed speakers in the past few weeks. It seems like they have been messaging to markets that they would not be moving in this particular meeting and would like to see what the effect of their 75 basis points of total cuts this year will do to the economy, saying that monetary policy does operate on a lag. But just pointed out in the segment before I hopped on the phone, but they did indeed remove some language relative to the October statement that was the last meeting 6 weeks ago. That October statement said that the outlook rather had some uncertainties still facing it. The Federal Reserve did remove that language, so make of that what you will, but it seems like maybe there is some optimism among the Federal Reserve that maybe some of the trade concerns and other downside risks have actually abated since that last meeting over the past 6 weeks. A few things worth noting in terms of the summary of economic projections. They do have a median dot for 2020 in the middle of the 1.5 to 1.75 range, meaning that that median dot is predicting no move either up or down by the end of next year. However, the 2021 and 2022 dots do note that there could be one hike in each of those years. But worth noting that the dot plots have not been a very good, reliable indicator of what the Fed's going to do. If you recall back to December 2018, that actually signaled that the Federal Reserve may have rates in the neighborhood of 2.75 to 3% this year. Obviously not the case now that we're at 1.5 to 1.75%. The last thing worth noting is that they do expect a tighter unemployment rate, a tighter labor market through 2020. In September, they projected that the unemployment rate by 2020 would be 3.7%. They've since revised that down to 3.5%, reflecting this continual view at the Federal Reserve that the labor market is getting tighter than maybe the economists inside had thought previously. As far as inflation, they project the same, that they expect to hit their 2% inflation target in 2021 and 2022. Shauna?
Hey, it's Adam, Brian. Two quick questions for you, and this one might be an easy one. But regarding Kashkari, who had been pushing for interest rate cuts and then gave a speech in November in which she said, look, we should be committed to not raising rates and signal that to the markets. Is there anything that would indicate to you, other than the dot plot, that he is really on the lead here? Because others had expressed his interest, but they never seemed to put their money where their mouth was.
Well, for right now, Adam, it seems like Kashkari is back in line and saying that he actually doesn't see the case for another cut right now. This is one of those rare meetings where we'll be able to actually find out where each member, not just the voting member, each member of the Federal Open Market Committee stands in terms of where they think rates should be, because we have the dot plot projection. If you look at 2019 and the new dot plots, it's a straight line. There are no dots that are outside of the 1.5 and 1.75 range, meaning that all 17 members of the FOMC decided that this is the proper level to keep it at. So yes, Kashkari and some others, I would include James Bullard at one point, saying that maybe there should be a case for further accommodation. That doesn't appear to be the case. Pretty remarkable when you consider that Chairman Powell actually faced record dissent as chair earlier this year when they were cutting rates. There was one meeting where you had James Bullard dissenting because he wanted 50 basis points of cuts, but then you had Esther George and Eric Rosengren actually arguing for a 25 basis point hike. So that divergence on the committee has actually come back together now that the Fed has already implemented these 75 basis points of cuts, meaning that both the hawks and the doves might be falling in line with Chairman Powell as they decide to wait and see as they go forward.
All right, thanks there, Brian. Stephen, I want to bring you back into the conversation here. When we talk about what is driving the Fed's decision right now, how much do you think it has to do with the bond market? Is that what the Fed is basing their decisions on right now?
Well, they certainly see the confidence there, and that is helpful to them. But if you just look at what's changed since their last meeting, all of the good economic news, some of it really unexpected, the jobs number in particular, and then consumer confidence, consumer sentiment from Michigan surveys, and even the small business optimism index are just unexpectedly up, even in view of the continuing turmoil around trade.
Miles Udland wrote about this in the Yahoo Finance Morning Note, where he talked about the fact that the unemployment rate is at 3.5%, but the natural rate of unemployment, which the Fed always looks at, is now they're predicting is going to be around 4.1%, which is down from 4.2% in September. I think the takeaway from his note was that should be a recipe for inflation. They haven't got inflation right at the Fed, as was pointed out 2 hours ago on Yahoo Finance, in almost 10 years. What's not working? Because something's not working in their formulas that help them create monetary policy.
I think it's hard for anyone to understand. It's just a different economic environment. And there's a lot of speculation as to what's causing these things, whether it's globalization or the way people are being hired. Are jobs really a substitute for capital investment? Is the competition for jobs and lower wages sufficient to prevent the level of wage increases that might be inflationary? I think the Fed just doesn't know. I agree with what you said as to the change in these statistics, but so many other things are contradictory in the way these data are moving that it would be hard to pin it on that.
You know, the other issue when we talk about the dot plot, has the Fed now unintentionally or intentionally signaled to Wall Street, you're not getting a rate increase for a year, but they may have to do that, and that the dot plot doesn't really serve a good purpose, because now we're going to have a lot of people making investment decisions, whether it be into equities or whether it be into bonds or whether it be into real estate, based on what we're talking about today. And that dot plot could be setting them up for a big hurt if they do have to make a change.
Well, I think that's the Fed's objective, is to get people to make these decisions to invest. That is a primary goal of the forward guidance that they've given us in stronger terms than we really have seen in the past. That they're going to keep rates low. They're not going to change them through 2020, hoping that that'll provide the confidence. The big drag on economic growth has been in business fixed investment. And there's obviously a goal to get that recalibrated to be a positive contributor.
Stephen, one of the hot topics that Jerome Powell will likely be asked about is the repo market, whether or not that is a major issue as it stands right now. What's your take on that?
I think they don't have it figured out yet. It's a big challenge. You know, they've added over $300 billion in liquidity without calling it quantitative easing, even though that's what it is. But there may be something structural within it that we just can't see.
You're the second person who understands these issues very well. The other one was Mohamed El-Erian, who said just what you just said. They don't call it quantitative easing. They do backflips to avoid calling it that. How they'll know this is nothing. And that's exactly what it is. Why won't they say that?
Because they don't want that to be the explanation of what it is that they're doing. They're trying to maintain a neutral stance, and quantitative easing obviously is not neutral.
Well, they're attempting to lower interest rates through that vehicle as opposed to the cutting of interest rates. And that's essentially part of what quantitative easing does.
Yes, and they would like very much, obviously, in what they're doing, to avoid having to admit that. But something that they have done has created this imbalance in the markets. And whether it's from the tightening they did before, whether it's from the way interest rates are operating, or just the movement of liquidity as a result of negative interest rates in Europe and Japan.
All right, Stephen Skanke, thanks so much for joining us here. I want to head down to Scott Gamm. He's standing by on the floor of the New York Stock Exchange. And Scott, when you take a look at the market's reaction, the Dow almost erasing its losses for the day.
That's right, and the S&P moving back near the highs of this morning, at least intraday. But we should preface that any time we talk about market reaction to Fed days, that reaction, if there is any, has historically, at least under the Powell era, come during the press conference, which starts at 2:30. You really historically don't get much reaction after that initial 2 p.m. decision and statement, especially during a Fed meeting like this one, where we really weren't expecting any decision on interest rates, and of course we got no movement on rates. The statement released at 2 p.m. was pretty benign, only 313 words, so it was also pretty short. When you talk about the best performing Dow stocks right now, those are names like United Technologies, Apple, Johnson & Johnson, and Caterpillar. But of course, on Fed days, it's not just stocks we look at. We got to look at bond yields as well. So take a look at the 10-year Treasury yield, which fell slightly after the 2 p.m. decision, but it's still relatively above 1.8%, which sounds low, and it is low. But remember, just as recently as August, the 10-year yield fell below 1.5%. So it's certainly recovered quite significantly over the past couple of months. Shauna.
All right, thanks, Scott. Well, for more on the Fed's decision here, let's bring in Andrew Levin, Dartmouth College economics professor. And Professor, when you take a look at what the Fed just released here, signaling that there will be no action or they will be on hold through 2020, do you think that is the right call?
Okay, so one thing that's really important is to look back over this past year. Remember, a year ago, the Fed was expecting to hike more or less 2 or 3 times. That would have brought interest rates up to around 3%. Here we are in a world where they actually cut several times this year, and the short-term interest rates are around 1.5%. That's a huge shift. 1.5 percentage points, that makes a real difference to the economy. A year ago, we were really worried about recession, inverted yield curve, and so forth. Now I think that, as others have said, the latest indicators are pretty clear that some of the uncertainties have subsided. Some of the worst downside risks have subsided. There's still some concerns. I don't think the Fed can relax or kind of take its eyes off the off the horizon, but for the time being, the shift that they've made over this year was really important. Now, looking forward, what's the mistake they've made consistently over the last 10 years was relying on inflation forecasts every year, almost every year, inflation being around 1.5%, and they were expecting it to be up around 2% within a year or two. Same story today. Actual inflation by the Fed's preferred measure is about 1.5%. They're expecting it to jump up to 2% next year. Not completely clear why, if the sustainable unemployment rate's around 4%. Maybe actual unemployment's a little below that. Maybe there's still...
Can I interrupt you?
Need to make adjustments. The bottom line is, I think that as someone else said, they need to improve the dot plot. They need to think about alternative scenarios. And one scenario is they need to do further rate cuts over the next year or two to put some more upward pressure to bring inflation back up to the target.
Professor, help us understand. What they're essentially signaling us is next year, status quo. This is a great low interest rate environment for all kinds of people. But there's this issue that we touch upon that no one wants to call quantitative easing, but the repo markets where they're adding liquidity. And then we got the report from BIS, which was they don't really understand why banks are not lending to one another. I'm going to ask a question that has to do with banks lending to us. Do we see the banks lending appropriately to the average consumer? And if they're not, wouldn't it have made sense for them to perhaps maybe lower the interest they pay to the banks on the reserves and excess reserves? Or, we're all trying to understand what's happening with, quote, liquidity. And things are not freezing, but they're not flowing the way they should be.
Right. So let's distinguish a couple things. One is the Fed's got a general stance of policy. Think of that as the general level of short-term interest rates. And then there's fine-tuning, which is to make sure that the federal funds rate targets at the actual federal funds rate's at the middle of the target range, that the repo rate is not too far from the federal funds rate target, and other short-term rates, Treasury bill rates, are all more or less reasonably well aligned. And the problems we've had in the last few months is that some of those rates, in particular the repo rate, have been moving out of line. And so I wouldn't call it quantitative easing, because quantitative easing, that term has been used to describe monetary stimulus, where you're actually trying to promote a stronger recovery, stronger real economy, push up inflation. That isn't what they're trying to do right now. They're trying to do fine-tuning to adjust the total amount of liquidity through the reserves and the repo facilities to try to keep these short-term interest rates in reasonable alignment with each other, which I think is important. But it's not the bigger macro picture. Now, the bigger macro picture you're describing here is to what extent is the current financial conditions facilitating credit to small businesses and consumers. We could talk about that. I think it's a distinct issue from the repo market narrowly.
Professor, I just want to go off on what you were saying before. So as it stands right now for the Fed's policy, you said that it's enough to foster a strong labor market, also just in terms of keeping economic growth consistent into next year. When you take a look at your projections in terms of what you are expecting in 2020, where do you see the economy next year?
Okay, so I think that at this point, I'm assuming that unemployment should stay around 3.5 to 3 3/4. Of course, it moves around from month to month, but we should be careful when we say strong labor market. At one point, the Fed thought that the sustainable unemployment rate was 5.5%, and that having unemployment go down to 4 or 3.5 would be dangerous, that it would cause overheating and wage inflation and price inflation would zoom out of control. If in fact the sustainable unemployment rate may be 3 3/4, maybe 4%, somewhere near the current range, that means the labor market's healthy. But it doesn't mean that it's overheating. And that also means that we can expect inflation probably next year to be not very much different than it is today, which is good news in many ways. The only reason it's bad news is because the Fed keeps emphasizing in its statement that they have a symmetric inflation target. What they mean by that term symmetric is half the time it would be inflation above the target, the other half of the time below. And consistently, year after year, for almost all the last 10 years, it's been on the low side of it. And it doesn't seem like they're ready to take action to fulfill the words. The words are, we have a symmetric target. Where's the actions to back it up? That's my question for next year.
Well, when you talk about that, there have been some people who've said it's time for them to give up the inflation target because, as we've talked about a couple of times, that hasn't really been that accurate over the last decade. Does it serve them well, or is it time to let go of it? Because we lived in a world without it if you go back to before 2008.
Okay, so I'm a teacher. Doing things like grade inflation is something we generally try to resist. So you say, well, we're missing the target, so we're just going to change the target or get rid of it. Usually not a good solution to a problem. A doctor would say the same thing if you have high blood pressure or overweight or some other, you're not getting enough exercise. Don't just change the target to fit the reality. Think hard about the target. Now, I think there are alternative frameworks. The Fed's considering some of those. I'm a little worried that they're going to change the framework in January, but it'll just be more words and no actions to back it up. The new framework that they're talking about is to try to hit inflation on average at 2% over periods of 5 and 10 years. The question then is, are they going to start that new going forward? Or are they going to look back at the extent they've missed the target the last few years? It could, in effect, become a way of doing great inflation, or it could really help make things more transparent. Normal investors, businesses, need to understand what the Fed's trying to do. What's its goals? What's it aiming for? What's the strategy that it's following to try to get that? And I'm guessing that in today's press conference, and probably even more so in January, there will be a lot of questions for Chair Powell. What do you mean by the symmetric inflation target? And how are you going to get there? Or do you want to just give up and get rid of the target and go back to the days when the Fed didn't say what it was really trying to do?
Certainly, we'll expect to hear more on that in just around 10 minutes from now. Professor, thanks so much for joining us today.
Thank you.
Well, amid all of this Fed news, we want to take a quick check on some of the big tickers that are making waves today. First, we have Saudi Aramco. Its shares are soaring in its public trading debut on the Saudi Stock Exchange. Now, its market value hitting nearly $1.9 trillion, making it now the world's biggest listed company. Aramco raised $25.6 billion from the IPO. Also in focus, we have GameStop. Now it's nosediving after posting a huge miss of expectations in its latest quarter. The company primarily blaming a, quote, unprecedented decline in new hardware sales across the video game industry for its woes. We also have Home Depot. It's in the red today after warning that its 2020 sales growth will likely come in below Wall Street expectations. The company citing signs of weakness in the housing market and disappointing payoff so far from its One Home Depot strategy to better integrate its online and brick and mortar business. Well, checking in on the broader markets, taking a look at the major indices, it looks like the Dow has erased its losses for the day, trading in the green. Jared Blickery is at the Wi-Fi Interactive board for more on this. Jared.
Yeah, so stocks got an initial pop at 2 p.m. on the decision time. We can see the Dow is now in the green, but only single digits here, 2 basis points. S&P 500 is up 0.25%, NASDAQ up about 1/3%, and the Russell 2000 still in the red here. So this is today's price action. We can see that we gapped down, briefly got in the green here, came down, made a new session low, and this is that FOMC pop that we got right here. We retraced a little bit and then continued in the same direction, but overall, not a big movement for the day. Let's take a look at the 10-year T-note yield, because this is where the action usually is. And here we saw that the 10-year T-note yield was down about 2 basis points. We did get an initial pop here, but really not too much movement. And to be fair, a lot of the movement usually happens at 2:30. That's about a few minutes from now when Jay Powell takes a podium and starts answering questions. He's been okay the last couple times, haven't had any major disasters, but we have seen him make some gaffes before. Let's take a look at gold too, because gold was popping earlier, and we can see at 2 p.m. we actually got an impetus higher. That's pretty interesting. So we made new session highs on the day for gold futures. Let's take a look at sectors here. So for today, we have materials. They are in the lead by 0.6%. Technology is up 0.5%, and industrials are up 0.5%. Now, since 2 p.m., we saw energy, tech, and financials make the biggest move to the upside. And then we're also going to take a look at consumer staples. That was making session highs or new record highs not too long ago, but that's barely in the green today. Guys?
All right, thanks, Jared. Well, joining us now is David Burson. He's Nationwide's chief economist. And David, we heard what the Fed was saying just in terms of holding rates steady where they are right now. Nothing changed there, signaling no hikes next year in 2020. When you take a look at the Fed's current policy, do you agree with them as it stands right now?
You know, given that the economy is growing at about trend and inflation is pretty close to their target, there's really no need for them to make a change, at least not in the near term.
And then when you look ahead, just in terms of what we want to hear from Fed Chair Jerome Powell, he will likely be asked about the repo markets, just whether or not that should be a major concern as it stands. Do you think that that's something that investors are closely watching at this point?
Well, I think investors are watching it. Hopefully, it's just a short-term concern that we get into the new year, and the liquidity concerns that we have with the repo market will fade away. But I think it's something that Chairman Powell will be asked about. You'll have to give a pretty clear answer.
And how much do you think of the Fed's decision today? How much of that has to do with trade? Because they did remove the language just in terms of uncertainties in the economic outlook, but we still are far from any sort of resolution when it comes to the latest between the U.S. and China.
Well, they may remove the language, but I think we're all still very uncertain about what will happen with trade and what the impact of that will be on the economy and ultimately on inflation. I think that the members of the Federal Open Market Committee are still probably pretty concerned about what will happen either to the downside or the upside, but more to the downside. And that while it may not be in the statement anymore, they're clearly looking very closely at that.
When you talk about inflation, and the Fed is predicting 2020 inflation to run about 1.9%, we've talked about the fact that they haven't actually hit that target. There are other people who say it's time to either change the formula or get rid of the inflation target and just go back to an implied target. What do you think Wall Street is expecting the Fed to do? Stay the course for another year or two and still miss inflation targets?
I think that the Fed probably will stay the course on that. The question is, how close can you get to 2%? with the policy tools that the Fed has. I mean, we're at 1 3/4 using the PCE price index. We're at 2 using the CPI. Can we actually get closer, or by trying to get closer, do we go over too much? I think the Fed probably ought to declare victory on inflation and give a range. You know, we'd like to get to 2, but if we're between 1 3/4 and 2 1/4, which is where we are, we've hit it just about right. And they ought to declare victory at this point and say, we're not trying to drive it higher. We want to make sure it doesn't go lower. But given that growth is around trend, unemployment is at 50-year lows, and inflation is so close to its target, why should we do anything different? Why should we make any changes?
All right, thanks, David. Well, for more on the Fed's decision, let's bring in David Nelson, Bell Point Asset Management's chief strategist. We also have Tony Rodriguez, Nuveen's head of fixed income strategy. And David, when you take a look at the market's reaction to the Fed's decision today, the Dow trading slightly positive now. Is this what you think investors wanted to hear from the Fed?
Look, coming into this, there was no drama. Everybody was expecting this. There are no surprises here. I could have told you that I spent the whole night crunching numbers, trying to figure out what the Fed was going to do today. And obviously, I didn't do that. No need to. They've kind of telegraphed this all along. Most notably, I'm looking at this press release from the Fed, and they point to one thing very clearly. It says the cost of war. And the cost of war is business fixed income, the fixed investment, and exports remain weak. And that's obviously what's happening with our trade dynamic with China.
I have a question that might be very basic, but I'm curious, why do we get stuck on this inflation target of 2%, and the Fed certainly is stuck to it? Why is 2% the magic number? Why not 2.5 or 1.5 or 3? Who came up with 2%? It was implied, and then they said it.
Well, I think the magic was that they all agree that 3 is too high, and they all think that 1 is too close to their 0 and deflation. So there's a little combination here of you don't want to get into the deflationary spiral that Japan has been in for so long, so you have to be far enough away from that. But once you start getting to 3, and if you think symmetric from there, suddenly it's 3.5 in play. So I think that's how they got there, although they have a lot of more mathematics behind it.
Other than a few one-offs, they haven't been above 2. I think
there's a principal reason for that. Now, we can point to energy. Energy is the elephant in the room when we talk about inflation. It touches every fabric of the economy. And with OPEC as a cartel-like structure, virtually absent at this point and unable to do anything, I think energy prices are likely to remain subdued for some time to come.
I mean, what do you see as the biggest risk to what the Fed is saying right now? Is it the potential fallout from trade? If we don't see some sort of deal or a delay in tariffs by that December 15th deadline, it's Sunday, it's only a couple of days away. Is that a big risk to the economy?
I think it is. I mean, we were talking about trade and global manufacturing recession. On the recession front, we've gotten better data from a lot of places on the globe, better in the U.S. included, so the recession risk has declined. The trade risk, while we are certainly making what we would call some progress as we're talking about a potential phase 1, we've seen this story before of announcing that a deal is imminent and then backtracking kind of 3 steps forward, 4 steps back. So we definitely want to see the whites of the eyes of a trade deal. We don't think it'll be a significant enhancement to trade conditions with China, but we do think if it can reduce the downside risk of imposing tariffs, raising tariffs, which really hurts business investment, business confidence, then you have maybe a better runway in 2020 for a reasonable growth picture globally.
I'm not sure that even if it was pushed out and we got that a tweet, say on Sunday, that it had fallen apart, there'd be the knee-jerk reaction down, but we'd likely recover. I look at the market right now, it looks more like a market coming out of recession, not going into one. All year long, we've had this recession dynamic, almost obsessed with it, and it went from possible to probable to a groupthink certainty, and yet the economy remains relatively resilient, and I think a lot of investors understand that China, as an adversary in every sense of the word, will likely be that way for some time. So we're digesting it at this point. We're going to learn to live with it.
What do you think is the one thing that investors want to hear from Jerome Powell at the press conference here that's expected to get underway in just under 2 minutes?
I think we probably most want to hear that the bar for raising rates remains high. He made those comments before us, and I think he will probably support that again. And I think number 2, we want to make sure that in terms of any of the long run thinking with these summary of economic projections, that the terminal rate is one that is viewed as remaining steady to lower. Our view is that it is kind of lower for longer, and that kind of interest rate picture, I think, helps support not only macroeconomic conditions, but also financial market conditions.
David, what's your projection for economic growth next year?
Tell me who the president is in 2020. I really can't make one. My crystal ball can probably go out to maybe January at this point.
Real quick, shouldn't this market be trading higher based on the fact that they've just been told don't expect interest rates to go up?
I don't think the market's going to do anything until after Sunday. I think we're kind of like in a relatively shallow range. You know, tariff fears, however you want to look at it. I think what he's going to have to address in this conference, he's going to have to address the repo market and QE, because it walks like a duck, it talks like a duck. It's QE.
We just had a professor tell us it wasn't. Just said it's not. I mean, we also had Mohamed El-Erian.
It's QE. The balance sheet has grown from 3.8 trillion to 4 trillion in just a couple of months.
Yes, and it has the same effect. It drives down the short-term interest rates.
I don't know how you can call it anything other than that.
Maybe it's QE light because they're not buying out on the long end of the curve, for example.
That's feeling tastes great. That's what you're saying.
Exactly. And kind of the intent is a little bit different, whereas the intent was to goose the economy. The intent here is to help support kind of short-term monetary conditions.
All right, we're going to leave it there. Tony and David, thanks for joining the show today. We have Jerome Powell's news conference getting underway in D.C.
Begin, I'd like to say a few words about Paul Volcker, who, as you know, passed away earlier this week. Paul Volcker served as Federal Reserve Chair from 1979 to 1987. He accomplished many things during his long and distinguished career at the Fed and elsewhere. Of course, he's best known for leading the fight to tame the double-digit inflation that he inherited as chair, thus laying the foundation for the prosperity and price stability we enjoy today. But what is perhaps most admirable about him, more than his many accomplishments, was his character. He believed that there is no higher calling than public service, and he dedicated the lion's share of his life to it. With courage, integrity, and tenacity, he always pursued the policies that he believed would ultimately benefit all Americans. My colleagues and I continue to draw inspiration from his example. Turning to today's meeting, my colleagues and I decided to leave our policy rate unchanged after lowering it a total of 0.75 of a percentage point at the previous 3 meetings. As always, we base our decisions on judgment of how best to achieve the goals Congress has given us: maximum employment and price stability. Our economic outlook remains a favorable one, despite global developments and ongoing risks. With our decisions through the course of the past year, we believe that monetary policy is well positioned to serve the American people by supporting continued economic growth, a strong job market, and inflation near our symmetric 2% goal. The economic expansion is in its 11th year, the longest on record. Household spending has been strong, supported by a healthy job market, rising incomes, and solid consumer confidence. In contrast, business investment and exports remain weak, and manufacturing output has declined over the past year. As has been the case for some time, sluggish growth abroad and trade developments have been weighing on those sectors. Even so, the overall economy has been growing moderately. And with a strong household sector and supportive monetary and financial conditions, we expect moderate growth to continue. As seen from FOMC participants' most recent projections, the median expectation for real GDP growth slows slightly over the next few years, but remains near 2%. The unemployment rate has been near half-century lows for well more than a year, and the pace of job gains remains solid. Participation in the labor force by people in their prime working years, ages 25 through 54, has been increasing, and wages have been rising, particularly for lower-paying jobs. People who live and work in low- and middle-income communities tell us that many who have struggled to find work are now finding new opportunities. Employment gains have been broad-based across all racial and ethnic groups and all levels of education. These developments underscore for us the importance of sustaining the expansion so that the strong job market reaches more of those left behind. We expect the job market to remain strong. The median of participants' projections for the unemployment rate remains below 4% over the next several years. Inflation continues to run below our symmetric 2% objective. Over the 12 months through October, total PCE inflation was 1.3%, and core inflation, which excludes volatile food and energy prices and is a better indicator of future inflation, was 1.6%. While low and stable inflation is certainly a good thing, inflation that runs persistently below our objective can lead to an unhealthy dynamic in which longer-term inflation expectations drift down, pulling actual inflation even lower. In turn, interest rates would be lower as well and closer to their effective lower bound. As a result, the scope for interest rate reductions to support the economy in a future downturn would be diminished, resulting in worse economic outcomes for American families and businesses. Against the backdrop of a strong economy and supportive monetary policy, we expect inflation will rise to 2%. The median of participants' projection rises to 1.9% next year and 2% in 2021. We're strongly committed to achieving our symmetric 2% inflation goal. Over the course of the past year, our views about the path of interest rates that would best achieve our employment and inflation objectives changed significantly as the economy faced some important challenges from weaker global growth and trade developments. As the year progressed, we adjusted the stance of monetary policy to cushion the economy from these developments and to provide some insurance against the associated risks. In addition, inflation pressures were unexpectedly muted, strengthening the case for a more supportive stance of policy. Rather than modestly increasing the target rate for the federal funds rate this year, as seemed appropriate a year ago, we reduced it by 0.75 percentage point. This shift has helped support the economy and has kept the outlook on track. The median of participants' projections for economic growth, the unemployment rate, and inflation are little changed from a year ago, aside from a lower inflation projection for 2019. Of course, that is the function of monetary policy, to adjust interest rates to promote employment and price stability in response to forces acting on the economy. We believe that the current stance of monetary policy will support sustained growth, a strong labor market, and inflation near our symmetric 2% objective. As long as incoming information about the economy remains broadly consistent with this outlook, the current stance of monetary policy likely will remain appropriate. Looking ahead, we will be monitoring the effects of our recent policy actions along with other information bearing on the outlook as we assess the appropriate path of the target range for the federal funds rate. Of course, if developments emerge that cause a material reassessment of our outlook, we would respond accordingly. Policy is not on a preset course. Finally, I wanted to note that we've been purchasing Treasury bills and conducting repurchase operations consistent with the plan we announced in December. These technical operations are aimed at maintaining an ample level of reserves and addressing money market pressures that could adversely affect the implementation of monetary policy. Our operations have gone well so far. Pressures in money markets over recent weeks have been subdued. To address possible pressures in money markets over the year end, we've been conducting term repo operations spanning year end. We stand ready to adjust the details of our operations as appropriate to keep the federal funds rate in the target range. Thank you, and I'll be happy to take your questions.
Howard Schneider with Reuters. Sorry about that. So I was struck by the sort of disconnect that exists here between the behavior of unemployment and inflation. You seem to have unemployment penciled in here now for 3 years running more underneath the longer run level, yet inflation never really accelerates. So what are we to make of that?
Well, that's what's happening there is the fact that the relationship between resource utilization or unemployment and inflation has just gotten weaker and weaker over the years. If you go back 50 years, you would have seen that when labor markets were tight and unemployment was low, inflation moved right up. And then as the Fed got control of inflation, the connection got weaker and weaker and weaker to the point where there's still a connection, but it's a very faint one. And what that suggests is that you would need to keep policy somewhat accommodative, and we believe that policy is somewhat accommodative. And we think that that's the appropriate place for a policy to be in order to drive up inflation.
Follow up on that. I mean, it's faint and non-existent, though, it seems to me. So this suggests that really your policy lever as it exists now isn't really influencing prices at all. So in that case, what do you do to reach your target?
Yeah, no, I don't think that's right. I mean, again, the relationship between slack in the economy and inflation is weak, has been weak. The coefficient is something like 0.1, so it's much, much lower than it used to be, but I don't know that it's gone down any more in the last decade. It just is quite faint, but it's still there. I mean, you can see it. If you look at where wages were 3 or 4 years ago, they were running around 2%, and now the whole group of different wage measures that we monitor has moved up to 3 and 3.5%, and that suggests tightening. The same thing is true, but much less true of inflation. The relationship between, in a way, the wage Phillips curve has a higher coefficient than the price Phillips curve does. But we do still see some relationship, and that's what you're seeing in those numbers.
Mr. Chairman, Steve Leisman, CNBC. You've used the analogy to 1998 to describe the rate cuts we just went through. And I'm wondering if we can sort of continue the analogy. Within 7 months of those 98 rate cuts, the Fed took them back and then some. So were those kind of rate cuts the kind that you need to take back? Or are we at a place now where we're at a neutral rate? Take back, I mean, if those risks that you say we're cushioning from don't materialize in the way you think. Or is this now a new sort of steady state for the economy at this rate? This is the right rate for the economy that you see going forward and don't need to take those rate cuts back?
So there's similarities, conceptual similarities, I think, between the two instances during that long expansion, I guess in 95 and 98, when the Fed cut 3 times only to resume raising rates. And the notion just is that the economy needed slightly more accommodative policy, but it wasn't the end of the expansion, right? And that's the same situation we believe we're in here. So we did in fact turn out to do 3 rate cuts. That wasn't in the plan, in any kind of specific way at the beginning. So that's the same. What's different is you have very different structural characteristics in the economy, particularly around inflation. So now, as you can see, inflation is barely moving up, notwithstanding that unemployment is at 50-year lows and expected to remain there. So the need for rate increases is less. And by the way, it's a good thing that we think we can. I think we've learned that unemployment can remain at quite low levels for an extended period of time without unwanted upward pressure on inflation. In fact, we need some upward pressure on inflation to get back to 2%. It's quite different in 95 and 98 when there were those two adjustments. So I would say similarities and differences.
BIS concluded in, I did the same thing as Howard. Michael McKee, Bloomberg Radio and Television. The BIS concluded in September that the repo spike was not a one-off confluence of random events, but reflected structural and regulatory issues that could lead to a recurrence. I'd like to ask you if you agree with the BIS findings, and given that we're approaching year-end for the markets, will you be taking any extra steps to ensure that funding is available in the repo and FX swaps markets? There was a report yesterday from Credit Suisse suggesting there's a good chance that we will see disruptions. And one of the reasons they put for it is that the Fed is, at this point, buying only T-bills, and the market wants to sell coupons. Do you have any plans to sell coupons?
So I'm going to take a little step back, and I will get to your specific questions on the year-end and on T-bills. So I guess I want to start by stressing that these are very important operational matters, but that are not likely to have any macroeconomic implications. We decided back in January to remain in an ample reserves regime, and that means we will be setting the federal funds rate, the range for the federal funds rate, through our administered rates and not through active management of the level of reserves. We're committed to robustly implementing that framework, as you can see by our actions. And the purpose of all this, let's remember, is to assure that our monetary policy decisions will be transmitted to the federal funds rate, which in turn affects other short-term rates. We have the tools to accomplish that, and we will use them. The purpose of all this is not to eliminate all volatility, particularly in the repo market. So taking you back, as you know, we'd very gradually allowed the balance sheet to shrink. We slowed that gradual pace by half in March, and then we ended it in July. Meanwhile, we had surveyed all of the banks, and particularly the large banks who hold a lot of the reserves, and said, what's your lowest comfortable level of reserves? We got those numbers, we added them up, we added a buffer, and it came out sort of at a level that was well below when we were in September. And yet, we saw actually in September that the markets acted as though reserves had become scarce. So what had happened was that liquidity, which actually existed, didn't flow into the repo market, and that had effects on the federal funds rate. So the question is, why did that happen? And we've been very carefully looking at the reasons why that might have happened. There are payments issues. There have been a number of supervisory and regulatory issues raised. We're looking carefully at those. We're open to ideas for modifying supervisory and regulatory practice in ways that don't undermine safety and soundness, and a number of ideas are under examination there. To go through it sort of in time, we started off really on September 17th with overnight operations. By October 11th, we had created and put into effect a plan. That plan is in effect. It's working. I think for the last couple of months, repo markets have been functioning well. Short-term rates are stable. Markets are functioning. So you asked about year-end. Temporary upward pressures on short-term money market rates are not unusual around year-end. And both our repo operations and Treasury bill purchases are intended to mitigate the risks that such pressures pose to our control of the federal funds rate. We think that the pressures appear manageable, and we stand ready to adjust the details of our operations as necessary to keep the federal funds rate in the target range. Our strategy has been essentially the key to our strategy is to supply reserves in the near term through both overnight and term repo. And at the same time, we're raising the underlying level of reserves through bill purchases. I'll take that now. We've said bill purchases. We've also said that we were willing to adapt our strategy. We're not at this place, but if it does become appropriate for us to purchase other short-term coupon securities, then we would be prepared to do that if the need arises. So, but we're not in that place. It very much looks like those bill purchases are going well, just according to expectations. I mean, the other thing I'll say is that we're in, very regular contact with market participants all the time. We'll be continuing that, and we're prepared to adjust our tactics. We're focused on year end as well, and prepared to adjust our operations as appropriate.
The follow-up to that would be, where are we with the possibility of a standing repo facility?
So on the standing repo facility, as you know, we've actually had a couple of meetings where we've discussed that. I think the standing repo facility is something that'll take some time to evaluate and create the parameters of and put into place. At the moment, what we're focused on is, we're now focused on year end. I should also mention that after year end, the sense of it is that as the underlying level of reserves moves up because of bill purchases, as that happens, there will come a time when it will be appropriate for overnight and term repo to gradually decline. We can't know today what the timing of that will be, but that's the way we see it going over time.
Heather Long from The Washington Post. A number of your colleagues have said explicitly that they do not think the FOMC should raise interest rates until core inflation is back at 2%. They think there should be a rule. Where do you personally stand on that?
Well, as I mentioned actually at the last press conference, we think our policy rate is appropriate and will remain appropriate as long as incoming data are broadly in keeping with our outlook. And in order to move rates up, I would want to see inflation that's persistent and that's significant. A significant move up in inflation that's also persistent before raising rates to address inflation concerns. That's my view.
So is this the de facto policy of the committee then? I guess I'm wondering why it's not sort of codified in a statement.
We haven't tried to turn it into some sort of official forward guidance. It happens to be my view that that's what it would take to want to move interest rates up in order to deal with inflation.
Gina. Hi, Chair Powell. Gina Smiley with the New York Times. Just following up on Heather's question. So if you look at the SEP today, it looks like inflation is never overshooting 2% and is only getting up to 2% by the end of 2021, yet rates are increasing in 2021. So I guess how do we square that circle with interest rates increasing before inflation ever really moves up in some meaningful overshooting way?
So I think what you're seeing is you've got a full year of the median being flat, which is, we think, accommodative, modestly accommodative, and inflation not moving up very much, as we've discussed. And that underscores, I think, the challenge of getting inflation to move up. The committee has wanted inflation to be at 2%, squarely at 2% ever since I arrived in 2012, and it hasn't happened. And it's because there are disinflationary forces around the world, and they've been stronger than I think people understood them to be. In terms of those out-year rate increases, what you're looking at rate increases more than a year into the future, and people will have their own explanations for why they do that. But none of us have much of a sense of what the economy will be like in 2021. So I think what may be behind some of that is just the thought that over time, it would be appropriate, if you believe that the neutral rate is 2.5%, it would be appropriate for your rates to move up in that direction. I will also say to you that a number of people wrote down, and you can't see this at this level of detail, but today, but a number of people did write down overshoots of inflation as under appropriate policy.
Brendan.
Brendan Greeley from the Financial Times. Given that inflation, whichever measure you choose, has either sort of remained where it is or not increased over the past year as you've been dropping the policy rate, what is it that gives you confidence that the Fed has the tools to get inflation back up to target or even overshoot, as you just indicated that some people are considering doing?
Well, it's just that there is still empirically, by many different, by the work of many different analysts, there is a relationship between resource utilization, by which I mean unemployment, and inflation. It's just relatively weak. And by the way, that's not a bad thing. That means that we can run at low levels of unemployment and have a historically good, in some dimensions, labor market without having to worry about inflation. It also means, though, that it's not easy to move inflation up. Now you say, why is there confidence? I mean, I would say there's more humility than there is confidence in this at this point. It's been very challenging to get inflation to be at target. If you look around the world, the United States of all major economies has been closest to it, but still hasn't quite been able to achieve it. And I would also point out that this year, which has been a good year for the economy, core inflation is actually running at 1.6%, whereas it ran close to 2% most of last year. So it's a real challenge, and but I think we're using our tools as best we can to meet that challenge.
Nick Timmeros, The Wall Street Journal. So, Chair Powell, I want to ask about the framework review, which obviously entails some kind of debate around allowing an overshoot of the 2% target. And in that context, is merely saying that you want inflation to rise above 2% a sufficient strategy for getting inflation to stay at the target? Or would it compel some kind of policy action beyond deferring future rate increases to achieve that outcome, if that's the direction in which the committee goes? In other words, it's one thing to accept inflation rising on its own opportunistically, but if inflation does not materialize, would a change in the framework necessarily make it easier to generate higher inflation?
Well, I think the answer to the question of whether saying it is enough to create credibility, the answer to that is no. And I think you have to back that up with policy that supports the outcome. And that's what we're trying to do. And so the changes that we're looking at to the framework are I think they take all of that on board. But what they are designed to do is to strengthen the credibility of that inflation target, but only if followed by policy. Ultimately, it will take time to move inflation expectations up from where they are, which appears to be a bit below 2%, will not happen overnight. It'll have to happen over time as credibility is built. The Fed has great inflation credibility, but inflation expectations are anchored at about their 25-year average, which is a few ticks below 2%.
We talked a lot about inflation. Edward Lawrence from Fox Business Network. We talked a lot about inflation. I want to ask you about uncertainty. With the House announcing that they will ratify USMCA and Canada and Mexico signing off on it, do you see that uncertainty easing now so the business investment could pick up? Or are the trade tensions with China just that big elephant in the room where you might not see those business investments pick up?
Well, I did see the news today that it appears there's an agreement to move forward to a vote on USMCA. And of course, it's not our role to comment on particular trade policies or criticize them one way or the other or evaluate them. I will say, though, that getting if the deal were to be enacted, then it would certainly remove some of the trade policy uncertainty, and that would be, I believe, a positive for the economy. And I'll say the same thing about the negotiations with China, which haven't reached that point yet. We've been hearing from our people that we talk to, the many people and businesses that we talk to through the reserve banks that wind up being written up in the Beige Book, and they've been telling us all year, for a year and a half really, that trade policy uncertainty is weighing on the outlook. And I do think that, again, without commenting in any way on the process or the content of the agreement, I think that removal of uncertainty around that would be a positive for the economy as well.
Is one uncertainty bigger than the other? Do you see, not commenting on the deals themselves, is one uncertainty for business?
I think you can, I think you can see that what's been moving, one way to look at it is what's been moving financial markets. It's been news about the negotiations with China, not so much USMCA. I think that the difference between NAFTA and USMCA is smaller than the difference between current, arrangements with China and what's being negotiated.
Hi, Matthew Boesler with Bloomberg. Chair Powell, the Fed policy review this year has largely been discussed in terms of the inflation side of the mandate and the need to shore up inflation expectations. But it seems like the message you've been getting from the Fed Listens events and also something else you've recently acknowledged is that the Fed has also been systematically overestimating labor utilization throughout this expansion. So I'm wondering if you could talk a little bit about the extent to which the review is looking at the employment side of the mandate as well. Are there any possibilities, for perhaps systematizing a more asymmetric reaction function with regard to unemployment? Thank you.
Yeah. So the focus really is on how to use our strategies, tools, and communications to achieve both sides of the mandate. You're right, though, that we've talked here a lot about inflation, and I think that I think more broadly, over a period of years, many years, we've been learning that the natural rate of unemployment is lower. It's in estimates, not just at the Fed, but broadly among economists, labor economists, have seen that the connection that we can sustain much lower levels of unemployment than had been thought. And as I mentioned, that's a good thing because that means we don't have to worry so much about inflation. And you see the benefits of that in today's labor market. The Fed Listens event are about inflation to a much lesser extent than they are about maximum employment. If you listened to or attended any of those, the discussion, we always focus on inflation as well, but the discussion is really around what's happening in low and moderate income communities and among small businesses. And I think you get a perspective which we were already getting that from our extensive outreach to community groups and such, but it was helpful to get it in the context of a monetary policy review. And I think that the fact that these communities have such high levels of unemployment and low levels of labor force participation tells you that there is slack out there. And I think that does also inform our understanding of what we mean by maximum employment. And it's been a very positive. I would say that the Fed Listens events have been extraordinarily positive, and they're certainly something we'll repeat. You also see from the business perspective that companies are taking all kinds of measures to look through things on people's resume that would have perhaps disqualified them in other kinds of environments. Training is moving up. You hear just a lot. There are a lot of things going on that suggest that people at the margins of the labor force are being pulled in and being given chances, which is a great thing.
Victoria.
Sorry, if I could just follow up briefly. Is there any way to sort of systematize these insights, do you think, in terms of, we talk a lot about, for example, make-up strategies on the inflation side. Is there anything similar you could do on the employment side?
I think we have kind of internalized, and this isn't news for today. This is something we've been saying for several years. You've seen us moving down our estimates of maximum employment. In fact, it's already understood, I think, that there's more, even though we're at 3.5% unemployment, there's actually more slack out there in a sense. And the risks of, using accommodative monetary policy, our tool, to explore that are relatively low. And I think we know that, and I think the review certainly underscores that, but that's a very important insight.
Victoria.
Hi, Victoria Guida with Politico. I wanted to ask more about the repo issues and what you all are doing beyond open market operations. Are you currently, for example, telling examiners not to prefer reserves over treasuries for supervisory purposes? Are you talking to the Treasury Department about maybe reducing the level of volatility in their account at the Fed? And on the standing repo facility, is it that you would be inclined to do it, but you need to figure out the details, or what would kind of drive the decision on whether or not to do that?
So on treasuries versus reserves, we've done a ton of work on that. We've talked to supervisors, and it's interesting, if you look at the banks, they're all over the place on the composition of their buffer. So you have a business model, and that business model suggests what your stress outflows will be, and that suggests what your buffer should be. And you see them making quite different choices. Some of them have lots of reserves and fewer treasuries, and then they change their mind and they switch. So it's not obvious that there's one thing happening there. Notwithstanding that, we've gone out to try to understand that, talking to the supervisors. In terms of the TGA, we have not tried to pull the TGA into this yet. We've taken it as exogenous. I don't know that at some point we won't have those discussions, but Treasury, we want Treasury to be able to have the cash that it needs, and then we are essentially taking that as exogenous to our work. There may come a time when we talk about that, but we haven't done much of that. Standing repo facility. So your question on that is, what are we thinking about it? What are we? I think we are more focused, frankly, on the bill purchases, the year end, and also the review of supervisory and regulatory issues that we're digging into, and because we think these are structural things, right? Where you could, without sacrificing safety and soundness, just allow the liquidity that is already there to flow more freely, perhaps by making fairly straightforward, non-controversial changes. And we think there is some of that, and so we're working hard and fast. But those are things, if they take rule changes, it'll take, a notice of public rulemaking, it'll take 3 months and things like that. Those things take time. These things that we're working on now, though, like, going through year end with the overnight facilities and the bill purchases and the term repo, those are things that we have to do right now and are doing.
Chris?
Hi, Chris Rugaber at Associated Press. I wanted to ask, the only change in the statement was a drop in the reference to uncertainties around the economy. You seem very confident, or it implies there's a lot of confidence that those uncertainties have gone away. What caused you to make that change for this statement? What were you looking at that seemed to be so much lower?
We did actually, if you look at the statement, you'll notice that we did call out global developments and muted inflation pressures later in the statement. And why did we do that? Those are the things that we've been monitoring all year. We've put now in place policies that we think are appropriate to address those things. So we're not revisiting that. But those are just key things, and they haven't gone away. So we thought it was appropriate to mention them there. Still subject to the idea that for us to change our stance, we would want to see a material reassessment of the outlook.
Well, just to follow real quick, on the material reassessment aspect, are you worried that has set too high a bar for potential cuts next year? We were talking about rate hikes, but no Fed policymaker seems to foresee any cuts next year. Some economists do. Does a material reassessment mean you need to see data actually worsen? Does it reduce your ability to act preemptively the way arguably you did this year?
So, one thing that we're mindful of is that we've cut rates 3 times since July. That's 75 basis points worth of cuts. And we do believe that monetary policy operates with long and variable lags, and that it'll take some time before the full effects of those actions are seen in the economy. So that'll take some time. So that's one reason to hold back and wait. And we think we took strong measures. In fact, if you look at more broadly at the Treasury yield curve, it has moved more than 75 basis points. So you've had quite a significant move in the direction of higher accommodation. In terms of what is material at the end of the day, I would just say whether or not a change in the outlook merits a policy response will be a collective judgment of the FOMC. There isn't any single factor that will determine our decisions. We'll look at a full range of data and other information bearing on the economic outlook.
Okay, Scott Horsley.
Hi, thank you, Mr. Chairman. Scott Horsley from NPR. You started out by talking about Paul Volcker, who obviously cast a long shadow. I wonder if, in hindsight, that shadow was too long, and if in the decades since his tenure, and in particular last year, if the Fed was too quick to raise interest rates to attack an inflation boogeyman that didn't materialize.
This wouldn't be my response will not be about Paul Volcker, but although you started with Paul Volcker. So if you look back at 2018, I'll just take you back to the beginning of 2018. We had an economy growing at 3%, we had inflation at 2%, and we had $1.5 trillion worth of stimulus arriving, and the federal funds rate was 1.4%. So it wasn't that. So we moved policy up during the course of the year. We never got policy even at the level of what we thought the neutral rate was at the time. So there was no sense of it being restrictive. We took steps to make it less accommodative, and that seemed to be the right thing. It still seems to me to be the right thing in hindsight. The idea that we were trying to, slow the economy down, we were really just trying to get near neutral. And even with the last rate increase a year ago, we were still meaningfully below the median estimate on the committee of what the neutral rate was. So policy was always accommodative during the course of that year. I think what's happened is obviously the facts on the ground have changed. You saw the global economic slowdown begin in the middle of last year, gather force, and then continue to go on this year. So you've seen a continual weakening. Just look at the IMF's forecast of growth from the spring of 2018 and compare them to now. You've had quite a significant, that does affect us. I think also the trade situation was just beginning in the middle of 18, and I think it has had, I think there'll be very, very wide range of estimates of the effect, but I think it's had a meaningful effect on output just through the uncertainty channel and to a lesser extent through the tariff effects. And again, that's not to make a judgment. It's not up to us to make a judgment about that. So that would be my story.
Okay, Donna.
Chair Powell, Donna Borak with CNN. To follow up on Edward's trade question, could you talk about what you would imagine the economic effect would be if negotiations with China were to fall apart, and how the Fed might be able to support the economy in that event?
I wouldn't want to speculate on a hypothetical. I would say we'll just have to see. We look at a range of factors, and we, as I've said before, we try to look through the volatility in trade news and trade negotiations. We try not to react. We can't react. Monetary policy is not the right tool to react in the very short term to volatility and things that can change back and forth, as this has happened, as is probably typical of a large, complex negotiation. In terms of, I don't want to get into hypothetical outcomes, though, if that's all right.
I'm just wondering, you met with the president last month. Did you have any advice for him when it came to this, and did you express some concerns about potential volatility and the impact of the economy given all this?
I'm going to stick with my predecessor's longtime practice of not discussing private meetings with elected officials, or other officials, really. But thank you.
Virginie.
Thank you. Virginie Montet with Agency France Press. Yesterday, Democratic leaders in the House have launched an impeachment process against the president. Have you mentioned these developments within the committee today as potentially presenting some risk for the confidence in the economy?
No, we have not. We don't consider things like that.
Mike Durbin.
Mike Darby with Dow Jones Newswires. Does the Fed's dot plot still serve a useful communications purpose, or do you feel that it might be time to retire it or change it in some fashion?
Well, I think properly understood, it can be useful, but that's been a challenge. You know, I think properly understood to me means looking at what it is and not at what it isn't. And what it is it's an expression of the thinking about individual committee members about appropriate monetary policy and the path of the economy. Remember that we write all that down and we send it in and it gets compiled, but we don't discuss it at the meeting and we don't negotiate a plan. There's no agreement, there's no plan. And I think particularly at inflection points, it's hard to convey the reality, which is that policy is always going to depend on the economic outlook and changes in the economic outlook. And when the economic outlook is changing, the dots they're just not a consideration. We're going to do what we think is the right thing for the economy. And if the dots that we did 6 months ago or 3 months ago don't agree with that, that's not even in the conversation. So it's more, but it can be useful, and I think, but as I said, it's been a challenge. And so I do like to say if you focus too much on the dots, you can miss the broader picture.
Greg Robb from MarketWatch. Chairman Powell, many people seem worried that the framework that you guys are working on is going to be, the results are going to be less rather than more. And people keep coming back and saying asking why you took off like a 4% inflation rate off the table, even when it started. I mean, as you said, if going around the country for all the Listen events, I don't think I heard anybody worry about a 4% inflation rate or think that higher inflation rate was going to be a problem. So where does that concern come from? Is it members of Congress that have said this?
No. So let me say we've been working on this all year, and we're just at the stage where we've had a really interesting discussion about the various tools that we have at the October meeting. At this meeting, we talked about the way monetary policy affects different groups in the economy. So we talked about the Fed Listens events and some very interesting research. So we're just getting to the stage where we're looking at conclusions. You know, what do we take away from all this? And those things, many of those things would wind up as changes, if you will, modifications to the statement of longer run goals and monetary policy strategy. I think that process will take until the middle of the year. But we want to approach it very thoroughly and very carefully. And that is, in effect, that is our framework document. And I wouldn't prejudge. No one. I believe we will be able to reach a successful conclusion and make meaningful improvements. I do. In terms of 4%, so I think it's premature for people to be saying that this isn't going anywhere. You know, and if you define going anywhere as a 4% inflation target, let me talk about the 4% inflation target. So. I'll go back to the point that just saying words is not itself credible. So I think if you said we're raising the inflation target to 4, what would be the effect of that? I mean, where's the credibility in that really? You haven't been able to get it to 2. So I think you need to lower your sights a little bit. I also think is 4%. You'd have to ask the question: is that really, price stability? Is that really price stability? Is that within our legal mandate? I mean, I think it's a fair question. So, I think I'd like for this review to come out with a set of positive results. Meaningful improvements. It doesn't mean it has to solve every problem going forward. We want to have this be a successful exercise where we meaningfully improve our monetary policy framework. These things don't tend to move in a lurchy way. They tend to evolve. But I think, and if we do this then in a few years again and again, and things like that, then we can then at least we're moving in a good direction. And I think we will be. I'm confident we will be.
Don Lee with the LA Times. Chair Powell, you've had a busy year, and I'm wondering, as you look back, what things you might have done differently, and whether there are any lessons that you would take into next year.
Well, I have to say my total focus is on right now and getting policy right and thinking about next year, thinking about what's the economy going to be doing. I like where we are in policy. As I mentioned, I think our policy stance is appropriate and likely to remain so, as long as the outlook is broadly like this. I mean, it's too long of a question. I don't know how to get after that. There's a lot of learning that comes into from the economy every year, and in the way we do our jobs, and we're always going to be trying to learn lessons.
I mean, are there any particular surprises, whether it's the economy or how markets or financial things have?
Well, I didn't obviously, didn't see, and I don't think anybody saw coming the challenges that we faced this year. I think they were a surprise. I think toward the end of 2018, there was still a sense the economy was growing at around 3%, and didn't expect to face the challenges. But I think we did face them, and I think I'm pleased that we moved to support the economy in the way that we did. I think our moves will prove appropriate. And again, I think both the economy and monetary policy right now, I think, are in a good place.
Nancy.
And Nancy Marshall-Genzer from Marketplace. Chair Powell, why aren't we seeing stronger wage gains? Wages are growing more slowly now than they were toward the beginning of the year. Why is that?
Well, wage gains have moved up a bit. If you look back 3-4 years, you'll see wages were growing around 2%. Now you see them moving up, more at 3.5%. So why aren't they growing higher at a faster rate? And it's a couple of things. I think there are a range of explanations. One would be that productivity has just been low. So wages should go up to cover inflation and productivity. Productivity has been low, and that is very likely to be holding back wages. I also think there are other possible potential explanations, such as globalization can be the idea that you can manufacture or even provide services anywhere in the world to anywhere in the world. I think that hangs over the wage setting process and everywhere pretty much. You don't see there isn't the kind of traction in the wage market that even in a tight labor market. Another thing is though that the labor market may not be as tight as we had thought it was, I think there are many possible explanations. I will say though, if you look for example at non-supervisory employees in the labor report, their wages are going up at 3.7%, and so you do see, and wages are going up the most for people at the lower end of the. That's been true for the last couple of years, lower end of the wage spectrum. So you do see wages moving up. They're not moving up at very high rates. And again, at the end of the day, that probably has most to do with productivity.
Hannah. Could I ask a quick follow-up? Sorry about that.
Just as far as the market not being as tight as you thought, are you saying there are still more people on the sidelines who could join the labor force?
Yes, and I would also say that if you ask people, and we did ask people, what do you think the natural rate of unemployment is? People were writing down numbers in the 5s, and then they were writing down numbers in the 4s, and now unemployment's been in the 3s for a year and a half, and we still see wage inflation, as you mentioned. The level of wage inflation has actually moved down, although there may be compositional effects in that number. That may be to some extent about younger workers coming in at lower wages than retiring workers, but that shouldn't have much of an effect actually. So why is that? It may just be that there's more slack in the economy, and I think we are seeing that. We're seeing really it showed up through higher participation. For many years, we've thought that there's a trend decline in participation. Notwithstanding that, against that trend, we've seen prime age participation moving up pretty steadily over the last 2 or 3 years, and it's a very positive thing. But it does sort of provide more labor supply, meaning a less tight labor market.
Hannah.
Hi, Hannah Lang with American Banker. Thanks for being here today. I just wanted to ask about the Community Reinvestment Act, since the FDIC and OCC may potentially join together for a proposal without the Fed. Are you concerned that this might cause confusion, and how would the mechanics work if this proposal is finalized without the Fed?
So, we think the CRA, we know the CRA is a very important law, and we're strongly committed to the mission of ensuring that banks provide credit to their throughout their communities, particularly addressing the needs of low and moderate income households and neighborhoods. We also think it's time for modernization. We've thought that for some time, and we worked very hard to try to get aligned with the OCC really on a proposal. And my hope is that we can still do that. I don't know whether that'll be possible or not. We'll just have to see. And if we can't, I'm not sure what the path forward would be. We would certainly not want to create confusion or sort of tension between the regimes if they do turn out to be slightly different regimes. So that's something I hope we don't have to face, but we will if we have to.
Hey, Brian, for the last question.
Hi there, Brian Chung with Yahoo Finance. So before the July meeting, you said something kind of colorful. You said to call something hot, you would need to see some heat, referring to the labor market. So to expand a bit, I guess, on Nancy's question, it seems like the wage Phillips curve has been pretty well explored already. But what would you need to see to call the labor market hot in that case? Would it be some sort of change in either the headline number of gains or in the unemployment rate?
Really, wages. I mean, there's so many other measures that suggest that the labor market is, I'd like to say the labor market is strong. I don't really want to say that it's tight. Someone asked me a question about a hot labor market. That was in the Humphrey Hawkins hearings. So I'll say that the labor market is strong. I don't know that it's tight because you're not seeing wage increases. Ultimately, if it's tight, it should be reflected in higher wage increases. So it does come down to that. We look at countless measures of labor market, labor utilization, and there's so many, it's too many to count. But the one that is kind of suggesting that it's a healthy number, that the sort of 3.1% average hourly earnings number is a decent number. 3.7% for production non-supervisory workers is more healthy. Ultimately, though, we'd like to see, to call it hot, you'd want to see heat. You'd want to see, higher wages.
Thank you.
Thanks.
You've been watching Federal Reserve Chair Jerome Powell there at a press conference in Washington, D.C., just wrapping up and walking away from the podium. This follows the Fed's decision to hold rates unchanged as expected. This comes after cutting rates for 3 consecutive meetings. The Fed hitting pause at the current target range between 1.5% and 1.75%. The Fed also signaling no move for rates through 2020. And with me now to break it all down is my co-host Miles Udlin, Yahoo Finance Editor-in-Chief Andy Serwer, and Andy Richmond, Managing Director of Fixed Income Strategies at Truist SunTrust Advisory Services. So right there at the end, Brian Chung from Yahoo Finance asking a question which I think hit on some key points that a lot of people were trying to get at, which is what's happening with wage inflation as that feeds into inflation overall. Because Powell has said he needs to see persistent and significant inflation for there to be any move.
Wage inflation. Well, or in both, right?
Or both. And he kind of really stuck to that. And with the dot plot coming out, does it look like we're on pause here for the foreseeable future?
I mean, the dot plot suggests there'll be no moves in 2020. If any of them move, might be lower. There's 4 dots that are higher. I think we've all kind of understood where the Fed wants to get to, which is a point at which they feel like it's not their fault anymore, right? And Powell he defended the decision to raise rates 4 times in 2018. He said, we believe the economy needed a more neutral setting for monetary policy. And then the question is, well, was that an explicit pushback against the tax cuts? But we don't need to go there, right? He said he's comfortable with what they did in 2018, and I think he's quite pleased with how 2019's policy path came about. But what everyone was kind of looking at in the run-up to this meeting, and we saw it again in the latest economic projections, is there's something happening in the labor market that the Fed hasn't been able to explain and Powell hasn't been able to explain, and every question was trying to get him to explain, which is basically, What is full employment? What would you consider to be full employment? What does that look like, and how hard are you going to push to get there? Because obviously, Andy, we're not there. We're not seeing wage growth reaccelerate. We continue to see unemployment 3.5%. We've been under 4% for a year and a half now, which is still below where Fed officials think the long-term neutral rate is. So I think he's going to continue to face this question until there's some more clarity on what the Fed wants to see in the labor market and how they would get there.
Yeah, and I mean, this gets back to the participation rate, and are we measuring the right things? And of course, then it can get political, because depending on what side of the aisle you're on, you can point to either the unemployment rate or the participation rate to bolster your case. I think the takeaway, that I got is he said, I like where we are, right? And so the market obviously likes where we are because it didn't do anything. And if you go to mainstream media, this is not even really particularly being reported on. I know our audience cares about it a lot, and they should, because it obviously impacts the markets. But this is exactly what the markets had anticipated and wanted. There are mysteries, Miles. There will always be mysteries. Then there's the mystery of inflation. Yep. Don't get me started on that one. And, there's different signals in the economy, and I think we should have a real long debate sometime about how we measure things. But I'll stop.
I mean, he did talk about going back on some framework issues. There was a lot about inflation at 2%. And at some point, you actually feel for him. He's like, it's very challenging what we're trying to do here with inflation. I mean, it's not easy to figure out. From what you're seeing, we just wrapped this up. We're on pause here. We're talking about labor, the inflation part, also the repo market, the liquidity stuff came up. Was that important here?
I think it was important, but I think the important thing is Powell really did a pretty good job, I think, at this press conference. And he said what needed to be said. Unlike maybe if we go back a year or so when the markets were gyrating on that news here, I think what he said here was what was expected, but we heard that. And what you pointed out earlier, significant inflation and persistent. He said that at the last meeting too. The hurdle rate for an increase is very high, and we're actually seeing the bond market rallying. The 10-year's up 0.5 point on this news right now, below 180, about 178. The 2-year rallying across the board. You're seeing rates down about 4 or 5 basis points, and the odds for actually a cut have moved up a little bit. Still less than 50, but they moved up a little bit just today on that. So I think the repo market, that's a different animal, so to speak, and that's going to persist here, I think, due to some regulations, due to some T-bill buying and what's coming out there. So they're going to inject liquidity. And I think he said we're going to be there. And unlike saying where he said we were basically on autopilot last time, he's saying we'll be able to change and adjust if we need to. And that's what the market wanted to hear.
One of my favorite parts was you're paying too much attention to the dot plot, basically. We don't need to focus on the dot plot as much as we do here.
It changes a lot, and there's non-voting members on that too.
And then the question about, so you need to have significant and persistent inflation. You don't think you're getting it, but you're going to have higher rates in 2 years. How do we figure out how that's going to happen? I guess they are thinking there's going to be some significant and persistent inflation, even though they can't figure out how to get it to fire.
I mean, look, I think you could look at the dot plot and say anytime PCE ticks above 2%, then they're going to raise rates, right? Because there's never been significant and persistent inflation in the last decade. There hasn't really been any over the last 20 years. There was a slight sense of that last year, and they raised rates 4 times. So, and I think it also gets back to the story which Powell refuted, but is obviously part of the way they thought about this process, which is they wanted to get off the zero bound just because they wanted to, right? And I think it's interesting during the week when Paul Volcker passed that the Fed is still operating in the Paul Volcker setting, right?
Yeah.
They still see inflation as the boogeyman, and that's what they're most focused on. They're scared of the zero lower bound, but the reality is the economy and financial markets can handle rate increases a lot less freely than I think the Fed is appreciating.
Andy, before we let you go, he was asked, Chair Powell, what he had learned in the last year. As a market participant, what have you learned about this Fed?
I think, I do think Powell has made a little bit of a change. I think he's communicating a little better right now. So I've learned that, he wants to be more openness with it. He certainly wants to do that. But his ability to change as well. He made a change, significant change, whether he said it was a mistake or not. He made the change, cut 3 times, adding liquidity in there. So he showed his flexibility here. And from the bond market perspective, I think, again, rates for us seem low for a while here. And I think the Powell pause is here to stay.
All right, Andy Richmond is Managing Director of Fixed Income Strategies at Truist SunTrust Advisory Services. Thanks so much.
Thank you. All right, and coming up here, we'll have more in the final round. Plus, Thornburg's Jeff Klingelhofer will join us to talk about how he's trading this market after today's policy decision. But first, let's take a look at some of the trending tickers here on Yahoo Finance. Back to the final round here on Yahoo Finance. Miles Zeldin with you in New York. I'm joined as always by my co-host Jen Rogers, Yahoo Finance editor-in-chief Andy Serwer, also stopping by on this Fed day. So we've got 29 minutes to go in the session. Let's take a look at where we stand. All three majors are higher. NASDAQ leading the way, up about 44 basis points. Not a whole lot of action going on after the latest Fed announcement. For more on today's stock market, let's go to Scott Gammey. He's live on the floor of the New York Stock Exchange. Scott.
Well, Miles, as we know, historically under the Powell era, the market reaction to any of this Fed stuff really comes during the press conference, not exactly at that 2 p.m. release of the statement and the decision. And that was again the case today, with the market, getting a little bit of a pop at 2 p.m., but then building on its gain during the press conference. And I think, as your earlier guest said, Jerome Powell is getting a little bit more used to communicating to the market. And I think the market, at least from talking to traders right now, likes the fact that Powell pegged the case for a future rate hike really solely on a significant possible rise in inflation. And I think the market also knows that that's not likely to occur anytime soon for whatever reason. Maybe it's just the rise of technology and automation keeping a lid on prices, and of course a lid on wage growth, because we have a very tight labor market, and yet wages are still at that 3% growth rate, which is good, but certainly not in the runaway inflation category. Now, aside from stocks, we do want to update you on the 10-year Treasury yield, because it held above 1.8% for the whole 2 p.m. hour, and then about 30 minutes ago at about 3 p.m., it fell below 1.8%. Now, perhaps that's just the market repricing itself to be more aligned with the dot plot, which clearly showed no rate hike coming anytime soon. Now remember, the 10-year Treasury yield was as low as 1.4%, really 1.5% in mid-August. So yes, the 10-year yield is low, but it's certainly made quite a comeback over the past couple of months. And then one other thing we're watching today is we've got about 30 minutes left in the trading session, the flip in Boeing stock. It was down about 1% earlier this morning. There was an interview with CNBC from the FAA chief basically saying that the 737 MAX recertification will extend into 2020. That is significant because it suggests further delays in getting the plane back into service. And yet, with the broader market rebound largely driven by the Fed, you do see Boeing shares now in the green. So perhaps investors shrugging off any of the negative headlines surrounding the MAX and focusing on the resiliency of Boeing stock. And resilient it has been, although it has been pretty range-bound over the past couple of months as well, guys.
All right, Scott Gam, we'll talk to you after the closing bell. All right, joining us now to talk a little bit more about today's Fed decision, what it means for investors in the year ahead, is Jeff Klingelhofer, the head of investments at Thornburg Investment Management. So, Jeff, just your first impressions of what we heard from Powell today.
Yeah, it was really a mixed bag, right? So part of the commentary from Powell was a little bit hawkish in the sense that a lot of the uncertainties that they had seen within the global landscape were removed. And part of this is just tiring of the flip-flop rhetoric around trade. But the flip side is we saw the dot plot come down rather significantly. And the most interesting takeaway to me is that the Fed at this point doesn't see that they'll get back to neutral before ultimately they have to cut rates. That's just not in the cards this cycle. And to me, that's very concerning, a recognition of some of perhaps the excesses in the market and the late stage cycle that we're in today.
That said, are we focusing too much on the dot plot? I mean, Chair Powell himself said that none of us have much sense what the economy will be in 2021. We've already seen, look, hey, they raised rates and then things changed and then they decided to cut rates, and they can just make this up as they go along, right?
Well, they're forced to, right? I mean, they don't know what the future holds. And the reality is we're only 1 year away, or 1 year past, not that long ago, that Powell was talking about being a long way from neutral, and that was to the high side. And so I think the biggest mistake is perhaps, to your very point, the markets are focusing a little bit too much on the dot plot. I'm surprised by the reaction in the 10-year because we continue to see wages tick up. We had a very blockbuster job number just a few days prior, right? There is this lingering risk that inflation could return. Now, it wouldn't be my base case, but in the markets, we as investors are forced to focus on both sides. And so I think rates markets are a little bit too complacent that the Fed is on hold here.
All right, so what does that mean for investors, though, really? I mean, isn't it a good thing that the Fed didn't do anything unexpected? I mean, if you think about it, Jeff, right, raising rates means you're concerned we're overheating, cutting means we're not growing fast enough, so setting and forgetting, isn't that a positive for investors for 2020?
Well, you're exactly right. It is a positive, but only in the short term because things don't stay the same, right? And that's the biggest risk that I see to markets today is they assume that what is going on today will happen in perpetuity. And we've seen huge moves from the Fed themselves. And again, my biggest concern is the markets are overly complacent, that we're just in a stasis. But I think the question is absolutely correct. Do we get inflation or do we get recession? And both of those have real risks. But the market isn't pricing in either of those. Both are pretty negative for risk assets. But really what the Fed did today, effectively I might add, is a Goldilocks scenario, that we're just on hold and that what we see today will continue to play out. But that's just not the reality that we're likely to face in 2020.
Well, so, Jeff, I think, the Fed's moves in 2019 pretty much determined where the market went, right? They got more dovish, stocks went up a lot. As we look to 2020, if the Fed assumes that they're going to be able to not have to react to anything, what do you see as the marginal driver of financial markets in the new year?
Well, so the challenge is looking backwards. What we've seen work in the stock market is a multiple re-rating, and that's exactly on the back of a relatively more dovish Fed. And I think those cards are just off the table. The Fed isn't likely to move in a more dovish direction from here unless they see a significant weakening in underlying economic growth. And so while I could see multiples staying flat at an elevated level, really we're going to have to see earnings growth come back into the picture. And that's going to really take a true fundamental shift on the underlying economic conditions. And I'm rather wary of that. So I continue to believe we're going to see strong bouts of volatility. And my belief is to play dividend paying stocks and just consistent income generation through fixed income is really the safest bet for 2020.
And when do you think this volatility is going to kick in? Because, we've had a couple little hints, but it's been relatively quiet, especially after last December.
It has been, and that's always a little bit of an eerie sign to me, just given the significant speed bumps that we have on the horizon. right? Anyone's best guess ultimately what happens to trade. It's day to day whether we have a deal or we're close to a deal or we're still far away off and December 15th tariffs kick in. We still don't have an answer to Brexit. We still don't have answers to a lot of the underlying concerns that we've had for quite some time. And there have been bouts of volatility. Certainly late 2018 felt pretty terrible for investors. You know, I'm not necessarily going to make a bold prediction in saying that late 2019 is going to feel the same way, but I am pretty convinced that we will see volatility likely in the first quarter of the year.
Hey, Jeff, I want to ask you about transparency and communication from Jay Powell. He's going to be speaking 8 times a year from now on. And that's great because we get to hear what's on his mind and we have that transparency. But I think there maybe is some concern that there might be too much and that it can whipsaw investors. Where do you come off on that?
You know, ultimately, I think not only because of the amount of speaking, but I really think the Fed is committing a policy error here. And I think that the Fed is overly convinced that they have the tools today to actually prolong the economic cycle. And they view that as their goal today. And I don't think that is the Fed's ultimate objectives, right? They have 3 main objectives. So full employment, stable prices, and moderate long-term interest rates, whatever the heck that means. But I think they've been able to take that last piece and adapt it to some form of financial stability, which certainly is becoming part of their underlying mandate as well. And that's not necessarily always congruent with prolonging the recovery. So I think the more that Powell talks, they don't have a crystal ball, but maybe the markets are reading into it too much that they do have all the tools, they do have the crystal ball, and again, leading to complacency, which ultimately leads to volatility.
Jeff Klingelhofer, Thornburg Investment Management, Head of Investments. Thank you so much for joining us on this Fed Day.
And coming up here on the final round, we'll have your winners and losers on Wall Street. But first, take a look at where financials are trading right now with 20 minutes to go in session. All right, let's take a look at some winners and losers in the stock market today. Company holiday party alert here. Dave & Buster's is lower after the dining and entertainment chain trimmed its sales forecast and earnings range for fiscal 2019. You guys ever been there?
Oh, I used to go there all the time.
It's incredible.
I just was on the website checking out how many points I had on my power card.
It's awesome.
I used to go there a lot.
Yeah, Dave & Buster's is great.
Big birthday party place.
Great spot. All right, this is another Jen Rogers trade here. GameStop, that stock lower. The video game retailer getting destroyed today. Last night we reported on their earnings, which were worse than expected. They cut their annual guidance. They said that sales were down 45% for consoles, and they bought back a third of their shares during the most recent quarter. That stock off significantly during today's session.
And now for some stocks in the green. Ollie's Bargain Outlet, after the retail outlet chain beat earnings forecasts for the most recent quarter, though same-store sales fell roughly 1.4%. And Chewy, shares are still surging after the pet supply retailer reported third quarter results back on Monday evening. Those were in line with analyst expectations.
That's because I said I wanted to do video commercials for them, that I would do
That was
as a
it.
job. That's why the stock is on the move.
It's on the move on that.
Yes.
Also, they're moving to pharmacy, and the fact that they're able to get all those darn subscribers clicking.
Yeah.
But the ads are going to be huge.
Stock up on a lockup expiration day. So how about that? What a world. All right, coming up here on the final round. For the past 2 decades, Amazon, Apple, Facebook, and Google have been allowed to amass more and more power, but that period of unfettered domination could be over. We'll discuss with Yahoo Finance contributor Roger Parloff after the break. But first, let's take a look at where those big tech names are trading right now with 17 minutes to go in the session.
If you read one thing today, forget the Fed statement. We've already covered that. Yahoo Finance contributor Roger Parloff is out with a big new article on Yahoo Finance. Behind the big tech antitrust backlash, a turning point for America. It's a fantastic read on how big tech went from being the darlings of capitalism to now being in the crosshairs of antitrust activists on both sides of the aisle. And Roger joins us now. So it's a real deep dive. I mean, you're talking Standard Oil in here and Brandeis and Bork, just the evolution of what's been happening. And right now we have these companies that we talk about pretty much on a daily basis. They're now being discussed on the campaign trail. Now, having written this, how hard would it be to build a case against a company, let's just say Amazon, without changing the laws?
I think Amazon would be the hardest of the four. Maybe there are, you could chip off a small issue, but some sort of big breakup. I think that would be the hardest because it sort of exemplifies what's called the consumer. Right now, the test of antitrust propriety is does it benefit the consumer, and most people just feel because of its low prices and convenience, it's sort of a superstar in terms of this consumer welfare standard. It would be the hardest, I think.
But that's the whole point, that the consumer welfare standard is the standard of the land, and it comes from Judge Bork, right? And before that, with Brandeis, you could have harms, different types of harms that would need to be addressed by the government. Now you only have this one very narrow one. So it would take either new laws, to Jen's point, or new reinterpretation of the laws. How close do you think we are to that sort of thing happening in the United States?
There is this group of insurgents, sort of, particularly Tim Wu, Lina Khan, and some other lawyers and economists that would like to do this. It would be very hard, again, to do it without legislation, because most of these, the thinking that they're trying to overturn, the so-called Chicago School of Law and Economics, or all these teachings of Robert Bork, these are now enshrined in Supreme Court rulings. So it's going to be very hard to do it without some legislation.
And something else that stood out to me, 1982, is the last time we had a meaningful breakup of a company here. That was AT&T. So now we've not just had one, but really two full generations of MBA-type, conservative-ish business leaders believe that you could never possibly want to break up a company. And, a number of the quotes that you had in there really stood out to me. Where, it seemed like people were almost laughing at you for asking, is there going to be antitrust kind of breakups in the future?
Yeah, it's a huge development, and to see this, to watch the presidential debate in October, and to have a candidate, Elizabeth Warren, urge, she mentioned Amazon by name, and then urge that all of these tech giants need to be broken up, and then 6 other candidates each try to sound as tough as her. It's a real turning point, something we haven't seen. And of course, those are Democrats, granted, but it's a bipartisan sentiment. And you can tell that because you look at the attorney generals that are going after Google. There's 51 state and territorial attorney generals. Facebook, 47. When after DOJ went after Microsoft, there were only 21 attorney generals that ever got involved, and they were 3/4 of the Democrats. So there's something unusual going on that is bipartisan and powerful. It's a real turning point, certainly in the last 40 years, maybe longer.
One thing that really stood out to me is this just kind of happened on all of our watches, basically. That when you go back and you look at the Apple and Amazon case about the ebooks, which you write about in here, and I remember that. And basically, the antitrust, the competitive stuff, helped Amazon be able to not let Apple come in. So has Amazon really benefited actually from this idea of, the Chicago school and that markets are going to be okay and that nobody would ever have predatory pricing? Why would you ever
Very
do
much,
that?
and that's really the subject of Lena Khan's, she wrote a law review article while still in school, 27 at the time, a really powerful article, and she was saying that Amazon, it's sort of as if they looked at the antitrust laws and developed a business strategy that was primarily based on 2 competitive practices that used to be, borderline illegal, predatory pricing and vertical integration. And, the Chicago school said, well, predatory pricing doesn't really happen in the real world, or it doesn't hurt consumers, and vertical integration helps consumers.
So wait, I'm a little bit of a disconnect here. You're saying it would be very, very, very difficult on the one hand. On the other hand, you're saying it's bipartisan and all these state AGs are for it.
Yeah.
Is it just because, Roger, it's so complex and there's so much lobbying by the FANGs that makes it so difficult?
No, I think it's also because there's a lot of law that is going to make it very difficult to have a dramatic, a breakup or something like that. I imagine they can work out a settlement, and I think the AGs are looking at the Microsoft case as their template. They're trying to work within the existing framework. But I think that the House committee, Representative Cicilline is working on legislation, and there's also legislation in the Senate that might involve particularly new legislation relating to the digital platforms to try to rein in conduct there.
And of course,
who knows what it's going to do to the stocks?
And to the stocks, and also we didn't even get to talk about Europe because they're actually moving on this issue. There's a lot of stuff. It's a great article. Roger Parloff, Yahoo Finance contributor. Thank you so much, and Andy Serwer. Have a great evening.
Thanks, you too.
All right, coming up here on the final round, the closing bell on Wall Street is 8 minutes away. But first, we will talk to Jared Blickery at the Wi-Fi Interactive Touchscreen to get a look at how the market is moving after Jay Powell speaks. But first, take a look at some of the most active stocks right here on Yahoo Finance. All right, stocks higher after the Fed. 5 minutes to go in the session. Jared Blickery joins me now. Jared, let's take a look at where the market is right now. Right near highs of the session, but nothing too exciting going on.
Oh my goodness. This has got to be one of the lowest volatility Fed days I've seen in forever. 37 basis points on the S&P 500. Even on a normal day, that would be really low. I think that's the lowest volatility we've had in 2 days. So we see the S&P is up 30 basis points here. NASDAQ up 45, Russell about unchanged. And here's the price action throughout the day. It's more dramatic because it's always going to fill up the space, but just barely able to exceed the morning highs here, and just kind of a snoozer through the even the press conference.
The old rule, zoom in close enough, any chart can look scary. Let's talk a little bit about the dollar, where we are seeing a little bit more action than we're seeing in the equity market.
Yeah, so the dollar is down on the news, and let's go to a one-year chart, because this is something I've been tracking for a long time. Depends on how you draw this long trend line here, but we're right at the edge, and we dropped today. It's hard to see right here, but it was a fairly significant move because the U.S. dollar index is actually at a 4-month low, and so we're going to want to keep an eye on that. That is the big mover of the day, especially after the FOMC announcement. And I'll just note quickly that the 10-year T-note yield, that dropped 4 basis points because the yield curve compressed.
Yeah, you know, the dollar is interesting. Just hearing Jeff Gundlach over the last couple of days has come out and said he expects the dollar will go significantly lower. And you hear from a number of strategists now that we know where the Fed is headed next year, like the marginal growth is going to have to come from overseas. Obviously, dollar negative would be positive for that story, but it seems like the market does want that to actually come to fruition.
Yeah, and anytime that you see the U.S. lag a little bit, you actually see the dollar outperform, because that usually means the rest of the world is doing even worse. But here's something I found. This is Jeff Gundlach's chart here. Somebody else is quoting him. It's not Twain's mustache.
Mark Twain, yeah.
It's a near perfect record. When the Fed grows its balance sheet, the curve steepens. And here is the balance sheet going back to 2009, the crisis era, and we can see it's uptick significantly here, coinciding with a big steepening of the yield curve. It's going to be interesting to see going into year end if Zoltan Pozar's prediction.
Sorry, he got a shout out today too.
Oh, he did. Impressive to see. Well, he used to work for the Fed, at least the New York Fed. I think the balance sheet is only going to grow next year as well. And we're probably going to see this reflation aided by not only the Fed, but also the ECB. Really interested to see what Lagarde comes out. If she comes out from left field tomorrow, that could stir things up, but I don't think that's going to happen.
That press conference starts at 8:30 Eastern. All right, Jared Blickery, thanks so much for joining us today. Coming up here on the final round, we got the closing bell on Wall Street, plus another big milestone for Disney Plus, and a little bit of an award for Disney CEO Bob Iger. We're back with that right after this.
Welcome back to the final round on Yahoo Finance. I'm Jen Rogers with Miles Udland, and joining us now, Dan Roberts. We are just moments away from the closing bell. And as you just heard from Jared Blickery, what did he say? The lowest volatility Fed day?
Well, I mean, probably a good thing. I don't know if that's a confirmed record, but I think in general,
anecdotally,
it is quite a low volatility day, and I think we can all kind of go on with our lives now, which we expected.
I haven't been going on with my life since he walked away from the podium.
Would you rather see a freak out on his every word, right?
All right, live pictures of the New York Stock Exchange and the NASDAQ market site. Oh, gosh, the bell coming in right there. Looking at sectors here. As you can see, it is going to end higher. We are going to have real estate off about 0.8, biggest laggard. And to the upside, materials, industrials, technology, confetti at the NASDAQ. So that was the last Fed meeting of the decade. That is it.
Oh, wow.
To think that where we've been for about 5 years of the decade, we were at zero.
Yep.
Then we got
what a long, strange trip it's been.
It's been such a long, strange trip. So we sat at zero for a while. Then we made some moves up. One a year, then some moves back up. And now, I guess the question is, what's the next thing? Cut?
Right.
What's left?
Or raise?
Well, the Fed would suggest that there'll be nothing. That's the next thing. The next thing could be next year, nothing. So I guess we're going to see.
The next thing will be whatever's necessary.
Oh, yes, to act as appropriate.
It will do, yes. It will act as appropriate. Even though we're not ending with a bang, because today has been a snoozer, to quote Jared Blickery, you could argue that decade-wise, the Fed is ending with a bang, because the last year of these meetings has been a whirlwind.
Yeah. Well, and I think for a Fed that basically for 6 or 7 years of this decade was in complete control and was really not making mistakes, they made a policy error in 2018. And Jay Powell, though he kind of defended that decision today, he knows what happened, right? They raised rates probably 2 times too many. I think they did that as a reaction to faster growth and the transient faster inflation that resulted from the tax cuts and the mini boom that we got as a result of that in the second half of 2018. And so he reversed that with humility. And I think that's probably a positive development for investors. And I think it does, to your point, Dan, allow the Fed to go out and say, but for the one thing, I think we kind of nailed it this decade.
Of course, hindsight 2020 also.
Right.
But when in doubt, do nothing.
Hindsight and next year, 2020. Let's go to Brian Cheung in our DC studio for a recap of today's Fed decision. So, Brian, you had the last question there, trying to drill down a little bit more on.
I took the jacket off, too. Wow.
Wait, he had the final question of the decade.
He did.
Oh,
Yeah.
Wow.
The final
I didn't think
question
about
of
that.
the
That's right.
decade.
Wow.
That's it.
Brian.
Well, I'll tell you, the Fed didn't give me anything for that, so.
What do you mean? They gave you so much information today. They told you that they don't really understand what's happening between labor and wage inflation, that there's like a faint signal there. They've told us that we have no idea what's happening with inflation, it feels like, overall. What was the biggest takeaway for you?
Yeah, well, I mean, the headline was obviously that nothing really happened in this meeting. So the Federal Reserve kept rates at the current range of 1.5 to 1.75%. They did have a fresh round of dot plot projections that indicated the median dot basically saying no change in 2020 with maybe one rate hike in 2021 and another one in 2022. But as Jay Powell said, it might be too much to pay attention to each of those dots, especially with the economy kind of at the point where it's at right now, where we really don't know if the next step is going to be a rate hike or a rate cut. Although it seems like a lot of the questions really focused on what sort of heat we would need to see in the economy to actually warrant some sort of raise in the federal funds rate, which is what I asked him. I said, well, if the labor market does get hot, because you have said that you don't see it as hot right now, what would you need to see in order to try to see something like that and then maybe want to raise rates? And here's what he had to say.
Really wages. I mean, there's so many other measures that suggest that the labor market is, I'd like to say the labor market is strong. I don't really want to say that it's tight. Someone asked me a question about a hot labor market. That was in the Humphrey Hawkins hearings. So I'll say that the labor market is strong. I don't know that it's tight because you're not seeing wage increases. Ultimately, if it's tight, it should be reflected in higher wage increases. So it does come down to that. We look at countless measures of labor market, labor utilization, and there's so many, it's too many to count. But the one that is kind of suggesting that it's a healthy number, that the sort of 3.1% average hourly earnings number is a decent number. 3.7% for production non-supervisory workers is more healthy. Ultimately, though, we'd like to see, to call it hot, you'd want to see heat. You'd want to see higher wages.
To call it hot, you'd want to see heat, and he's talking about really wage inflation, and that fits in with the overall theme, not just wages, but he'd like to see overall inflation, and what he said, persistent inflation, before he would see a case for raising rates. But as is for the time being, sounds like the Fed is pretty content with doing nothing and keeping rates steady as is.
Well, and Brian, I think it was striking to me that the theme of the press conference, I mean, there were some repo questions, and, Zoltan Posar made a cameo appearance, basically, but that was sort of for the nerds over here. I mean, the mainstream theme of the press conference was, what is the deal with the labor market, and at what point would you start to view it differently? Because the only real change they made, right, in the projections was lowering the unemployment rate forecast for next year, the year after, and their overall NAIRU, but they're still 0.6% above on their long-term estimate where the unemployment rate is today. And so I'm just surprised that the Fed continues to insist that the economy, I think they're Powell told you the economy has more slack, but I think they're still underestimating the labor market.
Yeah, and they're underestimating the labor market, but they're also underestimating, in my view, what the actual projections for inflation should be as a result of that, right? Because I think we've come to terms with the idea that the Federal Reserve has not seen any sort of pressure on inflation as a result of unemployment blowing through time after time the Federal Reserve's own estimates for where unemployment really should be. And we can get into the nitty-gritty of the Phillips curve itself, but regardless, it was still kind of peculiar that the SEPs continue to project that the Fed will hit its 2% target exactly and achieve 2% core PCE by 2021, when we've already seen that the Fed has persistently undershot and only breached 2% basically one time since it actually established that target in 2015. And it was interesting because a lot of inflationary pressures are really just kind of psychology. It's what they call rational expectations, getting markets to actually get to low and stable inflation by simply messaging to the world that this is an economy that will have low and stable inflation. You can do that in a fiat currency world. But the Federal Reserve has not really acknowledged that actually there might be a risk of continuing to undershoot it by 2021. Maybe we don't have 2%, and maybe we likely won't have 2% by 2021. But I think the Federal Reserve has kind of continued to anchor expectations, or at least say explicitly that it's going to be there by 2021 because it doesn't want to lose hold of that. That was a question from Nick Timrose at the Wall Street Journal, but Powell punting on that as well, saying we don't have any explicit goals for right now. We have that 2% target, and we're optimistic that we'll be able to hit that.
Brian Chung, live in D.C. Great job today.
Thanks.
All right, for more on today's market action, let's go to Scott Gamme. He's live on the floor of the New York Stock Exchange. Scott.
Hey there, Miles. Well, stocks closing in the green, and let's take a look at the best performing stocks in the Dow for today's session. Names like United Technologies, Disney, Apple, and Intel. By the way, Apple closing just under $271 a share. It hit a record high earlier today. Now, the stock market was, of course, choppy starting at 2 p.m. when we got the initial release of the Fed decision and statement, but even throughout the press conference, stocks remain in the green, even though there was some volatility. Stocks, paired some of their gains and then rebounded, but ended the day nicely in the green. Now, even with that, some of the laggards in the session today, especially for the Dow, were names like Home Depot, Chevron, Pfizer, and Travelers. And then outside of stocks today, we've been keeping an eye on the overall IPO market so far this year. And it's interesting because companies listed on the NASDAQ this year, IPOs, have raised about $34 billion according to Dealogic. That's more than the $26 billion raised for New York Stock Exchange IPOs. Now, there's always competition between the two major indexes, but each got some major IPOs this year. The NYSE had Uber, NASDAQ had Lyft. But we should also point out that the Hong Kong Stock Exchange had another significant year in the IPO market as well. According to Kathleen Smith over at Renaissance Capital, the Hong Kong Stock Exchange and IPOs listed there this year have raised $31 billion, so a formidable competitor to the New York Stock Exchange and the NASDAQ. And the Hong Kong Stock Exchange did score some notable listings like the Alibaba secondary offering, which took place last month, and then, of course, Anheuser-Busch InBev's Asia business, which spun off in September over at the Hong Kong Stock Exchange, guys.
All right, Scott Gamme, we'll talk to you tomorrow.
Lululemon's third quarter results just hitting the tape right now. Let's go to Emily McCormick in our newsroom for a breakdown. Emily.
Well, Jenna, better than expected third quarter result for Lululemon on the top and bottom lines, but guidance for the fourth quarter, that's that holiday season, was a bit light for profit. So diving into these results, we had third quarter adjusted earnings per share of 96 cents. That was 3 cents better than expected. And then total net sales were $916.1 million. That was ahead of expectations for $899.4 million. This was the seventh consecutive quarter that Lululemon saw more than 20% year-over-year growth on that top line. So a lot of strength on total sales that we're seeing here. We also had comparable same-store sales coming in ahead of expectations for the third quarter. That was up 17% year-over-year versus 14.2% expected. Now, guidance was what really disappointed here. Fourth quarter earnings per share are expected to be between $2.10 to $2.13. That's a bit below the actual consensus expectation that we have for $2.13 on that low end of the range. At the same time, though, the company did raise guidance for the full year. It expects profit of as much as $4.78 a share. That was above its previous guidance for as much as $4.70 a share. And we did have the stock hit an all-time high earlier today, but we are seeing it tumble a bit on that weaker than expected guidance, down just about 4.5% in late trading here. We did have a lot of optimism heading into the results. The stock really has been on a tear, about doubling for the year to date. A little bit of softness here, though, because of that guidance. Back to you.
Emily McCormick in our newsroom with Lululemon's quarterly results. As you can see, Lulu shares off just about 5%, but in all-time high for Lulu today, setting up coming into the earnings here. Revenue up 23% to $916 million. Bless you, Dan Roberts. Anything sort of standing out in here? I mean, there's not a lot of color. I mean, they want to be an experiential store.
Right.
It's going to be on the call.
I mean, on the call, we'll get more of a sense of what the breakdown between men's and women's is. Yeah. We know that men's has been empowering that brand for some time now, but you can't come out at an all-time high and guide low, right? That's why your stock's down 5%. D2C growth continues there, continuing to see, as Emily mentioned, strong top-line results. So I don't think the Lulu Bulls are going to be discouraged by this, but at the same time, when any company lowers their guidance, all else equal, you would assume the stock is down a little bit. And so we're seeing the stock basically back to where it was at the beginning of this month.
Well, and it flew pretty high, up 90% this year so far before this earnings report came out. All-time high earlier today. Here are the things you'll hear about on the call. First of all, there were hints given earlier this year that Lulu wants to get into footwear, sneakers, something Lulu hadn't done in the past. Men's, so there'll be questions about that. How's that going? We haven't heard much more since they indicated they want to do that. Men's, as Miles said, was the big growth area last quarter and the quarter before. Is that still the case? Is it still the fastest growing segment for the business? And then overall, just look, the trends in fashion still favor Lululemon, athleisure, which anyone you ask in this business that you talk to will say that has not gone anywhere. So that benefits Lulu largely. It's a nice tailwind.
Yep, certainly a call we'll be looking at tomorrow. So another stock we're watching today, shares of Disney. Now, according to Apptopia, Disney Plus has surpassed the 22 million download mark. That's just a month after the streaming service was launched. Currently holds the #1 spot in Apple and Google app stores as well.
22 million on mobile.
On mobile.
A key,
even better,
distinction, because we're not talking about people who are just watching at home on their TV.
So you think it's an even better number?
Absolutely.
Suggested by the tremendous 22 million.
Well, and I think
downloads.
22 million would arguably maybe not be so big if it really were only 22 million. Because if it was 10 million on day one, which Disney was
then
more than happy
doubled,
to tout and announce, then 4 weeks later it's only doubled.
Yep.
That would actually alarm me. But this is only mobile downloads, phones and iPads. So I think there's a lot of families that, well, they're not going to watch Mandalorian on a phone. They're watching at home on their Apple TV or Roku device. That isn't measured in this Apptopia report. And Disney had no comment. Disney isn't going to comment on some third-party firm's numbers. We'll get the numbers from Disney itself. We'll see when we get that number. I suspect the total number of paying subscribers when Disney shares it next earnings report will be more than 22 million.
Yeah, February, something like that.
And the goal Disney has shared is 60 to 90 million by 2024. That seems intentionally light. That is a goal that, of course, it will hit long before 2024.
Now, earlier this week, Yahoo Finance named its company of the year. It was Target, went through that on Monday, but I think another business you could have made the case for was Disney. Certainly, it's been the year of Bob Iger, and we see Bob here being named the Business Person of the Year by Time and holding his favorite new son, the not Mandalorian.
Child.
I don't know what this is technically in the world, but I do know that it's the Baby Yoda.
Well, I am also not watching Mandalorian yet. I certainly plan to.
I don't know. I've heard this from many
it,
people that are like, I'm waiting for the Mandalorian. Like, just watch it.
No,
Why are you-
Because
there's
it
too
come
many
out?
other shows I'm watching right now. Yeah, it's once a week.
It's not a bingeable thing.
Right.
So
I
the
see.
kids
Right.
are.
So that's why I'm
everybody's
also-
waiting. It's like,
I feel
and
like I've
I
got
think
time.
it's kind of interesting that they have delivered it that way. It's very un.
Yeah, some people don't like it. Exactly right.
They're making you wait for the reveal that it is in fact Baby Yoda.
Well, it's funny. Everyone calls it Baby Yoda, but as I understand it, I'm not watching the show. But in the show, the character is just called the Child. But we've all collectively agreed to just call it Baby Yoda. That's
great.
By the way, even though Bob Iger, Times Business First of the Year, and even though I agree with you, Disney, huge year for the company, there are critics out there who say that as of right now, it looks like Disney overpaid for Fox. I think it's way too early to be saying that.
Well, I certainly know that this large oil painting, Hanukkah gift for you, Dan. From me
No,
to
I'm
you.
good.
I'll get you one of
Over your
those.
fireplace?
Big pic of Bob and the baby.
Oh, you want the Bob and
coming
the
up.
baby, not just
no,
the baby.
I want that one.
No, I'll take the Marvel
No,
content.
I want Bob and the baby. It's a great picture. Coming up here on the final round, BlackRock's head of renewable power will join us to talk about trends they see forming as we enter 2020 and how you can capitalize on some of those. But first, let's take a look at where the energy names finished during today's session.
Platts Global Energy Outlook Forum is underway in New York City, where industry leaders are discussing the changing face of energy. Let's go to Yahoo Finance's Ethan Wolfman, who is joined by BlackRock's global head of renewable power. Ethan.
Hey, so David, I'd like to start with, what do you see as the kind of biggest trends coming in 2020 in renewable power and kind of investment opportunities?
Yeah, thanks, Ethan. We're really excited about getting started in 2020. We have capital to deploy. We think that there's going to be a lot of exciting opportunities in the Asia-Pacific region. We're looking at new investments in Taiwan and South Korea. We're also really excited about the commercial and industrial space here in the United States, behind the meter, investing for solar and solar plus storage. We think it's going to really generate some great investment opportunities for our partners. And then in Europe, we'll continue to see activity, things like repowering of older assets in the UK and more solar, offshore wind. So a lot of exciting things happening across the globe.
In terms of the idea of kind of retrofitting existing structures with kind of improved renewables sort of things versus kind of new projects, what's the kind of breakdown that you guys are seeing? Are you guys mostly towards one or very diversified in terms of those?
We try to be pretty diversified. We're trying to build a portfolio that has resilience both from a current yield perspective as well as a total return perspective. So for us, it's really important that we have some of that income coming from the investment grade off-takers to the assets, as well as then really getting that alpha from new build, new developments.
So you guys just closed a fund at $1 billion, the third one of these. That is a lot of money. I guess, does that tell us something about the kind of investor demand for these types of products, investment products that are a bit more environmentally conscious and more renewables focused? I guess, what does it say about the demand now and going forward into 2020 and beyond?
I think it's a really exciting time to be focused on renewable power right now. When we think about 9 years ago when we started this strategy at BlackRock, we spent a lot of time focusing on just the low-risk nature of the technology and the maturity of the markets. But now we get to spend so much more of our time just talking about the resiliency that renewable power assets create in a portfolio, that we're really part of where the future is going in the energy transition. And I think investors are much more in tune with the inherent risks of not being part of that portfolio and that energy transition.
So obviously there's a lot of different ways that you can invest in renewables, from various technological things kind of on the side to actual power generation. Has the momentum for specific areas changed, or do you see it changing kind of in the next few years?
We definitely see it shifting more to the distribution level and away from the utility scale, especially here in the United States. I think you're going to see a lot more opportunities. A lot of the growth is going to happen at that distribution level. And in Europe, you're going to see a lot of it happen offshore.
One thing I always wonder about is the amount of commitment that people have when it comes to kind of these renewable sort of things. Do you have a lot of kind of people who are trying to invest in these products, kind of looking with a fine-tooth comb, or is it something that seems more rubber-stamped?
Our partners really do their diligence before they put their capital with us. And it's something that I really appreciate. It gives us a great opportunity to talk about the things that make us different versus other teams out there. But it also then makes them a much better partner as we're growing the business, as we're working with them. It's just really exciting when they're now invested in the strategy because they fully bought into it.
Awesome. David, thank you so much.
Thanks for having me.
Miles, back to you.
That was Yahoo Finance's Ethan Wolfman with BlackRock's Global Head of Renewable Power, David Giordano. Thanks a lot.
All right, coming up here in the final round, we'll have the sector watch, but first take a look at some of the leaders today on the Dow. We are back right after this. Let's take a look at the sector winners and losers on the session. Sectors in the red include financials, down 0.3%, weighed down by shares of Progressive, Allstate, and Wells Fargo. That coming after the Fed's latest decision to keep rates unchanged. Sectors in the green today include Tech, XLK, up over 0.6%, led by Applied Materials, Western Digital, as well as shares of Micron. Also higher, Communication Services, XLC, up about 0.6 as well. Twitter, Netflix, and Electronic Arts doing most of the work for communication services.
Coming up, what we're watching tomorrow in the look ahead. Plus, 40 years ago, acting legend Marlon Brando wore this watch in Apocalypse Now. And now it has a new owner. Guess how much he, or maybe she, paid for this piece of movie history. We're back right after this. And now here's Miles with a look ahead at what will be making headlines on Thursday.
Well, Jay Powell's eventful year as Fed chair has come to an end, and after a dramatic policy shift during 2019, Powell now goes into a new decade with a Fed that's in agreement. On Wednesday, the Fed announced its latest policy decision. Interest rates were kept unchanged, and the Fed's forecast for next year suggests the most likely path for interest rates in 2020 is the same. And unlike the Fed's last four meetings, no members of the FOMC voted against this policy move. And though Powell never seemed particularly worried about dissenting votes on the FOMC, 2019 was a significant year for monetary policy, and the committee tension was obvious along the way. After four rate hikes in 2018, the Fed cut rates 3 times in 2019. At various points, FOMC members argued for lower rates, higher rates, and no change when the Fed decided to actually make a move. Not to mention what the White House thinks about where interest rates should be headed. And so to get all 10 voting members on board with where the Fed finishes the decade, I think is a pretty big accomplishment. And it sends a signal to markets that after 2 surprising years for Fed policy, 2020 looks like it might be a more predictable and perhaps more benign year for investors, at least as it relates to the world's top central bank. Now turning to the calendar for Thursday, on the economic data side, we'll get the latest weekly read on initial jobless claims, producer prices for November, and Christine Lagarde will hold her first meeting as president of the ECB. That press conference kicks off at 8:30 in the morning. Also, don't just leave work behind tomorrow when the day ends. We've got results from the UK's general election released beginning at 5 p.m. Eastern here. And then on the earnings calendar, Costco and Adobe are the most notable companies set to report their quarterly results.
And we will still be here.
We will be here until about
5
5:15 tomorrow. We'll get early first look. I actually like the way they do it in the UK, where you can do no reporting on the election, the polls. You have to pretend like it's not happening until midnight, and then the Beeb is allowed to do whatever they want to do. But it's midnight there, so they have to wait.
BBC One.
Better for us.
BBC Two. Right?
3, 4. I think there's like 7 of them. Yes.
Yeah, but the song.
Yes. Yeah.
Is that a song?
Yeah.
No.
By the way, I'm surprised we're not, since we're in the minute where we just say whatever we want here before we go to the next
This
segment.
is not, no, I
I'm
have
surprised-
something to
okay,
read.
But I'm surprised that we are not talking on our show today about Jack Dorsey basically announcing he wants to decentralize Twitter. Would have been that's a Jen, Miles, and Dan
With
talker.
the blockchain?
But for Twitter.
Is something wrong with Twitter as it is?
Decentralize it.
Well, if that's going to solve
Legalize
if
it.
that's going to solve their problem.
It's funny though, since we've gone to 2 hours on this show, I find that there's all these news stories that it would seem like we have all this time for, and yet we have no time for anything.
No time, and in fact,
it's amazing.
We're out of time. Jen?
Moving along. In the small, fanatical world of watch nerds, one movie watch stands out from the rest, and it just sold for big bucks at auction last night. Marlon Brando's Rolex GMT Master from the Francis Ford Coppola classic Apocalypse Now has a new home. It sold for an eye-watering $1.952 million. So it's almost $2 million.
$2 million GMT.
At Phillips Auction House. here in New York. It was worn by Brando's character, the enigmatic Colonel Walter E. Kurtz. The watch remained in Brando's possession until 1995 when he gifted it to his daughter. And I guess it has his name or something.
Yeah, he etched M. Brando on the back. It's not even like a true engraving. It's like a kind of a, it's cooler, I think.
Like he did it himself?
Yeah, like it's like, I think when he was getting into character as Kurtz and like hiding in the jungle,
He was doing it.
took a paper clip or whatever and chiseled M. Brando into the back. Yeah, it's cool. And as that picture shows, he wore it on the inside of his wrist.
Well, you guys know that I'm a fan of real watches, analog watches, not Apple Watch, Fitbit, whatever, electronica.
You don't like my Whoop?
And so you're wearing the Whoop.
He's wearing the Whoop, but he's also
Whoop,
wearing
there it is.
He's wearing a watch.
Well, and of course, as the Whoop guy was careful to tell us, that's not really a watch, even though I'm sure you can find the time on it.
I find the time. I can find the time on my phone.
Sure. But if I had money and were to spend it on something stupid that is a piece of movie history, I would certainly go for a watch over, say, a car.
Right.
James Bond,
Now, how
Aston Martin.
how about the Paul Newman Daytona? That's an $18 million.
It's ridiculous.
Watch. That's another option.
Well,
You
and
can
I do feel closer to Paul Newman roles
Than
than
you do to
I'm not a big
Brando?
Apocalypse Now guy.
So you're not a big Heart of Darkness guy? Conrad didn't do it for you?
I did like Hunter
I love
S.
that
Thompson's
book.
Hell's Angels ending with him on the floor being beaten up by the Hell's Angels that had previously befriended him, and he yells a quote from.
Now here's the question.
Heart of Darkness.
Like tool watches like this, they're meant to be worn. So if you had won that at auction, would you wear it?
Oh, absolutely.
Definitely.
Yeah.
You'd get it insured.
I'm the one who ripped the tags off my Beanie Babies right away because I bought them to play with them. And then later it's like, oh, people said they're worth so much money. Oh, but yours don't have the tags.
Right.
That's because I was an actual kid who used my toys.
Live your life. Don't just put it in a nice
That's
box.
right.
You people getting wedding gifts, use them.
Coming up here on the final round, we'll have our top take. It's a hard road to the top, and staying there isn't easy either. Why 2019 has been such a tough year for executive departures, with November setting another record. We'll take a look at that right after this. Welcome back to the final round here on Yahoo Finance. Miles London with you in New York. I'm joined as always by my co-host Jen Rogers. Also stopping by today is Yahoo Finance's Dan Roberts. Let's take a look at where the market settled on this Fed Day. Final Fed Day, guys, of the year and the decade. And what a decade it was. Got all three majors higher on the session, though not a whole lot going on. Tech leading the way. The Nasdaq up 44 basis points. The Dow, the laggard here, up just about 1/10 of 1%. Powell keeping the Fed on hold today, saying the Fed will probably be on hold as we head into the 2020s. We talked earlier with Brian Chung about the labor market and all the interesting kind of Fed arcana that I think is coming up as we look towards the direction of policy in the future. But as far as investors want to know, right, rates going up or down, rates going not up or down, rates going sideways, and that's just going to be what it is.
Get used to it. And it's fine. It's good.
I think it's
because
great.
we're in a good place. That's
According to Jay.
According to Jay.
Jay said.
But it was unanimous. Everyone,
It was.
we've heard them all come out and say things look okay right now.
Okay.
So just be happy, relax. It's fine. Like I think.
As Aaron Rodgers would say, relax.
Relax, spelled with a D.
Right.
Let's turn to our top take. It has been a rough year atop the corporate food chain. In November, 148 CEOs left their posts, this according to Challenger Gray Christmas. Only 5 more CEOs need to depart for 2019 to be the highest year on record. We just had one more today after hours, Harold Hamm stepping down at Continental Resources.
And Jen Corey away earlier this week.
Yeah, but not a public company, so
okay,
who
but
cares?
Challenger Gray is not counting public companies. They're counting all. They're counting
All companies?
Yeah,
But then I'm sure there are some they're not measuring.
Right. So
We'll hit the
That's at least
record.
2.
We'll hit the record. There's 3 weeks left.
Okay.
Especially, there's been so many more in just the past 2 weeks.
So why do we think this is happening right now? Why are they all leaving?
More expectations than ever before to get better every quarter or year. You know, you don't get as long a leash anymore. It feels like being the CEO of a public company in America in 2019 is like being a college football coach. You don't get a very long leash. 2 losing seasons, you're out. What happened? Now, of course, you're giving Harbaugh at Michigan a long time if he were a CEO. Oof. But the exits that we're lumping together, and I think it's fair, I mean, as a trend, let's put them all together. But each one is a little bit different, right? I mean, there are some where the person has clearly been forced out. The boot is in the back, you know, get out. There are some where the person has resigned, and it isn't just they're allowing them to make it look like they resigned. They stepped down for whatever personal reason. They've had a good run. Fine. Then there are some where it's still unclear to us what happened. What happened with Nike? Why did Mark Parker step down at that time of all times? And they tried to say, oh, this was planned, and we know that, Donahoe going over there, but it's like something happened at Nike that still hasn't quite come out. And we know that there was a lot of hemming and hawing and turmoil at that company with regards to female employees and the culture at Nike, and that story has not fully been told and is not done yet.
It's the Salazar story, too.
Sure. I mean, a couple big scandals. And by the way, Mark Parker, Nike, the face of Nike, stepping down on the same day as Kevin Plank, the face of Under Armour, stepped down. And some people say, oh, yeah, wasn't that a funny coincidence? Yeah, it's a strange coincidence, isn't it?
Yeah.
I mean, look at whatever industry you want. There was Google and Larry and Sergey. Different kind of thing as well. You know, they were not CEOs anymore, or at least, well, one was president, one was CEO of Alphabet. Yes, okay. But different kind of thing. So in some ways, I think some could say, this is, it's different in every case, you're lumping them all together. But taken as a whole, there's got to be some reason that more are being shown the door more quickly. I'm surprised in some ways that Mark Zuckerberg is still CEO of Facebook.
I am not.
I am.
Why?
At some point, you bring in an operator who's going to do things differently, who's not so wedded to it.
He's the operator.
Well, he's 34. He's overseen the insane amount of value creation.
He has not handled as well as could be handled the public scrutiny and lawmaker, but yeah, I guess the ad sales.
How would you have handled it, though?
Differently.
But what?
Not continuing to double down on something that isn't being received well. But I'm getting us off the rails here.
But he's doubling down against people who have no organized front against him. So he's just saying, keep going. I have my company. It's just me. I do whatever I want. And you Democrats and Republicans will fight with each other. And you can't touch me because you have to fight with each other first.
We'll show you how to regulate us.
Well, sure, yeah. So the CEO story, to me, I'm kind of 2 minds. It's like, it seems like a lot. And it seems like it's a significant story. And yes, it's a large number, and it is a record. So, I mean, it's not like it's anomalous.
Yeah.
Right. I mean, it's going to be a record when it's all said and done. But the way you kind of outlined it, Dan, it's like every story, right, on its own seems explicable to that specific story, right? But at the same time, it is very hard to sit there and be like, it doesn't matter. It's just so many coincidences colliding. And so, I don't know, I've been very conflicted about trying to pull bigger meaning out of it. At the same time, I don't want to just ignore the fact that there are a lot of CEOs leaving. So I don't know what it means. I know in this whole segment we're supposed to have a take about what it means, and I'm not sure. A rarity
That's
for
the
me.
take.
Some might say, I'm not sure if I know what mine is.
That's my point. Are we making too much of it? Yes and no.
My take was that they're all getting paid so much money. And that I think like now there's some people that are like, they can just leave. Any of them. They're also not fighting for their job. You're like, I have this activist breathing down my back. I don't know. I'll do this for a year and now I'm out of here.
Oh, I oversaw a toxic culture of sexual harassment. I'm out.
Yes.
I have like,
That's not
Harold
good.
Hamm is, no, I'm just saying that you can leave. They can walk away. It's not like if you leave, you need to go find another job.
I know.
It's harder is all I'm
And you know,
saying
and
for
these
everybody
guys-
else. It's a lot easier. I know you lose your private plane pass, but it's a little bit easier.
Well, if anyone wants to make me a CEO, I'm happy to do that for a few years. And,
And
then
then
according
leave.
to Jen, I will have enough money that I can leave and not work.
Well, and these guys don't have pizza experience. I've had 40 pizzas in the last 30 days. And you just wait, because the truth is going to come out here. Stay tuned.
Dan Roberts, have a great evening.
Thanks.
Coming up here, space is the final frontier, even for investors. Space investor Matt Kuda is boldly going where no man has gone before with his top picks in space exploration. We're back with that conversation right after this.
Voyager Space Holdings is the first of its kind, a holding company focused solely on supporting the growth needs of commercial space companies. Joining us now to discuss is Matthew Kuda, Voyager Space Holdings co-founder and president. So when we talk about space, it's like SpaceX or Richard Branson, basically.
Right.
There's got to be a lot of other stuff out there. Is that what you are looking at?
Yeah, exactly. I mean, when you think about space, and most of the layperson thinks about space, they think about NASA, Lockheed Martin, and Richard Branson. But in reality, there's thousands of small space companies out there now. They're called kind of new space companies that are established small businesses that are kind of all part of the ecosystem of space.
So when you look at space then, is this we could put it in Earth terms, right? Is this a B2B play? Is this a B2C play? I mean, if we're going to actually look at the galaxy as literally monetizable, who's going to be the first kind of person or first group of people that we start kind of using to monetize that?
I think it's important to realize that some of the stuff that the retail user is already using at some point of its backbone of ecosystem already has commercial space in it. You know, how does the Wi-Fi work on your airline's flight? Or the little blue dot on your Google Map on your iPhone when you have no cell phone reception. So I think it's primarily B2B, but it's important that there's that dynamic where they can have a retail user so there's not a false start in the industry.
So you think the B2C part of it, actual people going to space, the space tourism part of it, is important in the space narrative?
I think it's just one aspect. I think it gets a lot of interest because, of course, people are flying to space. And I think right now there's been around 570 people in the history of the world that have ever entered space. So it gets a lot of excitement, but there's a whole broader ecosystem.
So you were in the Air Force. I guess that means you got close to space, right? As close as non-space travelers.
Everyone does, exactly.
when you look at space, like, is this partly just something that you're really interested in as an individual? You're like, I think space is cool, and so it kind of powers a lot of your investment thesis here.
No, absolutely. I mean, I was in the Air Force. I flew the F-15. Had some point of the integration of space as we were flying missions or whatever. And I think it's important as an entrepreneur and leader of a business that you believe and enjoy what you're doing. But at the same point, I wouldn't be doing this if I didn't think that there was a broader macro tailwinds. You have national security tailwinds with the creation of the Space Force. Then you have obviously a lot of commercial applications as well.
Do you want to go to space?
Of course. Do you?
No. I'm scared to get on a regular plane. Like, I don't want to go to space.
It's okay.
Can you reassure me that it's like safe? Based on your knowledge of the aerospace industry, what's the relative safety of exiting the Earth's atmosphere?
I don't know. I mean, I think what I can say is that there's some really smart people that do a lot of iteration, that they're not going to send people up, when there's a high probability of failure.
What is the value proposition in terms of how long you're going to have to wait to get a return on these investments?
So that's a good question. I think it depends on the structure of where investors are investing. So Voyager Space Holdings is a Delaware corporation. We're not a venture fund. So as you know, most venture private equity funds have a 10-year fund life with a 5 to 7 year hold period. So they're restricted by the end of a fund. So we think the component of time is very important, and solving for that is very important. You see a lot of these benefactor capital models with Jeff Bezos and Elon Musk. They have very long time horizons. So for us as a holding company, we can acquire a company, and as we become publicly listed, essentially you create a permanent capital structure that is not limited by a 10-year fund life, for example.
So it sounds like you believe the opportunity is there, but it might take more patience, perhaps, than some investors have. I mean, they look at the space. What was that structure? The SPAC structure, right? And they say like, oh, that means we're going next year. But it sounds like you're looking a little bit further out than 1 or 3 or 5.
Right. I mean, we thought about building a venture capital fund, to be honest. I used to be a private equity investor, but I think specifically for the space sector, Voyager Space Holdings is purposely built to solve the time issue. But at the same point, I kind of equate it to, I view it as it's the internet of the 1990s. It's out there now, but no one really completely understands it. Like, what is this kind of stuff? But fast forward 20, 30 years, and it's going to change a lot of things.
How many of the companies are outside of the U.S.? Because for as much as we think we're leading the space race, I mean, China's trying to get back to the moon before we're there next. So are a lot of these companies outside the U.S.?
There is a growing amount of companies that are outside the U.S., but the dominant market by far is the United States, and then followed by Western Europe.
Matthew Kuda is Voyager Space Holdings president and co-founder. Keep us posted.
You can take Jen to space with you.
Maybe.
I'll stay here.
It depends how much it costs.
Oh, stop it. Coming up here on the final round, former U.S. ambassador to Hong Kong, Kurt Tong, talks to us about what's next on the trade war front and the situation going on in Hong Kong right now. We're back with that conversation right after this.
Hong Kong recently had elections where pro-democracy candidates came away with a victory. Yahoo Finance's Akiko Fujita sat down with the Asia Group partner and former consul general to Hong Kong and Macau, Kurt Tong, to learn what he had to say about the direction things are going in the wake of this change.
Well, I think the district council election was extraordinarily useful in allowing people to have an opportunity to express themselves, and I sense a little bit of diminishment of anxiety as a result of that. But I do think that the population still feels a considerable amount of anxiety about the future. So really the way forward is to see if there are ways that the government or some of the elected leadership in Hong Kong can find a way to reassure people about the future. Of course, the mainland government's going to play a very important role in that, and reinforcing the notion that they really understand what one country, two systems means from the perspective of the Hong Kong people.
Let me pick up on that anxiety you mentioned. We've certainly seen from a financial perspective a lot of volatility, obviously in the Hong Kong exchange, but also when you look at the broader macro picture, they've certainly been hit hard. No, people aren't necessarily visiting. I imagine you're in constant contact with those that you know in Hong Kong and a lot of the officials. What's the sense right now in terms of where things go from here?
So I think as you said, tourism is a major bastion of the economy. So the lack of visitors has been harmful to the economy. But I think most of the private sector actors are taking a much more thoughtful approach, or not more thoughtful approach, but a thoughtful approach about the future. They realize that Hong Kong is a great value proposition for both foreign investors as well as Chinese investors, and they want to stay there. They're watching closely to see what transpires over the coming months and years. But there's certainly no one running for the doors. So I think the question is, how can the Hong Kong government, the Chinese government, reassure, again, the private enterprise people in Hong Kong that this is going to continue to be a good place, a reliable, rule of law based, judicially independent jurisdiction for operating. I think that's doable. Again, it requires real effort to do so.
Broader picture, there's a lot of questions about where this all fits in terms of the discussion that's happening between Washington and Beijing on the trade negotiations. We saw the president move forward and sign that Hong Kong bill. Do you see this as a separate issue that the U.S. deals with? In other words, we once thought this was maybe a hurdle in the U.S. and Chinese reaching a deal. Do you think the Hong Kong threat, risk, if you will, has been removed from that conversation?
Certainly, it's a political variable that has impacted people's thinking in the bilateral context between the U.S. and China. I think that actually that's largely a misperception, and the right way to handle things is to treat Hong Kong as a special issue set, rather than the U.S. viewing it as a China issue or China viewing it as a U.S. issue. There should be constructive thought about how can both sides reinforce confidence in the city. Because at the end of the day, Hong Kong is a win-win proposition for both the West and for China. Now the president signed the Hong Kong Policy Act. That's largely, at this point, a symbolic measure. But the fact that it was passed and the concern that Congress has expressed about the situation in Hong Kong, I think has hurt a little bit, just a little bit, people's confidence in what's happening in Hong Kong and whether it's a good place to do business. So I think really the way forward is for everyone to really focus on how do we reinforce confidence in this value proposition that is Hong Kong.
And finally, the end goal for a lot of these demonstrators have been universal suffrage. Just hard to imagine that China would give any leverage. Do you see any movement on the Chinese side? They've seen the results of the election. Do you get the sense that Beijing will move to at least hear out the protesters beyond moving Carrie Lam, for example?
So I think there are things that the Chinese government could do to reassure people. Certainly, some degree of political reform would be helpful. I also don't expect China to give the Hong Kong people the same rights and privileges as a republic or as people living in Europe or in the United States. But I do think that an enhancement of those rights and privileges would be useful. One possibility is to look again at the Legislative Council. How could that be made a very representative force of Hong Kong public opinion? There are lots of things that could be done as long as people are willing to experiment in a positive direction.
All right, and coming up here on the final round, we'll have what you missed here on Yahoo Finance today. We're back right after this. All right, it's time now for all the best moments that you missed today right here on Yahoo Finance.
Christina, we just had Raymond James, Scott Brown on here, and he pointed out a lot of people in the market view these rate cuts as heroin. Strong statement, yes, but is this market addicted to rate cuts?
Well, I actually take exception with that. I would say more like crack.
Well, that's really splitting hairs. Wow, Christina, I did not expect that card for you.
Bob Iger, you know, he's just sort of the top of this incredible organization in an incredible year. The first day that Disney Plus launched, it got 10 million subscribers. And, you know, I mean, Iger himself is, you know, had a New York Times bestseller this year. I mean, he's sort of at the top of his game.
Gee, maybe President Trump really has influenced Jay Powell. Maybe those tweets do matter. And the other thing to remember is Jay Powell is probably a one-term chair.
The idea of flipped is it's for people in heavily, densely populated areas where they're a little more on the go, they need things fast. We're going to provide that for them.
And of course, we did have a lot of buying. 75% of the institutional money that this IPO represents comes from Saudi companies, funds, government agencies. 97% of the retail investors are coming strictly from Saudi Arabia. So when you put a gun up to your countryman's head and tell them to buy, guess what? They buy.
Our economic outlook remains a favorable one, despite global developments and ongoing risks.
Amazon would be the hardest of the four. Maybe you could chip off a small issue, but you know, some sort of big breakup. I think that would be the hardest because it sort of exemplifies the test of antitrust propriety does it benefit the consumer.
That's going to do it for us today. The last Fed meeting of the year and the decade. We won't see Jay Powell, at least in that room.
We'll see him in like 6 weeks. But everything will be different because it'll be 2020.
It'll be 2020. We're sending you off here with very small green arrows across the board. That's all for now from New York. I'm Jen Rogers with Miles Edlin. This is the final round.